Please welcome your host, Natalie Brunel.
Welcome to day 2 of Bitcoin for Corporations at MicroStrategy World. We have such a great and very full day in store for you, starting with a keynote that you do not want to miss. And I want to just say once again, thank you so much to the generous sponsors who made this event possible. I'm so honored to be up here to introduce Michael Saylor again momentarily. If you've followed my work, you know that I talk a lot about the American dream and how Bitcoin, I believe, can really revive the American dream. I was thinking the other day about how when Michael started MicroStrategy in the late 1980s, my family was in Eastern Europe trying to flee communism, and they were driven by economic hope and the American dream. And I think that Michael and MicroStrategy really embody the American dream. What can be built here? The value that can be created. No one handed anything to Michael Saylor. He wasn't born into wealth. And I think that his success and the company's success is really a testament to how determination and innovation can transform ambitious ideas. And now it's so inspiring to see how determined he is to help onboard the world to Bitcoin. And in my opinion, there is no second best messenger for this message of hope. So Bitcoin is the American dream, and I'm so honored to once again introduce Michael Saylor, Executive Chairman for MicroStrategy.
This, of course, is my favorite subject. There's no better way, no way I'd prefer to start the day than talking about Bitcoin and why there is no second best. I had an occasion to consider this phrase as I prepared this presentation, and I just thought it resonated across so many different dimensions. And so I started considering, you know, what is the best idea, right? What is the best? And I think that in the modern era, in the 21st century, I think we can agree that the best idea has been digital transformation. And the companies that have reshaped the world over the past 30 years are Microsoft and Apple and Google and Facebook and NVIDIA, and they stand for digital books and digital entertainment and digital intelligence and digital communications and digital memories. And of course, as they dematerialize those products, as our recorders drop away or dematerialize and our CDs and our libraries dematerialize, and as our services dematerialize, there's just a massive amount of economic energy that's been given out. There's an extraordinary amount of efficiency. Now you can give a book to 1 billion people, or you can give Beethoven's Ninth Symphony to 1 billion people, and you can do it for the cost of some incremental electricity. And the big winners were the investors in these companies, and the companies themselves became, you know, as powerful as nation states. Now, how good an idea is digital transformation? Well, it's good enough that in many years, 100% of the return for the S&P are attributable to just 7 companies. 1% of the companies have all the result. In other words, if you're not doing this, then you're just working very hard, and working harder just doesn't get ahead. This is a snapshot in the year 2023, and it just shows you, A, how good that idea is, and B, just how much trouble you're in if you're not actually surfing a digital wave here. 7 companies have all the returns in the S&P index. 493 companies return nothing. Okay? This is not a value judgment. The truth is, probably the people that work for the 493 companies worked harder. They worked harder. They're probably smarter. They got paid less. And they're taking an extraordinary beating and a burden on their back, trying to fight against a digital wave. But life isn't fair, and certainly the global economy isn't fair. If you're the winner, you're the winner, and if you get on the wrong side of a trend, then you just get gradually crushed. So this is a sobering observation, but it's a reminder that if you're going to invest, and if you're going to align yourself with an idea, it better be the best idea, because the second best idea, as you can see, is worth nothing. You'll be lucky if you just stay in business. So, what's the best digital transformation idea? Digital capital is the best digital transformation, right? I mean, for 30 years, we've been transforming books and records and email or letters and packages and pictures and VHS cassettes and the like. But that's all digital information. Digital information it's interesting. It does create enormous value, but the truth is, the first 30 years of digital transformation will be an order of magnitude less important than the next 30 years of digital transformation. And the real bull here, the extraordinary opportunity, is the digital transformation of capital, the digital transformation of property, the digital transformation of money. And if you want to be a physicist and be deep about this, it's the digital transformation of matter and energy. Not the digital transformation of information, but the digital transformation of matter and energy. And where are we? Well, I mean, first of all, you're talking about $900 trillion of assets that are in the analog world. So I don't know what Apple's worth or what Microsoft is worth, but, you know, books weren't worth $900 trillion when they transformed them, and nor were CD records worth $900 trillion. As of today, 0.1% of the capital in the world is digital. 99.9% is this, right? We're very early in the digital transformation cycle of capital. Right? The world is living in analog assets. We have analog money, we have analog bonds, we have analog real estate, we have analog equity, we have analog art. A lot of analog stuff. $900 trillion of it, but the $900 trillion doesn't just reflect the value of the physical stuff. It reflects a monetary premium over and above the utility value of the stuff. People buy real estate not just to live in, they buy real estate as a store of value. And they buy equities not just because they want to capture the cash flows of the company. They buy equities because they want a store of value and they feel like it's preferable to holding cash. And for 500 years, people have been buying art as a store of value. It was scarce, desirable, portable property. If you had to leave the city, you could take it with you. And gold is the same thing. People have been buying gold as a store of value. So something like half of all this capital is really a monetary premium. And the other half may be a utility. We are just 1 trillion out of the 900 trillion right now. Very early. Crypto proof of work is the best way to create digital capital. The world wants digital capital. What's the best way to do it? Crypto proof of work. That is to say, when you're running a proof of work mining operation that converts energy into information that can be secured and transferred via cryptography. Not all crypto is based on proof of work, and therefore not all crypto is digital capital. A lot of it just looks like a digital security. But what's special about this particular approach, which is, of course, the Bitcoin architecture, is it creates a decentralized asset. It creates a physical asset. There is a physical linkage to the real world via the electricity and the silicon that makes it thermodynamically sound and integrates it into the universe and not just the metaverse. It's sovereign. You can take custody of this. It's egalitarian. The protocol is open. Anybody, anywhere on Earth can engage in this network. It's permissionless. It's global, right? This is the best idea, the best way to create digital capital. What's the best crypto proof of work asset? Bitcoin is the best. How good is it? It's 97% of all of the market cap of crypto proof of work. After Bitcoin, you have to go all the way down to Dogecoin, literally a joke created over the weekend by an engineer as a joke to find the second best. Obviously, there is no second best proof of work asset. But you know what? There's no second best crypto. Bitcoin's the best crypto asset. Now, why is it the best crypto asset? Because it's increasingly clear that no other crypto token is going to achieve institutional acceptance this decade. Bitcoin is the only crypto that's going to cross the chasm. You could see the writing on the wall when the spot ETF of Bitcoin was approved in January. By the end of May, you'll know that Ethereum is not going to be approved. And when Ethereum is not going to be approved, sometime this summer, it'll be very clear to everyone that Ethereum is deemed a crypto asset security, not a commodity. After that, you're going to see that Ethereum, BNB, Solana, Ripple, Cardano, everything down the stack is just a crypto asset security unregistered. None of them will ever be wrapped by a spot ETF. None of them will be accepted by Wall Street. None of them will be accepted by mainstream institutional investors as crypto assets. This is the one universal, consensus accepted, institutional grade crypto asset in the world. There won't be another one this decade. I can't speak to 20, 30, 40, 50 years out. Anything can happen that far out. But between the year 2024 and the year 2030, the die is cast, the writing is on the wall. This is the winner. There is no second best. And Bitcoin is the best crypto network. It's not just the best crypto asset. This asset is secured by the most powerful computer network in the world. It's rapidly growing stronger. Hash rate's growing by 70% a year. It's growing that fast in bull markets and bear markets. It's an unstoppable thing. How much is 624 exahash? It's enough that all of the computer power of Microsoft or Amazon is not going to outdo this, right? This is a silicon machine, because the genius of an open crypto proof of work network is that very intelligent engineers can harness the power of ASIC chips to create orders of magnitude more efficiency in SHA-256 hashing. So the silicon ratchet is 2,000 to 1, 3,000 to 1 more powerful than a general purpose CPU. A GPU is not appropriate and is not capable of doing this. It's not the right technique, so you're not threatened by all the GPU capacity. And what you have here is enough hash power to create a wall of encrypted energy that's nation-state resistant, that's corporate resistant, that's Dr. Evil resistant, that's hacker resistant. There is no trick, there is no gimmick, there is no social attack. This is just raw digital power standing in the way of anybody that would try to undermine the integrity of the network. And it's also driven by electricity, 20 gigawatts of electricity, 20 full-on nuclear reactors worth of electricity. But it's a lot better than 20 full-on nuclear reactors, because this electricity is spread everywhere to the ends of the earth. The network is feeding on electricity, and that creates a decentralizing dynamic that drives all of the network to the end of the grid in the quest of stranded energy. So this network and the dynamic is going to continually decentralize, continually dissipate. It's going to continually move away from population centers where the electricity is expensive. It's going to move to places where the electricity is stranded, where it needs to be recycled. And that 30 gigawatts is going to create a thermodynamic connection between the virtual network and the physical world. This is what makes the network stable. This is what makes the network ethical. This is what makes the network politically sound. The fact that that electricity is going to be coming off of a dam in Bhutan or a volcano in South America or Africa means that this is going to be a global neutral asset. There's no way anybody's going to centralize the Bitcoin network on top of a single data center. That's what makes Bitcoin the best crypto network. Now, beyond that, Bitcoin's the best crypto brand. Why is it the best crypto brand? Well, 220 million Bitcoin holders, people that have an economic interest in Bitcoin. 420 million crypto users around the world. The crypto industry has been aggressively marketing and aggressively expanding on the backs of lots of different use cases, not just Bitcoin as store of value or property, but also cryptocurrencies, stable coins, NFTs, everything under the sun. And this continues to grow. It's a incredibly aggressive, fast-growing, creative market. The marketing is extraordinary. But there's an important point to be made here. As the other crypto assets fail because of competition, as the Solana competes with Ethereum, competes with whatever, as they fail due to regulation, as they get shut down or they get labeled unregistered securities by regulators, as they fail due to entropy, just the complexity of what they're attempting to accomplish, and they crash or they get hacked or they unwind, or as people move away from their projects, as those failures take place, all the users in the crypto ecosystem and all the capital in the crypto ecosystem is going to flow into the best network. It's going to flow into Bitcoin because Bitcoin has 100% crypto acceptance. If you talk to everybody in the world and you say, well, do you like crypto? Yeah, I do. Well, is Bitcoin legitimate? What's the most secure, what's the most credible crypto network? Well, it's Bitcoin. Bitcoin's the O positive, right? It's the universal donor, right? Everybody can't agree on anything else. If you talk to people in the crypto ecosystem and you ask them whether or not they like Solana better than this or Tether better than that or NFTs better than this, they can't agree on that. That's competitive, that's controversial, that's confusing. Everybody agrees on this one thing, Bitcoin. Bitcoin will be around for the long term. The industry was built on it. It'll be around long after most of the other industry participants are gone. Well, Bitcoin's not just the best crypto brand. It's the best investment brand. There is no second best investment brand. People know about the dollar, but dollar's not an investment unless you're in a country with the currency collapsing. And if the currency's not collapsing, then you need a different investment. Okay, Bitcoin's the most widely held investment asset in the world, right? People are coming to grips with that. I travel all over the world. I get on the runway in the middle of Switzerland, and the guy with the yellow vest knows me. He's buying Bitcoin for his daughter. He just got married. I walk to the beach in Italy, and someone swimming off the beach yells at me, and they know me. I walk into a room full of billionaires, they know me. I walk to a bar, and the guys at the bar turn around, and they know me. This happens in Uruguay. It happens in Mexico. It happens in Brazil. It happens in Italy. It happens in Greece. Happens in Switzerland. Happens in London. Happens in New York City. Happens in Asia, right? Why, right? Bitcoin's a sports team with hundreds of millions, arguably 400 million fans, and they're all rooting for the same thing. And when Bitcoin's doing well, they're all in a good mood. It's like their blood sugar's up. When Bitcoin's doing poorly, it's all they're in a surly mood, their blood sugar is down. But, you know, give me another example of a team that's got 400 million passionate fans and they're all winning or losing together, right? What's making news on Sunday afternoon? Bitcoin. When there's a scare of a war, what's crashing? What can you sell? Bitcoin. When you decide the war's not coming, what can you buy? Bitcoin. What is there to tweet about, talk about? Bitcoin. What do you cover on YouTube on a Saturday or Sunday or midnight on the East Coast? Bitcoin, right? Everybody's got something to say about it. What is it? Well, and why is it? Well, first of all, it's the most widely held asset in the world because it's a standardized economic unit, right? I mean, maybe we own watches, but we own different watches. Maybe we own buildings, we own different buildings, right? Maybe your building is worth more in Paris, but how does that help my building in Los Angeles? We're not on the same team. We're not on team building, right? We're not on team watch. You know, and good luck, you know, trying to invest in like Apple stock in Nigeria, right? And so what is Bitcoin? Well, Bitcoin's the economic solution to everybody. It's a global economic solution to billions of people, right? And what has it become? It's become cool. Bitcoin's cool. It's useful. It's global. It's standard. Who's the last person to standardize something? Well, I mean, people have been standardizing things for thousands of years, but you might know the name of one company, one Standard Oil. John D. Rockefeller launched Standard Oil, and it became such a household word. In fact, just about every oil company in America came from John D. Rockefeller's company. Half the oil companies in Europe came from John D. Rockefeller's company. We all zoned out and we thought oil. We forgot about the standard part. The standard part was this is the oil that's not going to blow up in your face and set your house on fire. This is the oil that's actually got clean chemical properties. Standardizing energy was the most powerful idea in the 20th century. Made the richest man in the 20th century and created every single energy company. But what is this? This is standard capital. This is standard wealth for 8 billion people. It's, you know, so tell me the next standard, right? Give me another asset that goes up in value, not down in value, that's standardized, open to, and global to everybody, right? And the answer is there is no second best, right? There's a standard investment brand. It's called Bitcoin. It's always interesting. It's egalitarian. You can buy $1 billion worth of it, and it's a pretty good idea to buy $1 billion, but you can buy $23 worth of it. And if you look at the wealthy in the world, they buy buildings, but you know, how's a cab driver in Nigeria supposed to buy a fraction of a building, right? How does it impact the other 7.9 billion people that can't afford a building, right? This is egalitarian capital, egalitarian property, and it's prestigious, right? So this is the ultimate luxury brand. You know, people used to buy the nice watch, so they figure they could sell it if they ever needed to eat or pawn it, right? But you'd much rather have Bitcoin in your watch. Bitcoin's the best digital commodity. There's no second best digital commodity. What is a digital commodity? It's the only crypto in the world recognized as an asset without an issuer by all major regulators. By all major regulators. Okay, the Chinese recognize it. The Russians recognize it. Right? The enemies of the U.S. recognize it. You know, in Singapore, in the UAE, in the U.S., in Brazil, everywhere. This is the one thing everybody recognizes. So the question is why? Why? It's not the first. It's not the only. There's 2.5 million copies. Why? It's because of the Immaculate Conception. What is the Immaculate Conception? By the way, it's such a simple idea, and yet everybody that's copied Bitcoin hasn't got this simple idea in their head. Satoshi created a way. He gave it away, and he went away, walked away. That's the idea. there's not a single major company in the world where someone created the company, gave it to the world, and walked off. And in fact, if you look at every other crypto asset, there is no Satoshi, right? In fact, the way you know that they're not commodities is they're all arguing that they're commodities. Satoshi's not arguing anything. Satoshi went away, gave it to you, right? And this is the essence of it. If something's going to be a commodity, there can't be a beneficiary. Satoshi gave up control of the protocol. Satoshi gave up the Satoshi coins. Satoshi stopped trying to influence the network. It was a gift to the world. That's what makes it an asset without an issuer. If you go and make a list of the next 100 cryptos and you go down the list, you're going to be hard-pressed to find that. But that's a simple asset test. By the way, it's a lot easier than the Howey test. You know, if you wanted to figure out whether you're a security, if you created something, did you give it all away to someone else? Did you never sell it? And are you gone and not arguing over it? And then maybe it is. So I have simple advice for someone that wants to create a digital commodity, right? Give it away and walk away. Bitcoin is not just the best digital commodity. It's the best commodity, right? Bitcoin's the only commodity in the world, that's digital. Everything else is a physical commodity. And because it's digital, it's fixed in supply. Everything else is physical, therefore not fixed in supply. That makes Bitcoin superior to gold, and gold is the king of commodities. You know, when I started my career at DuPont, commodity was a dirty word. Every single business decision made by the DuPont Corporation was to escape a commodity business and create a specialty business. Nobody wanted to manufacture or sell commodities, and the reason why is they knew they were all eventually driven to zero profitability, or every commodity provider eventually has to produce the commodity at a loss in order just to run their capital. And so commodities are awful investments, and gold is simply, you know, the least worst of an awful investment. Why is Bitcoin the best? It's global, it's digital, it's programmable, it's inelastic, it's durable, it's divisible, it's portable. These are all the things that every other commodity is not. Okay, well, the numbers don't lie. You know, I can give you words and rhetoric, but look at the last 4 years. In an inflationary environment, gold is up 13%, Bitcoin is up 394%. Any good investor will tell you all physical commodities make poor investments. Gold's just the least worst. Now, for those of you who are Bitcoin advocates and you go and you talk to people, right, what you'll find is the very controversial narrative of Bitcoin is this digital currency. That gets everybody racked around the axle because they think, well, it's competing with the yen and the dollar and the euro and the ruble and the CNY and the like, and it's a medium exchange, and it needs to be legal tender, and it shouldn't be taxed. It becomes a very controversial thing. If you put that aside for a second, that's the ugly narrative, and you go to the bad narrative. Bitcoin is digital gold. It's sort of true, but it's not a very good narrative. Why? Because if you talk to 1,000 billionaires and you say, well, how many of you made $1 billion investing in gold? And the answer is 0. And if you go to 1,000 wealthy families and say, now that you're wealthy, you know, are you going to go buy $1 billion of gold? The answer is no. And you say, well, we've got digital gold. It's great. It moves at the speed of light. It's programmable. You can teleport it. It's great. And they go, well, that's nice, but I don't own any gold. Okay, I can't find anybody that owns gold. The people that are advocates of gold don't own gold. Peter Schiff, on the record, has spent 15 years advocating gold. And when you ask him, Peter, do you own any gold? It's like, oh, no, I don't own gold. It's a very small part of my portfolio. Okay, so find me someone that actually owns gold that you could even debate on the topic. And the answer is it just seems to be 1% to 3% oddity, you know, in any portfolio. So Yeah, Bitcoin is the best commodity, but the truth is all commodities are dogs, and Bitcoin actually fixed the commodity. But that word commodity is a dirty word. Every intelligent business person, every intelligent investor knows that you should run as fast. Run, don't walk away from commodities. So what is Bitcoin really? Bitcoin's the only scarcity. It's not a commodity. A commodity is something you can create infinite amounts of. And anybody's allowed to create infinite amounts of and dump it on the market. And if you want to hold, $1 billion of soybeans for 100 years, that's probably not going to be generational wealth for your granddaughter, right? Pretty obvious why. But $1 billion of gold won't be generational wealth for your granddaughter either. Bitcoin's the first absolutely scarce commodity in human history. So you have to say it represents an entirely new asset class. It's not an equity, it's not a property, it's not a commodity, it's something different, it's new. Given the fact that it's new, there's nothing to compare it to. So you got to ask the question, if there is no scarce commodity in the world, what is scarce? Find me anything that's scarce. And I got the hourglass up here to make a point. No amount of money will buy you more time or more Bitcoin. So if you consider the nature of the universe as a physicist, the one thing that's scarce is time, right? No politician can make more of it. No capitalist can manufacture more of it. No AI bot can create more of it. Time is the true ultimate scarce yardstick, right? That's how the universe works. That's how God makes the universe work. Einstein had a lot to say about it. Physicists have a lot to say about it. What have we done with Bitcoin? We have bottled time in a Bitcoin, right? The process of proof of work mining is, in essence, digitally transforming time into an asset. Our goal was to create a digital money, but now it gives new meaning to the phrase time is money. How do I actually create digital time, digital scarcity, and then how do I put it, on a hardware wallet? How do I move it? How do I compute with it? Right? So scarcity is, it's very underwhelming to say, oh, Bitcoin is it's digital currency, or it's digital property, or it's digital gold, or it's digital something, because what it really is this digital time, this constant, right? If I give you 100 trillion quadrillion dollars, you won't get more than 21 million Bitcoin. If I give you all the money in the world and you crank the miner up, we know how fast Bitcoin is coming out every 10 minutes, right? We have created the perfect monetary asset because we have figured out how to duplicate the benefits and the characteristics of time. And ultimately, when you measure your life and everything in your life, you have to measure it against time, because time's the one thing you're not getting back, no matter how rich you are. Now, people oftentimes, they try to buy land, right? Land is the scarce asset. They're not making any more beachfront property, right? I want to buy land, and the truth is, in the 20th century, if you're a rich family and you didn't make money on technology, then you made money on property. And the property you bought was the middle of London or Paris or New York, or you bought some beachfront in the Hamptons or Palm Beach or something, but probably you bought very desirable commercial real estate in the middle of the city. But, it's kind of a bromide. People will say things, oh yeah, well, I guess commodities can be manufactured, but land, they're not making that anymore. They're not making any more land, right? When Mark Twain said that? Okay, look at the picture here. The truth is, they are making more land. This is Boston over the course of 300 years. Half of Boston was made. I live in Miami Beach. 3/4 of Miami Beach was manufactured in the last 100 years. It's all made, right? They dredged it. Dubai, they make land. Amsterdam, Rotterdam, they made the land. The truth is, given enough money, you can make land, and if you want it, you'd be surprised how much of it you make, right? Most people don't think about this, but at the end of the day, storing all of your economic energy in land is not truly going to be effective, because it's going to inflate, and it's going to be impaired by a whole set of other challenges. So Bitcoin's the best property. What's the best property? Bitcoin's the best property. What's the second best property? There is no second best property, right? This is the greatest digital city in the world. There's 220 million inhabitants there right now. What's the second best digital city in the world? Right? There isn't a second best city in the world. Why is this so powerful? It's global. Anybody can go there. It's digital. You can zap there on a mobile phone, and there's billions of mobile devices. It's open. This is a city that's got no mayor to tell you what you can't do. And on the other hand, everybody can zap there with their capital when they want. It's permissionless. And you don't have to buy a building. And you don't, I mean, how many people can afford an apartment in New York? Most people can't afford an apartment in New York. You can buy a fraction of a piece of property in this city. It's totally divisible, and this is the immortal city. Maybe New York is there a couple of hundred years. This city could be there 10,000 years. It's a virtual city. And, you know, we talk about sustainability, but sustainable here means there's no painting, there's no tornado going to hit this city. There's not a flood insurance obligation on this city. You don't have to worry about, you know, neighbors getting together and creating a zoning ordinance. This city will last, and this property in this city will last. Bitcoin's the best property, right? Why would you buy it? You would buy it because it's a heck of a lot better idea than buying an apartment to Airbnb for the rest of your life. What are you going to do when you die? You're going to leave instructions for your grandchildren on how to operate the Airbnb? And, you know, and where are the instructions for how to actually convince the mayor to not tax away or rent control your Airbnb? You know, one of the problems with property is it's inherently corrupting in the physical world, because if you're not a political actor and you own property, then the politicians take it away from you. And that convinces you that you have to then influence the political process and take control of the government, whether it's the city, the county, the state, right? Entire states were created, right? Why is Las Vegas here? Why are you in the city? You know why you're here? It's because they drove all the way down to across the state line. And when they were out of California, they said, okay, this is a good state, and we'll put the city here in this part of the desert. If the city had been a few miles on the other side of the highway, there'd be no Las Vegas. Everything that's going on here would have been shut down, regulated away, made illegal, or taxed away sometime in the last 50 years. So the problem with physical property is you have to become the political actor, or another political actor will just take it away from you. And there's no middle ground. And at the point that you're no longer politically capable of defending your property, when your children or grandchildren aren't as well-wired and aren't as politically sophisticated or charming or charismatic as you are, then the county, the city, the state, the whatever, they just crank your property taxes, expropriate your property, turn it into an airport or a school or whatever, utility line, and someone writes a little obituary saying, oops, third generation, they lost the family farm. I guess they weren't as smart as their grandparents were. They probably deserved it, right? And that's the best thing about this property. Here's a city you can move to, a cyber Manhattan. There's never going to be more than 276 to the third blocks. 276 cubed, that's the number I want to plant in your head. If Bitcoin was a city in cyberspace, it would be 276 blocks wide, 276 blocks high, 276 blocks deep. When you buy Bitcoin, you're buying one of those blocks. That's all there is. 276 is the cube root of 21 million to the nearest integer. There's no second best property. But again, as I say, property's really, it's underselling what Bitcoin is. Bitcoin is much better than digital property. Bitcoin's the best capital asset. Capital, what is capital? Pure economic energy. Bitcoin's digital capital. It is the first occurrence of pure economic energy in the history of humanity. If we look at every other asset, there's no other asset, there's no second best capital asset, there's no asset that represented pure economic energy. The closest thing we have to it is the myth of gold and the idea that, you know, if I'm successful in business, I'll basically convert that success into gold. When I'm a powerful king, when my kingdom is successful, it'll be the kingdom of gold. When my city is successful, it'll be the city of gold, right? The gold standard, right? We talk about gold, but gold was never pure economic energy. Just ask the Spanish when they had all their gold wash up in Queen Elizabeth's harbor during the Great Wars, and she took it all. And then they lost the war in the Netherlands because she took their gold, because their gold had to be shipped on wooden ships. It wasn't quite energy at all. It was a little bit too clumsy. And gold, of course, as we talked about, it's a commodity. It's inflationary. The Spanish had hyperinflation, you know, in the 16th century after they brought all the gold back from the New World. 500% inflation. They collapsed their entire civilization. They destroyed their empire because they found too much gold. Must not have been pure economic energy the way it worked out. The problem with every other asset, and the primary capital assets are equity, credit, the bonds that is, currency, and property. They're all impaired by physical constraints. The physical constraints lead to political constraints, lead to entropic effects, chaos, disorder, fragility, risk. Bitcoin's better than that. Bitcoin's immortal, immutable, indestructible. The whole idea of Bitcoin is I create an asset which doesn't live in the physical world, that lives in the virtual world. And because it's immortal, I mean, immortal is a pretty big word. I mean, what's the difference between inflating the gold supply 2% a year and inflating the Bitcoin supply 0% a year over 10,000 years? Well, the useful life of gold, the half-life of money in gold, or half-life of capital in gold is 30 years. It's a difference between dying in 30 years or living forever. That's what, when people tell you 2% inflation doesn't matter, well, 0% inflation is live forever, immortal, and 2% inflation is die or half die in 30 years, die fully in 60 to 70 years. It really does matter. So the idea of immortality in your energy is pretty critical. Immutable, right? Is someone going to corrupt it? Indestructible? Is an act of God, a force majeure, going to destroy it? Everything else, all these other capital assets, they suffer from those risks. And because Bitcoin doesn't, it's inevitable. It's an inevitable idea. Why? Look at Bitcoin man here. Not stupid, right? People aren't stupid. I mean, go back 10,000 years and then find everyone that disagreed with you on every ideology and every religion, and then ask the question what they all agree on. And they generally all agreed that they didn't want to lose their stuff, right? Just about everybody, whether they're socialist, communist, capitalist, every possible ideology, they all agree that generally being wealthier or having economic power is better than not having economic power. There's a few people that kind of forsake all their property and surrender their economic power. They end up losing control of the government and lose control of the society, and they certainly lose control of the armies, because one of the lessons of history is if you can't pay your soldiers, then they're going to mutiny, and then your empire is going to collapse. So in this particular case, every self-interested human being that's going to compete in a Darwinian world is going to agree that they want immutable, immortal, indestructible capital, right? Who doesn't? So back to the numbers. What's the best capital asset? Bitcoin. What's the second best capital asset? Well, actually, the S&P is the modern surrogate for cost of capital. So that's been the case at least for 30 years, probably 30, 40 years since the Vanguard 500 and since SPY was launched by State Street. And so if you're looking for the cost of capital, what is the cost of capital? It's kind of like the rate at which your capital has to return for you to not get poorer. And it's kind of interesting here, 50% over 4 years is about 12% a year. The cost of capital is about 12%. If I had to guess, at what rate does the US dollar money supply expand? Probably 12%, because that's kind of copying it. I mean, probably the dollar supply expands a little bit faster. That probably slightly underperforms the monetary inflation rate. But if you had to pick one metric and say, what's the metric that gives you a sense of how rapidly the world currency supply is expanding in dollars, probably the S&P 500. That's the cost of capital. And as you can see, when you have inflation, the money finds its way into the strongest asset, and it does not find its way into the weakest asset. So this is another way to see inflation. This is last 4 years. And what do you see here? You see that when the money supply expands, perhaps 50, 60%, I wouldn't be surprised if it didn't expand 60%. I don't think we measure it, by the way. I think that all of the official measurements of M2, I think all of them are incomplete, imperfect, in the same way that unemployment statistics are imperfect, in the same way that GDP statistics are imperfect, in the same way that inflation is imperfect. They're just synthetic numbers that a certain organization decides to focus on. But what's the story here? The story here is that bonds don't hold value, right? They're awful capital assets. Silver doesn't work. Gold doesn't keep up with the cost of capital. The NASDAQ, interesting, it underperforms the S&P. Why? Well, sometimes you get some big winners with technology, and sometimes you don't. But maybe the S&P is a more broad index and just got a little bit less of a sharp edge to it, less risk in it. There's a lot of low-risk businesses in the S&P 500. And then obviously what we see is Bitcoin's the only asset that exceeds the cost of capital. Another way to say that is everything else is dilutive. You invest in anything other than Bitcoin, you're destroying capital, you're destroying wealth, right? You invest in the S&P 500, it's a conventional capital asset. You won't look stupid. You're probably still losing a bit of wealth, but nobody will notice because the rest of the society's using that as the benchmark. But if you're not doing the 50%, then you're running a hedge fund underperforming the S&P 500. You're destroying value. Most of them underperform the S&P 500, and they destroy value. What's the best capital asset? Bitcoin. What's the second best? There is no second best. That makes Bitcoin the best treasury asset. Treasury meaning you got a company, a private company, a public company, you've got a treasury. A treasury means you've got a country, you've got a city, you have a municipality, you have an institution, you have an endowment, you have a treasury. Well, most operating companies surrender their capital to avoid shareholder dilution, right? Because if they hold the capital and they invest it in T-bills, they're going to get 3% after tax against a 12% cost of capital per year. And so you hold $100 billion of capital, you destroy $9 billion of shareholder value a year. Berkshire Hathaway's got $160 billion of capital. That's a $15 billion a year cost in order to use that as a treasury asset. Cash and credit are both dilutive. Bitcoin is the first treasury asset that's accretive. That is, you carry $100 billion of Bitcoin, it goes up 40% a year. You're earning $40 billion of accretion a year instead of $9 billion of dilution a year. That means Bitcoin changes the rules of modern corporate finance. Finance for the past 50 years in B school, is taught like this. You have to operate on the P&L to strip away all volatility. We want you to pursue the Microsoft model. We're going to sell you 3-year enterprise agreements, and they're fixed for the next 3 years. We'll renew them every 3 years. The CFO of Microsoft can predict the quarterly results 12 months in advance, plus or minus 50 basis points or 100 basis points. The only moving part is the cost, and the costs are controlled by the corporation. So modern finance says you're a good CFO if you strip the volatility off the P&L, and then you're a good CFO if you return all the capital to shareholders via buyback or a dividend, no matter how tax inefficient it might be. And then if you want to be a really good CFO, you borrow $50 billion, and you give that back to the shareholders, so you actually go to negative working capital. Well, so, you know, and that's happening where? It's happening at Apple, it's happening at Meta, it's happening most places. Why? Well, I mean, partly it's happening because you need to get your EPS to go up by 12% a year if you're going to beat the 12% cost of capital and make your stock a store of value. And if you're organically only growing 1, 2, 3% a year, which is I mean, people do the math. If the economy grows 2 or 3% a year and you need your equity to grow or your cash flows to grow 12% a year per share, the only way to do it is to borrow money and buy back your equity and lever up. But at that point, you go to negative capital. Okay, so if you hold positive capital, that's what that's what bonds do to you. And if you hold negative capital, now you're fragile. You have one bad quarter, you go bankrupt. Right? So the problem here is that the treasury asset that's conventional is toxic, and it's killing the companies. The corporate life expectancy is 10, 15, 20 years. Okay, and we've simply accepted the fact that our company's going to die in 20 years. But the reason they're dying in 20 years is you're injecting poison into their veins. If they just stopped injecting the poison, they'd live hundreds of years, right? It's a very basic insight. So what's the way to flip that? The way to flip it is you stop injecting toxic assets onto your balance sheet, and you actually put accretive or healthy assets onto a corporate balance sheet. This is what happened to MicroStrategy since we adopted a Bitcoin strategy in 4 years. You've all lived these 4 years. SAP, IBM, Salesforce, and Oracle, that's what they do. Oracle looks like the winner. They beat the cost of capital of 50%, right, the S&P. Oracle's the winner. The rest are losing. They're not keeping up. Then you've got Amazon, Netflix. They can't keep up with the cost of capital. Apple's barely tracking the S&P. Meta, Microsoft, Google, looking a little bit better. And then you see where the assets are. Any company that simply had a large portion of their assets in Bitcoin is getting 435%. MicroStrategy levered up by borrowing cheap debt and buying Bitcoin, and therefore we do better. Now, if you had asked someone, is a $500 million company growing 0% a year in August of 2020, are they going to beat every one of these companies' performance? People would have said, no stinking way. Right? And the truth is, it's not us. It's Bitcoin. Stop bleeding the patient. The patient mortality rates plunge when you stop bleeding the patient and when you sterilize the equipment you use to operate on them, right? It's basic medicine. Eliminate the toxicity. So what's the best tech investment? Bitcoin's the best tech investment. The best tech investment, an investment in something everybody needs, no one can stop, few understand. Apple in 2010, Amazon, Facebook, Google. Everybody needs it, nobody can stop it, people don't understand it. If people agree with you when you say, I like Bitcoin, that means it's not a good investment anymore. You understand? At the point when it's not controversial and everybody agrees with you, everybody will own it, the price will be 100x. You won't be able to afford to buy 1% of what you want, right? You want to know it. You don't want them to understand it. Let them take 10 years to figure it out, because that's how you 100x. What's the best new investment idea? Bitcoin's the best new investment idea. Okay, financial advisors, they're looking for an alternative investment that's going to provide performance without direct correlation to risk, right? And they've been stuck in a rut for 30 years, right? This is JP Morgan's family office survey. What do people own? They own some private equity, some public equity, some real estate, some cash, some bonds, some commodities, infrastructure. You notice commodities are the least popular. A lot of people just think it's a no-fly zone. The other stuff are pretty conventional. But coming back to this chart, you know, I think this is probably also JP Morgan. None of these assets are beating the monetary inflation rate. You just feel smart because you tell yourself the inflation rate is the consumer inflation. But for the most part, the screaming winners are 1% better. Nobody's got a great solution, right? You can either do really awful, or you can just, you know, keep your wealth without generating any more. Nobody can outperform inflation. So what do they invest in? Well, these family offices, this is capital weighted. They put 45% of their capital into alternative investments. They don't want to hold public equity. Their view is public equity is fully valued. They certainly don't want to own bonds, right? So much for the 60-40 portfolio. Their portfolio is not 60-40. They want something else. And something else is more like real estate or something private or some special situation. But what's the best alternative investment? Bitcoin's the best alternative investment, right? What's the second best? There is no second best, right? There's hundreds of thousands of financial advisors, and every wealthy family in the world is looking for the best alternative asset. Okay, why is Bitcoin the best alternative asset? Well, just a little bit of inspection will demonstrate that it's uncorrelated to currencies, corporations, or counterparties. No corporate execution risk, no currency debasement risk, and none of the counterparty risk that comes with bonds and credit and the like. What is it? It's global, it's non-sovereign, it's a store of value. It's liquid. You know, buying a building in San Francisco is not liquid. You can't buy it in a minute. You can't sell it on the weekend. And the truth is, and this is the irony of ironies, everybody thinks Bitcoin is risky because it's volatile. It's volatile because it's not risky. It's the lowest risk thing you can own in the world because it's the thing that has the most risk stripped away. The reason it's volatile, it's that it's the most desirable, most accessible thing, which means that everybody else is expressing their sentiment and their emotions every minute of the day, everywhere in the world, however they wish to. And why is it the best alternative asset? Because it's the longest duration asset, right? You buy a building on the beach, it'll last for 30 years. Do you want to buy a building in Manhattan that's good for 50 years or whatever? Or do you want to buy the granite or the schist under Manhattan that's been there for 200 million years? Buy 100 blocks of granite in Manhattan, right? Don't get caught up in the building, the zoning, the corporation, the parties, the conferences, and the whatever. When Howard Hughes came to Las Vegas, he looked around and he bought all the land. He bought so much land that they're still building on the land that Howard Hughes bought, and he's been dead 50 years. Summerlin, it's all Howard Hughes. Everything he did, he looked and he was like, well, if this is going to work, I'm just going to buy all the land because I don't know which casino will work. Right? The land's still here. The casinos are gone. The restaurants are gone. The politicians have come and gone. Every other good idea is gone. They built, you know, it used to be the Mirage was cool. Treasure Island was cool, the Bellagio was cool, the Wynn was cool, the Encore was cool. Here we are in some cool place. The land's still here. Buy the land. That's the alternative asset. And of course, that makes Bitcoin the best asset class. It's an entire ecosystem of products, services, companies, securities, derivatives, and professions. It's the global digital asset network. It's the internet of money. The securities, or Bitcoin-backed securities, are being issued worldwide, everywhere, at an accelerating rate. This year, right, you saw an explosion of spot ETFs in the US, but look at all the ETFs in Hong Kong. Look at all the ETFs in Europe. This is the beginning, right? You're going to see more and more and more. Every one of these companies is joining the ecosystem. They're securitizing. And it's not just this MicroStrategy security, options are security. There are options and derivatives on the securities. There are bonds on the securities. This is exploding. It'll continue. Every Bitcoin miner is a security. One day there'll be 1,000 securities or 10,000 securities, all backed by Bitcoin. Same with corporate treasuries. Bitcoin treasuries are growing rapidly, right? They keep this chart up every month. It's never declining. The chart's not ever decreasing. It only goes one way. Bitcoin is a capital ratchet. It's a one-way ratchet, right? Archimedes said, give me a lever long enough and a place to stand, and I can move the world. Bitcoin is the place to stand. The leverage is coming via all these securities, all these corporate treasuries, right? And the leverage is getting to be extreme. MicroStrategy showed you how you can actually generate performance with leverage, but we're just the first, we're not the only. You could do it 10,000 more times. The more leverage that gets put on this network, the bigger the network's going to get. You know, and a final few points, Bitcoin's the best bank. It's the it's a savings account for billions of people. No company, no currency, no country, no agenda. It's egalitarian, it's open. There is no second best bank. Bitcoin's the best path to peace. It's open, permissionless, transparent, decentralized. It's a fair and equitable way to settle differences between global counterparties that have conflicting interests. What's the second best way, right? The second best way maybe is we shoot each other up, right, with weapons, but this is the best way. There's no second best way. It's not just the path to peace, it's the path to prosperity, right? This is a global monetary network giving equal property rights to all economic classes in every nation. What's the second best way to do this? There's no second best way. Where are we now? Bitcoin's on a path of evolution from the idealist to the institutions. The first dozen years, it was the era of the idealists, the cypherpunks, you know, the libertarians, the entrepreneurs, the crypto cowboys, right? You know the story. It's been written about. People will probably make many more movies about it. What was 2020 to 2024? The crazy years, right? Starting with COVID, ending with the approval of the spot ETFs. It was the crazy years. What's going to happen to crypto? Who's going to control crypto? Will it be regulated, right? Will Bitcoin be banned? Will it be hacked? Will it be copied? We resolved that in those 4 years, and now we've come out of the crazy years. Now we're in the era of institutional adoption. Institutions, corporations, and investors are going to define the future of this network from 1 trillion to 100 trillion. And that's appropriate, right? From 2008 to 2020, the network went from 0 to 150 billion. And between 2020 and 2024, it went from the 150 billion to 1.4 trillion. So you can see how this is lining up. Of course, institutions and corporations are going to join this network. They have all the money. It's a monetary network, right? At the end of the day, you have a monetary network, then people with all the money, that run the money, that need the money, are going to join the network. So in summary, look, Bitcoin's the best idea. There's no more powerful idea than the digital transformation of capital. Right? What are you going to do with this? Well, you're going to improve your life, your family, your product, your service, your company, your institution, your government, or your world, right? Improve them all, right? It's pretty straightforward how you do it. You've got pure economic energy. It's not the solution to every problem in the world. It's just the solution to half the problems in the world. But every other problem in the world, you're going to need economic energy or economic power to solve it. And this is how you harness and channel that power. No force on earth can stop an idea whose time has come. This is an idea, its time has come, it's unstoppable. And so I'm going to end with the observation that Bitcoin is the best. The best what? The best. It's the best. It's the best idea. Once you found the best idea, everything else you can invest your time, which is scarce, or your energy, which is scarce. Everything you can invest your time and energy in is dilutive, everything else. So what do I suggest? I suggest study Bitcoin, buy Bitcoin, hold Bitcoin, build on Bitcoin, advocate Bitcoin, defend Bitcoin, and then you can enjoy Bitcoin. So Bitcoin, there is no second best. Thank you.
Fantastic. He stole my quote. I was actually going to say that no force on earth can stop an idea whose time has come. And Bitcoin's time is here. You know, Wall Street is coming on board. So many people are really excited about that. I don't think that the rush to these ETFs has really come from institutions yet. And that's really what the next panel is going to be focusing on, is Bitcoin and Wall Street. So I'm going to be introducing the speakers. This panel is going to be moderated by Shirish Jajodia. He is the Vice President of Treasury and Investor Relations at MicroStrategy. And the speakers will be Chris Kuiper, Director of Research for Fidelity Digital Assets, which provides enterprise-grade digital asset solutions for institutional investors. Chris contributes to and oversees the research creation process to provide leading Bitcoin education and resources to clients. If you haven't read his reports, they're fantastic. The next speaker is Alex Thorn, Head of Firm-Wide Research at Galaxy. He leads a team of researchers dedicated to understanding and unpacking developments in the Bitcoin and crypto ecosystem, producing insights for internal and external audiences. And the final speaker is Ryan Rasmussen. He's a senior research analyst at Bitwise Asset Management, one of the largest crypto index fund managers in the US. He focuses on the production of fundamental research and educational material about all aspects of crypto assets. So please give a round of applause to the next panel.
Hello, everyone, and good morning. Thanks for being with us today here. 2024, what a difference a year can make. We were here exactly 1 year ago, and Bitcoin was at $28,000. And a lot has happened over the last year. Now, Bitcoin is close to $60,000, even though down 15–20% from its recent peak, but still up over 100% from last year. And Bitcoin's quadrennial halving had just occurred. MicroStrategy now holds over 214,000 Bitcoin, which is more than 1% of all the Bitcoins that will ever be in circulation, currently worth close to $13 billion. And we have participation and support from big institutions like Fidelity, BlackRock, Galaxy, Bitwise, ARK. They all now support Bitcoin, and combined, all the spot Bitcoin ETFs hold over 800,000 Bitcoins. So it is said that arrival of spot Bitcoin ETFs is one of the biggest development on Wall Street in last 30 years. Today we have a fantastic panel of some of the top research professionals in the digital asset space with us here today. So my first question to the panel is, how are Wall Street and Bitcoin getting along together? How has the institutional acceptance and landscape evolved over the last 12 months? Chris, you want to begin?
Sure. I think how are they getting along? Quite well, obviously. It's, as you said, not only one of the most successful Bitcoin products out there, but one of the most successful ETF launches compared to all ETFs, whether you're looking at volumes, time to AUM, thresholds of different amounts, longest day streak of inflows into it. Absolute success. And I think even all of us here were blown away by it. I think we were expecting a hot start, but I don't think anyone was expecting the flows that came after it. And so when I look at this, I see, even though Bitcoin is absolutely unique, which of course you heard in the previous talk, there is no other thing like it. In terms of it as an investment, I think it's following the same track as a lot of other things. So I used to be an equity analyst. I covered REITs at one point. Real estate investment trusts, those weren't even a thing until the 90s. And now, of course, everyone has them in their portfolios. They're obviously a great diversifier, and that's, as they say in finance, the only free lunch. If you can add something that's not correlated to all the other things, you can get increase your risk-adjusted returns. And so I think it's following the same path. Well, just as REITs had to go through this process of financialization, Bitcoin is doing the same thing with these products. And so I think you're just going to see more and more of this, but I think it's going to take a lot longer to play out. But it's a slow burn. There's a lot of demand. A lot of these products still aren't on platform. They still have to go through the compliance. So to me, the bigger story is not the big splash that they made, but actually this long tail of 12, 18 months where I think you're just going to see this continual bid for these products over the next couple years.
I totally agree. I think it was a smash hit. It's probably one of the most successful financial products ever, these Bitcoin spot ETFs. And we were just talking about this backstage. All three of our firms have one of these. So collectively, we have experts in ETFs, both operating them, marketing them, and still, I think, shocked at the amount of volume. I think 13 billion in net inflows in a basically 2-month period, all without the main net new addressable market that I argue these are actually for, which is financial professionals who had no other way to buy Bitcoin. We can all buy Bitcoin. Michael Saylor and MicroStrategy and Shirish, they've been able to buy Bitcoin. They didn't need the ETF. I've been buying Bitcoin for years. I didn't need it. So we said, who is this for? And it's for professionals who can't go to a crypto exchange and buy it either for themselves or their end clients. There's not sub-accounts. It's not integrated into their advisor platform and technology. So the ETFs are powerful for that. And just to be clear, right, ETFs are a brilliant financial product separate from Bitcoin. You can wrap anything and have it trade through the most liquid, deepest capital market infrastructure in human history. I mean, you can put gold in it. You can put a basket of equities in it. You can put basically anything in it. You can put spot Bitcoin. So I was blown away too. The other thing I wanted to say is, like, when we think about Wall Street, because I worked at Fidelity, people used to say, oh, you work on Wall Street. I said, that's not fair. We work on Summer Street in Boston. It's very different. But when I think of like lower Manhattan active trading Wall Street, I think of hedge funds primarily and global macro traders. And they were already very interested in Bitcoin for its fundamental properties and for its trading characteristics. It's relatively uncorrelated and all those things. But they're becoming much more interested. It's on every screen when I talk to people that literally trade rates and fixed income securities. They also watch Bitcoin. When gold is up, they say, wow, gold is up. What did Bitcoin do today? That was happening before the ETF, and it's only accelerating. So I think it will continue to accelerate over time, that Bitcoin is a macro asset.
Yeah, I completely agree with what Chris and Alex have said here. These spot Bitcoin ETF launches were the most successful ETF launches of all time. ETFs have been around for 25, 30 years, and we haven't seen anything like this in its history. And I think, it just goes to show that there was a lot of demand for Bitcoin that could have accessed the markets in a lot of ways before, but didn't. I think, now Wall Street has that regulatory stamp of approval on spot Bitcoin ETFs, through spot Bitcoin ETFs on Bitcoin as an asset, and that allows them to, de-risk from a career perspective a little bit and say, look, we want to understand this asset, we want to allocate to this in our portfolios or on behalf of clients, and it also allows, retail traders, people that are investing in Bitcoin through their retirement accounts to also feel the same way, like, look, maybe this won't be regulated into non-existence like the mainstream media likes to say, or maybe Bitcoin, isn't going to die like the mainstream media has said hundreds of times before. And so I think Wall Street and Bitcoin are really getting along well, and it's really impressive to see the demand that we've had so far. But I agree that we're only seeing the tip of the iceberg, and I think there's a lot more demand underneath the surface that will unlock in the longer term future as we get more approvals and we have more institutional investors coming around. So it's really exciting. I think spot Bitcoin ETFs are really Bitcoin's IPO moment, and it's really early in Bitcoin's life cycle still, and for institutional investors to gain adoption and Wall Street to adopt Bitcoin. So it's really exciting to see what they're doing now with Bitcoin, and the conversations we're having with Wall Street are definitely more positive than they were this time last year or the year before.
Do you have any examples of how the conversations were in the past and how they have evolved now?
Sure. Yeah. So at Bitwise we have a large sales team that goes around, and they're dialing for dollars and knocking on the door of financial advisors and RIAs and institutional investors all around the U.S., trying to explain to them why Bitcoin belongs in a portfolio or help them on their educational journey. And I think a year ago, beginning of 2023, particularly the last 6 months of 2022, those conversations were really hard to even get started. We were, ignored by a lot of financial advisors, ignored by a lot of investors who really thought that Bitcoin was going to go away or was dead. And so what we've seen in the last 12 months or so, really since BlackRock applied for spot Bitcoin ETFs, and we started to see the markets turn around and a lot of optimism for these ETFs to be approved, we've seen a lot of inbound calls into our organization looking to get educated on Bitcoin, trying to understand how it fits into a portfolio, how they can access it, how it's custodied by ETFs. And so those conversations went from us knocking on doors and having the door slammed in our face to institutions knocking on our door trying to understand how they could get access to ETFs. So it's been a really great shift, and those allocations that were less than 1% for some advisors who were pro-Bitcoin before the ETFs are now 3% or 5%, or in some cases 10% of the portfolio. So I think we're just continuing to ramp up over time, and it's great to see.
I have one too. We was talking to like a top 15 asset manager, like by AUM in 21, and we gave a big presentation, and they were like, "That was a great presentation. We really do think Bitcoin is digital gold." And we were like, "Sick! That's great. That's what we were saying." And they're like, "Yeah, but we don't invest in gold, so we're not going to invest in Bitcoin." They're like, "You guys did great." And then fast forward now 3 years later, the macro picture has also dramatically changed since then. I think people may not be aware, but what used to be something that only gold bugs talked about, the unsustainable national debt, the federal deficit, the strength of the dollar or relative weakness of the dollar, other currencies. Sure, Ray Dalio has been talking about that. Stan Druckenmiller has been talking about that. But now everyone is talking about that. The unsustainable nature of the government's debt situation, not just the U.S. government, I mean, most governments, is a huge, huge issue now. Maybe it's come to the fore because rates are so high and so it's pressuring. This is something that everyone is concerned about. Jamie Dimon, no fan of Bitcoin, but also the big CEO of the world's largest bank, he has been saying that it's unsustainable and something has to give. Federal Reserve Chairman Jay Powell, who has been criticized for a long time for never discussing the fiscal side of the equation, which we understand the Fed doesn't want to be seen as political and pressuring the executive branch, right? They're supposed to just stay in their lane. He said on 60 Minutes, they said, "How does this get solved?" He's like, "I don't know. It's not tenable," right? And so that has caused, when I think back to this asset manager, they are now looking at things they did not invest in 2021, not just gold, but Bitcoin again, but also they kind of had a team to look at Bitcoin and crypto assets in 21. Then the market fell out and they were like, well, let's focus on other stuff. And now they're like, oh no, we're scrambling to start doing the work again. So it is still slow going.
Yes, on the topic of gold's comparison, not many people are familiar, but if you look at 1970s gold price fluctuations, I saw a chart from Morgan Stanley that showed the correlation, and gold was the Bitcoin of 1970s, and it used to fluctuate similarly with similar type of volatility. And just, as the asset class matures, it kind of stabilizes. So that's one of the things on the comparison. So what are the type of institutions you are talking to? Who are these institutions, and what are the type of conversations you're having? So, and any insights on the nature of the companies or corporate or institutions that are looking into taking positions or taking position now?
Sure. Yeah, we have our own clients, institutional clients that we have our direct business with. But we also do a institutional survey every year at Fidelity Digital Assets, and you can find this on our website for free. But it's really interesting. We've done the 5th year in a row now, and consistently what you see is a very high number, 80+% of all of those surveyed, and again, these aren't our clients, it's over 1,000 people worldwide, say they own or are invested in digital assets. And then you say, well, how come if they're all here, if the institutions are here, why are we still a $1-2 trillion asset class? And you dig into the numbers and you realize it's kind of a big barbell story where the high numbers, 80+%, are high net worth individuals, family offices, multifamily offices. And then on the other end, at low single digit adoption, are the big gorillas, the big money, the foundations, pensions, endowments, those sorts of things. And so really, I think it's just a matter of time and also kind of bureaucracy. The individuals, the high net worths, the family offices, it's usually one person leading the charge, we've found. They've come onto the thesis, they are well informed on it, and they say we want to make this a core position, and they can just go and do it. And then of course, all these other institutions have a board, they have a lot more red tape. And so that's why the ETPs, the exchange trade products, they're the biggest story here, because now before where they would have to carve out all these special exceptions, if they're already set up compliance-wise to buy a stock or an ETF, they can do so. So I think that's one of the biggest changes, and we're starting to see a little uptick in the number of the big money there. And so I think that's the story we're watching going forward, and we'll continue to do the survey and see where we land. And obviously it'll just be shown in the price as well, in the market cap.
Yeah, so a lot of this adoption so far has been driven by like champions in the respective companies and driving the adoption. And now I think the message is coming more broadly that the companies, the managements need to look into it, and they cannot just stay silent and stay on the side. They need to look into it. So what are the type of companies that are lagging behind, you feel like, that are still staying on the sidelines and not participating? Or like, what are the kind of hurdles that are keeping them away?
Yeah, well, I'll just quickly say I mentioned the foundations, pensions, endowments. Those are the ones that are lagging. The survey also covers what's your biggest hurdle.
Yeah.
And number one is always volatility, or at least near the top. And this one, I think it's just, not to be hard on him, but a convenient excuse. And so if you look at volatility, I'm sure we'll talk about this more, all these funds, they own things like Netflix and we just ran a study. Bitcoin is no more volatile than a lot of mega cap stocks, Tesla, even Meta, just to name some as examples. And so if they own those, but they don't own Bitcoin, I don't really see that making sense. It's not about the volatility. I think it's just an excuse. And if it's volatility, if you're a professional money manager, well, then the answer is risk management, position sizing. You should know how to handle this. And then, of course, there's all the other things, fear of regulation, some things still about the security. But what I've noticed over the years is the excuses are getting more and more sophisticated, if you will. Like there's a little bit more there, whereas before they were just kind of the same old tropes of bad for the environment, it's criminal money, those sorts of things. So we've made progress, but we still got a little ways to go.
Yeah, and the 13 Fs have started to come out, not fully out yet, middle of May. So how is the breakdown, like how much of this demand so far in the ETPs, like institutional versus retail? Ryan, I think you have done some work on this. Would you like to elaborate?
Yeah. So the 13 Fs, which are filed by wealth managers that manage over 100 million in assets and show what they're invested in, and those have started to trickle out. I think May 15th is the final deadline. But what's been interesting to see there, and I think what is surprising a lot of people, is that there aren't these gigantic firms that have come out and said that they're buying Bitcoin. It's really the littler firms, the smaller financial advisors or RIAs that can move a little bit faster, and retail investors that can, they're self-directed investors and they can buy whatever they want as long as it's on the platform they use. They're the investors in these spot Bitcoin ETFs today. I like to use the analogy of, the bigger the firm, the bigger the boat, the slower it's going to move to adopt these things. And you have these more dynamic and more agile, wealth managers who are generally the first adopters to new assets like this and newly listed assets like this. And so, we speak to a range of wealth managers, from independent financial advisors to large RIAs to pensions. And I think we're starting to see a tipping point that that Chris kind of mentioned, where before you might have one person in the room who is a fan of Bitcoin or at least has studied Bitcoin, but the others in the room are just anti-Bitcoin. They haven't spent time learning about it. They don't believe it belongs in a portfolio. They think it's going to zero or it's going to be regulated away. And now we're seeing maybe 2 or 3 people in the room, maybe 25 to 50% of the room being educated on Bitcoin, believing in Bitcoin, fighting for Bitcoin to be in these portfolios, and they're just having to work to get the investment committee or the risk managers at the firm to really start believing in Bitcoin, and that's when we'll start to see that corner turn. But for now, it's RIAs that can move fast. There's financial advisors who are independent who can move somewhat fast, and then there's self-directed retail investors. And I think a lot of the demand has come from self-directed retail investors in the first 3 months of these trading, and that's really impressive given the growth of these funds that we talked about and the amount of assets that have flown into them. And it's also very optimistic for the outlook of how large these funds can grow. And it's not just about the size of the fund, it's about the impact that inflows into these funds have on the price of Bitcoin. And I think that we're sitting in a really optimistic place, despite the fact that the price fell 20% over the past week or so.
Yeah, can I just point out, too, that if you look at the prior bull runs, like I think 2017 had 22% or more drawdowns during a run from $1,000 to $20,000. 2021 from December 2020 to like April 2021 had something like 8 or 10, 15 to 20% draw. It's actually totally normal in a bull run. That's what they say, climbing the wall of worry. I would say, to the question specifically, I absolutely agree. I think we, like I said before, we looked at wealth managers and financial advisors as the obvious target market for this product, and other institutions that can't easily, go on Cash App and buy Bitcoin. And they take a while to turn on. Many of them aren't even allowed to consider adding an asset to their platform for 90 days. They need a seasoning period, and then they got to do a bunch of diligence. So we always knew that. So then in the first 40 days to have what we had, this just record inflows, we assume and know that this is mostly on the brokerage platforms. It's on Fidelity.com and Schwab and TD, where anyone that has an account can basically buy any ETP or security, and that is very bullish because that market that we sized, and I've heard different estimates. James Seyfarth and Eric Balchunas have a slightly different estimate, but we peg the U.S. wealth management and financial advisor market at $40 trillion in AUM. It's between basically bank platforms and broker dealers. Some of them may allow, on an unsolicited basis today, a client, if you call up your financial advisor and you pester them enough, they might let you at small size buy the ETPs. The vast majority won't allow you, and none of them are currently actually suggesting it or offering it. That's what's happening now. So we got 13 billion in net inflows, and I don't know, where did we start the year? Like in the 40K range for Bitcoin price, got to 73.8 and 13 billion without any of that market. So I think there's a lot to come for that. And I would also just say, in terms of the types, do I feel bad? Someone was like, oh my gosh, you should have been telling us to buy Bitcoin earlier. I'm like, do you listen to what we say? I've been saying to buy it for years, right? And I'm like, I was the one, and many of, I'm sure all 3 of us, were saying buy it at 16.5 at the start of last year. And they didn't, and the institutions were still, some of them were literally burned from venture investments that went poorly in the crypto ecosystem, or rate hikes causing some turmoil in their portfolio generally, and so they had gone away. And then Silicon Valley Bank collapses, Bitcoin rises a lot on that event in March of last year, and then BlackRock files for their ETF, and then we all and everyone else followed suit, immediately refiling, and then Grayscale in August wins this court case that, for close watchers, and of course it ended up being true, we all said, wow, this I think might make the ETPs inevitable. That was when they were like, let me pick up the phone and call, let me restart the conversations. And then that was at 28K last August, and they're like, let me poke around. I guess Bitcoin isn't dead. Then at 35K in October, they're like, we really need to start working on this again. And then at 50K, they're like, why haven't we gotten into this yet? And now they're basically, a lot of them are literally racing to go through whether it's onboarding or diligence on the asset itself or the ETPs. They're not deterred by $57,000 Bitcoin.
And so those people may find it cheap now, off 20% from the high.
Honestly, yeah, the institutional investors are typically relatively savvy investors. They'd prefer not to buy right at like the all-time high in general.
Yeah, I would just add to that. You know, you have these wealth managers, a lot of these financial advisors, right? They're having to answer to clients when Bitcoin doubles, triples in a year. Why don't I have an allocation of this in my portfolio? I'm paying you to manage my investments, yet you missed one of the best performing assets ever, and especially over the past decade. And how did you do that? And so it's either because they ignored Bitcoin or they couldn't access it. Now a lot of them can access it, and now it's impossible for them to ignore it. And it's really a business risk for them to not do their due diligence and learn about Bitcoin, because if a client's knocking on their door saying, hey, I want to invest in Bitcoin, and they're saying, no, we're not going to let you do that, they're just going to go find another financial advisor, and that advisor is going to lose business, they're going to lose revenue. And so there really is this grassroots demand that helps drive Wall Street's adoption, and that comes from clients and individuals who ultimately are paying these wealth managers to grow their assets. And if they're not investing in one of the best performing assets that we've ever seen, then they're not doing their job, and they don't deserve to be paid for it, is the view of the clients. And so I think that's going to help push forward adoption and accelerate it in a way we haven't seen before.
So on the topic of price, Bitcoin's halving just happened 2 weeks ago. It was the 4th halving in the history of Bitcoin. It's a big milestone event in the protocol's journey. How do you expect this halving to impact the supply-demand economics? And prior halvings have shown the price to rise dramatically after 6 to 12 months after the halving. So how do you expect this halving to behave? And I'm sure you've done a lot of research on this topic. So can you elaborate like the demand-supply economics, and how do you expect the price to behave?
Yeah,
would it be different? And would it be different than the prior cycles?
Right. From my traditional finance background, you're supposed to never say the 4 most dangerous words in finance. This time is different. However, this time is a little bit different in that we hit a new all-time high before the halving. That's never been done. And of course, a lot of that was on the anticipation of the approval of exchange-traded products. So that was definitely demand-driven. But I'm still in the camp. A lot of people look at that and they say, see, it's already getting priced in. More people are aware of it. I'm personally still in the camp that you cannot fully price in the halving for 2 reasons. Number one, it's basic supply and demand at its core, Econ 101. If you're cutting the supply, the new incoming supply in half, it's the equivalent of some whale coming in every day and buying 450 coins regardless of price, right? So that has to have an effect. Now, whether or not that is in the short term fulfilled by other people, and that's what we're seeing right now, you can see in some of the on-chain metrics that these long-term holders, this time is different. We've never had 70% of all Bitcoin hadn't been moved in over a year going into the halving. That was an all-time high. We've never had that before. And now with the bull run of last year and then coming into this year, we're seeing some of those long-term holders move their coins, so probably sell. So they're fulfilling some of that supply that's been cut. But over the long term, I don't think you can front-run that amount of supply, that no one has that much capital. And the other reason I think it can't fully be priced in is we have a pretty big publicly traded miner market now. And so as a thought experiment, if the price of Bitcoin went to $1 million tomorrow, the publicly traded miners, their margins would be absolutely massive. So if you're a capital allocator, are you going to say, oh, I want exposure to Bitcoin, I'm going to go buy some spot Bitcoin? Or are you going to say, wait a minute, these miners their profit margins are huge, I'm going to allocate to that? And so there's going to be kind of an ebb and flow and an equilibrium between these two things. And so, of course, the problem, though, is we don't have a way to separate which is driving it, supply or demand. And the demand side is, of course, absolutely huge this time around with the exchange-traded products. And so we can't disentangle them. And then we also don't have a counterfactual every 4 years as to whether or not this is being driven by liquidity. So far with each halving, we've had these liquidity cycles where the Fed's printing or easing more. We have an election year perhaps, and we might get that again this year. And so we still might not have our answer of which is the bigger driver here. But to me, I don't think over the long term, anything can happen in 6, 12 months, but over the long term, over the next couple of years here, I don't think it's fully priced in, and it's still going to have an effect.
Yeah, I think it's really a story of supply and demand. If you boil it down to the most simple point, it's, is there rising demand? Is there falling supply? With the halving, we have new supply falling in half. We clearly have this tidal wave of demand coming into the market, and I think, which it sounds like we all agree on, is yet to be seen because of all these platform approvals and these committee meetings that happen, months, even years out from when these assets are approved. And so you have all of this incoming demand, you have this reduction in new supply, and that's great for the price, but the halving is also this great marketing tool for Bitcoin that comes around every 4 years and really brings attention back to the core focus of Bitcoin, which is it's an asset with a hard cap, limited supply, and we know what the schedule of that supply is going to be until it reaches that hard cap. And so, yes, it's great that the new supply is falling in half. That's definitely, a impact on the market because you have less selling pressure coming. It's great that we have increased demand, but it's also great that the world continues to wake up every 4 years to what Bitcoin is, its fundamental design, how it's different from traditional currencies, and why it does demand attention from investors.
I just want to add on your last point, Ryan, too. I think I totally agree about the supply demand, and obviously from a supply standpoint, the potential impact of it halves every 4 years. So, when 50 coins are being produced per block prior to 2012, and it halves to 25, that's in absolute terms a much bigger impact. I think somebody put out a good chart, maybe not someone on the stage, and so not us, so I'm not going to give them too much credit, but if you look at the actual supply in dollar value of Bitcoin that's produced every day, or the reduction compared to the daily float of 10 to 30 billion of the asset, it's a tiny percentage, right? So it's not, so I agree with this point, but yet it still does matter. But to your point, the second part, the marketing point and the uniqueness of Bitcoin, there is no asset with as credibly neutral and transparent and predictable a supply as Bitcoin in the world, in the history probably of humanity. It's cryptographically provably scarce and gets scarcer every 4 years. And I think that learning about the halving is one of the best ways to learn about Bitcoin in general. And that happens. And now you've got Fidelity and Bitwise and Galaxy, but also BlackRock and big financial advisor platforms, Invesco, who we partner. I mean, big, giant asset managers putting out pieces about the halving and about how Bitcoin is unique and different. So as a quadrennial marketing event, I think it will always matter.
Great. So switching to the mechanics of the ETPs. I think a lot of people are very curious about, how does the process work in a life cycle of like a day in ETF? You see some demand coming, people hit buy button on BitB or FBTC or anywhere. So how does it work? Because there's demand coming, and then do you buy it all together? And how does that work during the day? And how do the APs enable the create and redeem process in the background? Would you like to elaborate? I think Ryan. Yeah.
Sure. Yeah. So there's a lot that goes into the weeds of how these ETFs work. Fundamentally speaking, when a dollar comes into the ETFs, they go out and buy $1 of Bitcoin. Now there's, again, things behind the scenes that are happening. You have kind of three parties at play. You have the ETF issuer, like a Bitwise or Fidelity, and sitting in the middle. And then you have APs, which are authorized participants that are regulated broker-dealers, large financial institutions. They strike agreements with ETF issuers. They're the only ones that can actually receive shares of the ETF directly from the issuer. And then you have OTC desks, which are on the other side of the arrangement, who go out and buy and sell the Bitcoin and kind of deliver it to the ETF issuer on the other side. So, a typical flow on any given day, these ETFs trade any day that the stock exchange is open. And if there's $1 billion worth of demand coming into the ETFs, the authorized participants would contact the ETF issuer and say, hey, I want to buy $1 billion worth of shares of the ETF. And then they would send the cash for those shares to a cash custodian like BNY Mellon. And on the flip side, the ETF issuer would go out to the OTC desks, and us at Bitwise, we partner with a variety of the largest OTC desks to get the best quote you can get on Bitcoin for that purchase. We find the best quote, we enter an agreement to buy Bitcoin, $1 billion worth of Bitcoin from them. Once that Bitcoin is delivered to the crypto custodian, which for most of the ETFs is Coinbase, which generally takes about a day to settle. Once the ETF takes economic ownership of that Bitcoin when it's delivered to the crypto custodian, you let the cash custodian know that you've received the Bitcoin. They release the shares, to the authorized participant, and the ETF issuer receives the cash and settles the trade with the OTC desk. So there's these moving parts that are happening, but fundamentally this works just like every other ETF works. This isn't something new for Bitcoin. There's a bit of a nuance under the weeds, whether you have in-kind creations or cash creations. The current SEC regime said that they only wanted cash creations, which means that the authorized participant has to deliver cash for those shares. If they allowed in-kind creations and redemptions, then they could just go out and buy Bitcoin and deliver that directly to the ETF issuer. So it creates a little bit of inefficiency and a little bit more complexity with this cash redemptions and creations process. But ultimately, this is how ETFs work, and that what I described was inflows of assets into the funds, but the same process would unfold in the reverse order when flows were, if they're flowing out of the funds. So that's the process. Hopefully, that helps paint a picture of how it works. And
so, if there's $1 billion of buy order, is it done during the market hours? Is it concentrated towards the close of the day, or how does it work? And is it only on the weekdays? So there can be some predictable patterns from there. But is there anything out there on how does it work? Means if there's $1 billion demand, it can move the markets also, and there has to be enough liquidity. So how do you handle those tensions?
Yeah, it's a good question. So working with these OTC desks like Falcon X, for example, or Jane Street, right? They specialize in trading assets and getting the best pricing for those assets and not moving markets too much with large liquidity orders, buy and sell orders. And so they're really focused on that element of it. But certainly, there's not too long of a delay between when those assets come in and when the Bitcoin's purchased. That's why, we certainly see the price of Bitcoin moving. Oftentimes, I think there's been a high correlation between market hours of the stock exchange and the price, certain volume around Bitcoin since these ETFs launched. And so it can impact the market. That's the nature of the beast. These are basically funnels for dollars into Bitcoin. And if those funnels have a lot of dollars coming in, that's going to ultimately push the price up. But OTC desks are very sophisticated. They trade all kinds of assets. Jane Street doesn't just trade Bitcoin. They trade all kinds of financial instruments. And so they really specialize in doing it in a way where they get the best pricing for the customers and they don't move markets too much intentionally.
Alex, you have a lot of experience with APs.
Yeah, Galaxy, I think, is the largest OTC crypto derivatives desk. I'm quite certain that we're also one of the biggest spot OTC desks, and we trade with everyone from endowments and pensions, although like we've talked about, they're slow to get back in the saddle, hedge funds, high net worths, other institutions, and ETFs, right? The ETFs, to Ryan's point, they're not logging into a Coinbase account and hitting market buy when they need Bitcoin, right? They have much more sophisticated arrangements. And one thing I'll point out is that whether it's the APs delivering the dollars or the desk talking with the issuers about, and the issuers asking, saying, look, there's going to be a $200 or $300 million create today, let's say. We can hedge that, right? So if there's a delay between when the demand occurs and when the coins can be delivered, someone can own that risk and someone can actually make money holding that risk if they want, right? So if Bitwise or Invesco Galaxy or Fidelity comes into an OTC desk and says, we need X amount of Bitcoin, we could just deliver it to them and take a equally short exposure to Delta, hedge our position while we wait for them to send us the cash and blah, blah, blah. So the market, in terms of outside of the ETFs, but the actual just spot and derivatives markets and infrastructure in Bitcoin trading has gotten very sophisticated. So we have plenty of tools. And I would say that has smoothed out a lot of this impact. Typically, the risk has now, when we do that, even though the coins haven't been delivered or bought yet or delivered to the ETF, or the cash hasn't come from the APs and settled, the delta risk has now been dispersed into the market typically by then. So it's not too bad. But there is a fixing window, usually between 3 and 4 p.m., when actually all of this effectively happens. But if you know at 10 a.m. that demand today is huge, this is a big catalyst or whatever, that risk will be getting absorbed by the participants already in the form of agreements to deliver spot, but hedged in other ways. So the market is sophisticated enough to bear even large inflows or outflows at this point.
So this authorized participant, Jamie Dimon has a view on Bitcoin, but JP Morgan is one of the big authorized participants, including you have others, Goldman, Citi, Citadel, and Jane Street. So what do you think? When do these big banks officially start to custody Bitcoin and kind of change the tone overall?
Well, I would say, first of all, watch what they do and not what they say. Jamie Dimon has said a lot of very stupid things about Bitcoin over the years. He really has. So one of the things that lets JP be a authorized participant is the fact that they have cash, create, and redeem. And this is, in the US, there's a variety of very silly things that have been done by regulators or not done relating to Bitcoin. Two of them are directly relevant here. One, the SEC has the SEC and FINRA, who of course the SEC delegates plenty of regulatory authority to that SRO, they have neglected and in some cases prohibited broker-dealers from touching crypto assets. The SEC specifically claims that you need a separate license, a special purpose broker-dealer license, to hold crypto asset securities. But of course, Bitcoin isn't a crypto asset security anyway. But this lack of, in some cases, lack of clarity, in some cases, an actual prohibition means that broker-dealers can't actually touch crypto and Bitcoin. And so those, many of the firms that, like our OTC desk, even Coinbase owns a broker-dealer. I remember everyone has tried to come in to the regulators and say, what do we have to do for you to let us do this in the way that we would how do we make Bitcoin flow through the pipes that already exist? And they've really not done the work, or like I said, in some cases prohibited that from happening. So Jane Street, Coinbase, they all have a broker-dealer, and they're having to do the Bitcoin activity outside the broker-dealer. The big banks, first of all, are broker-dealers. All of them have broker-dealers, so that can't touch the Bitcoin. Then a whole sort of separate set of very stupid things that regulators have done around banks touching digital assets of any kind basically makes it impossible for banks to custody digital assets and Bitcoin. Specifically, Staff Accounting Bulletin 121, which is a non-binding guidance letter put out by part of the SEC. Actually, it's guidance for the accounting firms that oversee publicly traded companies. But, well, if you tell the big four accountants that they should they should tell their clients to treat digital assets this way, it does effectively become a rule on the public companies, and many banks are public companies. And what this thing says is that that you have to carry custodied Bitcoin on your balance sheet. State Street, I think, is the world's largest custodial bank, something like, I don't know, trillions of dollars on behalf of their depositors and clients. That's not on their balance sheet. If State Street goes into bankruptcy, I'm not saying they are, then those assets are not part of the bankruptcy, right? Those are owned by the depositors. They're separate. They don't carry them on their balance sheet. This rule requires that the Bitcoin be carried on the bank's balance sheet in the case of a publicly traded bank, which means that it now becomes subject to bank capital requirement rules. So for every $1 you hold in Bitcoin, you will have to hold $1 in extra cash also. So you can imagine, okay, if we're going to hold $12 of Bitcoin, okay, that's not too bad. But what if you're an institution with $1 billion or $13 billion of Bitcoin? The bank's not going to, where are they going to get the $13 billion in cash to put next to their Bitcoin? So they effectively don't do it, right? It would be totally uneconomical for them to do it. The downstream effect is that everyone is custodying with state chartered trusts. And at this point, to be clear, the custodians have become amazing. But in general, you've got for millennia, maybe not millennia, for hundreds of years, the place that people custody assets is at regulated depository trusts and banks. And for some dumb reason, they won't let Bitcoin be custodied there. So these will ease, I think, over time, because also it just doesn't make any sense. That's just really quite stupid. Why not let them do it? Many have tried, none can really do it. And then I would also say there has been pressure from the banking-specific regulators, so the FDIC, the OCC, the Fed. They're all concerned about what would happen if banks held Bitcoin. I think the evidence is becoming overwhelming that nothing bad and plenty of good could come from it, but that's why.
Any sense on timeline of when this changes? We never know.
A different regulatory regime would probably take a different stance. So in some cases, that's elections, and or terms that expire. But also, I will say the U.S. House is taking action on SAB 121. By the way, you know who hates that regulation the most? The banks. They want to custody it. JP wants to be an authorized participant, and I bet you if they were told that they could custody it, they probably would, right? Like in the end of the day, if you have a product that everyone around the world in increasing numbers desperately wants for whatever reason, and Bitcoin certainly is that, and you're in the business of offering and holding such products, then of course you want Bitcoin.
So in absence of banks custodying, currently all the ETPs are custodying their Bitcoins, predominantly with Coinbase and maybe some others. So how do you think about the risk of centralization here?
Yeah, there's definitely some concern about seeing all of this flow to one custodian. I'm not sure it stays that way in the future. If you're a provider, you're going to want to diversify to spread your risk. So I personally think this is just maybe what emerged straight out of the gate to get these things launched, and so we'll see how it goes. But the idea too of these companies co-opting or having some kind of pressure, I don't find very interesting because, again, going back to what makes Bitcoin unique, the token holders have no say or power over the network. Someone holding $1 billion of Bitcoin has no more power than me holding $10 of Bitcoin, right? And so I think that part's a little bit overblown. There's certainly some things to maybe be aware of just from like a risk perspective, or if somebody screws this up, that's obviously very bad. It's going to be ripple through and people will lose a lot of trust. But that's why it's so important to get custody right. And Fidelity Digital Assets, that's our main product, our bread and butter. It's a boring business until it's not. And so you hope it's always a boring business. And I don't think that there is that much of a concern, also because Bitcoin's so unique that there is the opportunity to self-custody at any time. So even if someone has their coins with someone, the fact that they can either sell it and then use it to buy it or just directly withdraw off an exchange keeps all these participants a lot more on their feet and honest, in my opinion. Just having that option there, I think, is really interesting and something we've never seen before with any other asset.
Yeah, I mean, I think Chris's point about proof of work coins versus a proof of stake coin, right? I mean, if you hold a large amount of coins, a percentage of the circulating supply in a proof of stake network, you literally have control over the network, right? The validating network is based on how much capital you own, not how much work you conduct. So that is a bigger deal. And you see this as a debate and constant debate and question and potentially problem in networks like Ethereum, which do have questions around this because who controls the capital literally does control consensus, where in Bitcoin it's more complicated. So I agree, the risk is more about safety. And I would also say, if you believe in, first of all, custody has become very sophisticated. So I think the risk is actually very low at this point that any of the major custodians, including Fidelity, would have any issue with this. It's managing private key material. There's set sort of standards for how everyone basically does it that's highly secure. So I don't think there's a real risk of loss. There's some technically down there, a little tiny, but it's really gotten a lot smaller. But if you believe that Bitcoin will be widely adopted or owned, then you should, let's say it even in the most aggressive utopian outcome where it's like as prolific and ubiquitous as the dollar or major fiat currencies, it's going to be everywhere. It's going, you have dollars in your fintech app, in your bank account, in your pocket, right, in your brokerage account, in your money market fund. You have cash-like instruments like treasuries, and right, there's so many versions of dollars. There's going to similarly, in my view, be so many versions of Bitcoin, and some of them will be custodied, others will be self-custodied, others will be perhaps at banks. I mean, one of the earliest adopters, Hal Finney, the recipient of the first Bitcoin transaction, wrote a blog post mere months after Bitcoin launched saying that there would be a very good reason for Bitcoin banks to exist. So I think it's not all going to be self-custodied on a hardware wallet in my basement or in my self-custodied node. But it is unique in that you can do that, to Chris's point, but it is going to be everywhere. It's going to be at institutions. Let's hope it's eventually at banks. I think this, in the end, makes it much more entrenched and decentralized if it can be spread out to the systems and architecture of the world.
Yeah, I think, to Alex's point, the experience for self-custodying Bitcoin is not great. And most investors, especially retirees investing in a little bit in Bitcoin, or just everyday investors or wealth management platforms who don't want to take on the risk of having to secure and custody Bitcoin on behalf of their clients. Like, the user experience for self-custody isn't great. So there will always be people and proponents of self-custody. I'm one of them. But there will also always be a demand for a more user-friendly way to access Bitcoin. That's why using a third-party regulated custodian that's in good standing, that holds the assets, segregated from the business's assets, is important, and it's why a lot of the spot Bitcoin ETFs, or most of the spot Bitcoin ETFs, chose Coinbase, because it's a publicly traded company in the US. It's regulated. It has a track record of custodying assets on behalf of clients for many, many years without any issue. And so as that continues, you have this kind of Lindy effect of using third-party custodians taking place. And I think the investors in a spot Bitcoin ETF are generally not going to be the self-custody maxis, and that's okay. There's going to be a broad spectrum of investors in Bitcoin and ways to store that Bitcoin, to Alex's point. It could be in a mobile wallet. It could be in cold storage, hot storage on your web browser wallet. There's all these different ways to do it. And so custody through a third-party regulated custodian is just one of those ways. And because of the legal structure and the regulatory burden of ETPs, you have to use a third-party regulated custodian. There is no, the risk of self-custody is too high to go a different route.
Great. So I want to talk a little bit forward-looking from here on. And volatility is something that still scares a lot of people, individuals, institutions, a lot of people. And we have gone through predictable cycles of 4 years of volatility in Bitcoin's history. So now, with ETF's presence, how do we think the volatility will it get smoothened out over time? Because it's easy for people to get access to Bitcoin through ETFs now, and there can be a lot of inflows. But as we have seen in the last few days, it can reverse also very quickly, where it can turn into outflows also very quickly. So does the volatility get smoothened out, or will it increase the volatility because it's easy to get and easy to get out?
I think it depends on the time frame you're talking about. So we just put a piece on our website just this week, so you can see the charts I'm talking about here. But zoom out, big picture, Bitcoin started at a 200 vol, annual vol level. And it's done a lot of this, but if you draw a regression line through it, it's continually sloped down. And I think that's just a product of it maturing and becoming a multi-trillion-dollar asset class. So you mentioned gold earlier doing the same thing. And so we actually have a chart in this report showing that once the dollar was depegged from gold and people could legally own it again, so until the 70s, people actually weren't allowed to own it as an investment, it had to go through a price discovery process, and the volatility went way up. And then it kind of came back down, and then it actually went up again in 08 as it kind of went through a second price discovery process. And I think Bitcoin's following the same thing. It's going through this price discovery process where the volatility is part of it. You can't have volatility without the returns. Parker Lewis, a famous Bitcoin educator, I love his line where he says, Bitcoin is volatile because it's scarce, but it's also valuable because it's scarce. And so you can't have one without the other. You can't take out the volatility without taking out its core value proposition. And so investors should embrace volatility. In our report, we actually talk about this. We show things like Sharpe ratio and Sortino ratio of Bitcoin versus S&P. Sure, it's more volatile, but you're more than compensated for it. You have a higher Sharpe ratio. And Sortino ratio, which is only looking at the downside, which is what most investors, especially retail investors or individuals, care about, that kind of stomach ulcer index of drops. Yeah, it goes through big drops, but again, you're more than compensated for it, and it's actually asymmetrically skewed, the returns, where there's more positive volatility. So it's experiencing volatility because it's ripping to the upside versus its volatility is going up because it's dropping. And that's one thing that makes Bitcoin very, very unique, this asymmetric return. So short term, I do think the exchange trade products could add to volatility because you've got a lot of, obviously, retail momentum kind of trading in and out of this. But long term, this is just another milestone on its road to financialization. And then you're going to get the derivatives and the futures. And a lot of academic research shows that once you have those markets, that also smooths it out because you're adding more participants, you're adding more ways to express information about the market. So again, long term, I expect that regression slope to continue going down for Bitcoin.
Great. And so looking forward from here, medium term, 12 to 18 months out, and longer term, base bull case, like how do you explain what's the outlook for Bitcoin in your opinion, given all the institution demands and all the dynamics that we are seeing? How's the outlook?
Yeah, I mean, I think we're very optimistic on the outlook. We've talked about a few of the dynamics that are at play here. There's a falling new supply going forward, and already a relatively limited remaining supply until Bitcoin hits its hard cap. There's increasing demand that will only continue to increase as more and more institutional investors and wealth managers who manage something like $40 trillion of wealth in America, as they start to access Bitcoin, add it to model portfolios that they just blindly allocate to when they do quarterly rebalancing, as they start to add it to their more aggressive portfolios, which maybe have, instead of a 1% allocation, a 3% or a 5% allocation. So there's this rising demand, there's this limited supply, and then there's this de-risking that's happened with the spot Bitcoin ETPs and with Bitcoin recovering from the last bear market, where I think a lot of investors around the world are looking at this as an asset that really is here for the long term. And I think that leaves us optimistic for the future of Bitcoin. I think we were just running a very simple market penetration study that said if Bitcoin penetrated 50% of the gold market, which is something like a $16 trillion market today, then the price per Bitcoin would be somewhere in the $400,000 to $500,000 range. So if you just play out these various elements that we have, rising demand, falling supply, this awakening that's happening to what Bitcoin can do to a portfolio, and you look into the future of the markets it could penetrate, I think it paints a very optimistic picture for the future of Bitcoin, whether that's 1 year, 2 years, 5 years, or 10 years.
I think that's extremely well said. I agree with that completely. I think I'll add some additional stuff, really less about that, but if think about the macro environment and how the geopolitical landscape is changing, I think the case for a non-sovereign fixed supply, totally inelastic supply to, which also creates volatility to your point. The case for something like that is just getting stronger and stronger on a fundamental basis. So if the volatility comes down, then investors can take larger positions, right? Because high volatility, as you said, manage your position size. Well, if the volatility comes down and the liquidity goes up, then liquidity begets liquidity. So now, if you're looking at some macro event and you're saying, well, sell $1 billion of this country's debt and buy $1 billion of that country's debt instead, well, you can't really do that in a lickety split with. Now you can, probably a billion you could do, but to be that global macro quality asset that can be used as an exposure either to or not to the fundamental idea of a non-sovereign currency, it needs to grow bigger, and it gets better and bigger as more liquidity, it feeds itself, and so that it will become more useful as it grows bigger, as volatility comes down. But also, like I said, aside from that it's got these return potentials and risk characteristics, all of that's true. I think there's going to be many more fundamental reasons why people want to own it. I think you see it with gold now. It's finally moving. Sweet gold, you took so long to finally have a positive, few months. But there's reason for that. The world is very concerned about the national debt situations around the world, and including in the U.S. Treasury demand is declining. And yet deficits are at basically all-time highs. The United States is adding $1 trillion to its national debt every 100 days. Just during this talk alone, we added $200 million. Did you know that? Just to the national debt. What were you guys doing? You shouldn't have been adding 200 million. Get your stuff together. Well, unfortunately, the nation's governments basically can't. They're in such a tricky spot when it comes to fiscal and monetary policy that when you look at the programmatic, credibly neutral monetary policy, by the way, which has a payments network built into it, it can be stored cryptographically. It just looks so fundamentally interesting that I think beyond the pure return potential, you'll just see people start holding it for its fundamental properties more and more.
Yeah, I was going to go on the macro front as well, so I don't have anything to add to it. As well said. I'll just add to the fact that I don't think traditional finance and Wall Street has seen in many, many decades a true, as you said, credibly neutral asset that has no counterparty risk. Like that just hasn't existed before. And you have all these macro things going on where I think people are going to come to the realization of how powerful and valuable that is. And that I don't think that can be understated. And the other thing I'll just end on here in terms of outlook, we were talking about this last night. If you've ever seen that YouTube TED Talk, it's only a 3-minute TED Talk. It's many, many years old by now. But it's called How to Start a Movement or something like that. If you Google it, it'll come up. And it's got this guy who's dissecting a 1-minute video. And it's a video of a young man dancing wildly at a park or at a concert on this grassy hillside. And he's the only one out there dancing. And he says, this guy's trying to start a movement. And you think he's the one starting it. But as he goes through the video, he shows the most important person is the second person who joins him. Because that person validates the first person. He's not crazy anymore. He's not just the one lone guy dancing as a crazy person that everyone around is just ignoring. Now the second guy joins, he starts motioning his friends over. All of a sudden, in an instant, there's this crowd, and they're all dancing wildly. And I think that's the moment we're at right now. You have one company who some people, all due respect, thinks is the crazy person dancing. You've got one country, El Salvador, everyone thinks is the crazy country doing it. And so if we get that second one, I think that's the inflection point that we need to get us to the next level. So I think that's what we're at now, and we'll see how it plays out.
What an excellent way to end the conversation. I would like to thank all our panelists. Thank you so much for being with us today.
Yeah, great job. It was fun.
All right, we are running just a little bit behind, so I'm going to get right into introducing the next panel. It is about integrating Bitcoin in the boardroom, moderated by Andrew Kang, the Senior Executive Vice President and Chief Financial Officer at MicroStrategy. The first speaker is Salman Khan. He is the CFO of Marathon Digital, the largest listed Bitcoin miner in the U.S. by market cap. Prior to joining Marathon, Salman served as the CFO of NASDAQ-listed Verb Technology Company and has served in various senior executive positions at Occidental Petroleum. Rick Schonberg, he is the head of custody, foundations, and trading at Coinbase. He brings 3 decades of experience in institutional financial services to navigating the complexities of digital management. And Nathan McCauley, the CEO and co-founder of Anchorage Digital, one of the leading digital asset platforms for institutions. Welcome our next panel.
Thank you, Natalie. And thank you all for joining us today, and thank you for the panelists. I know people have traveled pretty far. Salman, I think you might get the award for traveling the furthest, so thank you all for being here. So this session is really focused around, I guess it's titled Bitcoin in the Boardroom, but I think what we'd like to focus on is how corporations think about innovating with a Bitcoin strategy. What are the thought processes that go through at the board level, at the management level, from a strategic level? And also we have probably some unique perspectives around how customers that each of the companies here service also think about those types of initiatives. And so I guess to kick it off, I'd probably describe a little bit of the journey that MicroStrategy has gone through. It's been a very impactful and eventful one. We were obviously one of the first large corporations to adopt Bitcoin as a treasury strategy. And in fact, it was probably, in the timeline of adoption very early. And I can imagine, I wasn't actually at the company in 2020, but I can imagine the intense conversations, the deliberation and debate that went on. But one thing that resonates with me from a MicroStrategy perspective is when we think about the initiation of the treasury strategy and the ongoing support and execution of it, it is something that permeates down throughout the organization. It obviously starts very much so with our executive chairman, We have alignment at the board level. We have alignment at the senior management level. And over the course of the past 4 years, the company has really transformed from a values and cultures perspective to also embrace Bitcoin as a corporate identity. And so a lot of what you see as an identity today in MicroStrategy permeates not only the foundation of our business as a technology forward and innovation first software company, that very much blends in from a DNA perspective into how we embrace Bitcoin as a digital asset, as digital property and a digital store of value. So for us, you look at us, we still have intense deliberations. There's a lot of energy in the room when we talk about our Bitcoin strategy. And it consumes us in so many different ways that's positive and has created a lot of shareholder value for our company. Excuse me. So I guess maybe I'll start with Nathan. Anchorage is the only federally chartered crypto bank in the U.S., and that alone, speaks to probably a very unique journey and how you founded the company and all the things that you had to consider in really executing that strategy. Maybe we'll start with you, and if you can help us understand a little bit about that journey, that'd be great.
Sure, and I'm really honored to be here. Thanks so much for having me. So Anchorage was conceived in late 2017. And the idea there was back in 2017, Bitcoin was the main topic at say Thanksgiving dinner for a lot of people that year. That was when it really kind of took its first real gain into prominence in terms of the cultural zeitgeist, if you will. What ended up being interesting is I and my co-founder sat down and kind of looked at the market landscape and realized this was an entirely retail-driven phenomenon. And the bet we made in 2017 was, what if institutions wanted to adopt Bitcoin over time? What if institutions wanted to buy and hold Bitcoin? Wouldn't that be incredible? And so at the time, felt like it's possible that we're really late to this market. It actually felt very late to start in 2017. In hindsight, we were incredibly early to that idea that institutions might look to adopt digital assets, and particularly Bitcoin. So basically kicked off the company with the goal of solving two big problems, which is let's provide the most secure and safe place to hold your Bitcoin, and let's get the whole thing regulated so that, say, registered investment advisors, public companies, any of the world's institutions that need to go through an incredible amount of due diligence and organizational due diligence on their counterparties would be able to hold with us. Incredible security, incredible regulatory apparatus. Combine those two things together, and that's basically the bet we wanted to make. Now we are 7 years later, and it turns out that bet was right. Turns out that many folks, many institutions over time have wanted to adopt digital assets, MicroStrategy being one of the biggest ones that has wanted to do that. And along that journey, we were fortunate enough to be granted the first ever federal bank charter to hold digital assets. And there's a whole journey I could get into with any of you on that process. But imagine an incredible amount of due diligence and oversight from the federal government around how we hold assets, how we do that in a fiduciary capacity, how BSA, AML, compliance, and accounting, and security even are all held to an incredibly high standard. And that is the high standard that is needed to really catalyze and continue to grow institutional adoption for digital assets. So we're really excited. The way we think about it is that the Bitcoin ecosystem deserves a bank, and we are happy to get to serve that capacity and help institutions participate in the landscape.
Great. Salman, as the largest Bitcoin miner, your business, literally is Bitcoin. Can you give us a better understanding of Marathon overall and how you guys have changed and evolved over time as well?
Sure. Thank you for inviting us. This is a phenomenal opportunity to connect with people here, so appreciate you doing that. Marathon is the largest publicly traded Bitcoin mining company, as you alluded to. We have global operations. We view ourselves as a global company. We operate in the United States, in multiple states, going from Texas, Nebraska, North Dakota and Ohio, and then overseas we've got operations in the Middle East region and also in Latin America. And we're expanding further significantly overseas while our domestic operations continue to grow. The company has been, when you think about it, we view ourselves as from a three-pronged perspective. So one is we are focused on the Bitcoin mining utility scale business. That's one of our business units. That is bread and butter Bitcoin mining, large scale, 100 megawatts plus, and that's our current operations. The second piece of the business that we are focused on is something called energy harvest. And energy harvest is what we call is the future of the space. As the technology continues to improve, the halvings keep on happening every 4 years. We find opportunities that are more opportunistic and closer to zero cost to mine the Bitcoin. And that makes this process of Bitcoin mining sustainable and also economically feasible from a longevity standpoint. So think about energy that is stranded in remote locations that cannot be accessed or is stranded because of whatever reason. We go out and take that energy and convert that into value for our stockholders. So that's the other piece of it. The third piece of it is technology. Although we are in Bitcoin mining, we've got two energies converging together. One is the energy commodity-based risk with Bitcoin price, and also on top of that is the technological aspect of this. And I know we're going to talk a lot more about technology, but we have a technology division that focuses on operating our own and operated pool, which is unique to Marathon as a miner. And also we have various technologies that we've announced fairly recently that we're very excited about. It's a changing landscape. Every 4 years, the Bitcoin halves, production halves as a result of that. We got to be on our toes and continue to be creative about how we can create significant value for our stockholders. And underlying fact remains the Bitcoin is limited in capacity. There's a race of mining those coins. 20 million coins have already been mined out of the 21 million. So it's just the 1 million that will continue for during the life cycle of the people in this room. But this is a phenomenal position to be in because it's different from oil industry, for example. I come from oil industry, and in that industry, you don't keep oil on the balance sheet. You try to sell it as quickly as possible. Whereas in this industry, and something that was a struggle for me as a CFO coming into this space, to understand how much coin should we have on the balance sheet or not, was that underlying thought process. But it's very different at the same time from oil industry. There's no storage cost to keep your Bitcoin. And the value that it accretes over a period of time, we've seen a lot of numbers in the previous sessions. It was up 150% last year alone. It's up 35% or so, even with the decline recently now. So a very interesting space, and very excited to be here.
Thank you, Salman. And Rick, from Coinbase's perspective, as the largest U.S. crypto exchange, I know how you guys have serviced customers and the products that you've been offering has changed over time. Can you give us a little bit of some description on how Coinbase has evolved and what you guys think of as, from a corporate strategy perspective?
Sure. So to start with, thank you for having us here, and thank you for your continued partnership between Coinbase and MicroStrategy. Obviously there's a long history there, and I think I'll use that as sort of the example of what we try and do. We partner with our clients on their journey, and we try and surface sort of the range, the full suite of assets we have. Similar to Anchorage, we are heavily regulated, and I think as some of the last firms standing in the space, we're standing because we leaned in partnership with our regulators rather than sort of trying to outrun them. And I think that says a lot with how we partner with regulators and how we partner with our clients. So in terms of what we try and do, whether it's with the ETFs, which have obviously been in the press a lot, and I'm sure we'll discuss later, we try and find their pain points, deliver solutions for them, and keep building and build with them and try and anticipate their future needs. And so just, again, building that partnership as we go along?
So, as we were speaking, I think all individually, maybe I didn't dive directly into it, but I'll take an opportunity to. Regulatory landscape, whether you're a U.S. chartered bank or you're a public company, there's a lot of focus around making sure we do the right thing from a regulatory perspective. And so one of the things I take away as we're speaking, MicroStrategy, for example, has been a public company for over 25 years. And with that comes a lot of rigor around making sure we have the right financial reporting, we have the right internal controls. All of our partners have to have the right internal controls. That's a lot of, sort of the infrastructure that has to exist in order for a corporation to be able to implement a Bitcoin strategy. And for MicroStrategy, it's been a very important focus. And kind of what I reflect as I hear everyone speak is each of the institutions represented here also focus on that. So there is an alignment that exists in order to be successful in executing on a Bitcoin strategy. And one thing I reflect on is over the past 4 years, and probably even longer than that, that has become easier, that has become a little bit more transparent. Every year that goes by, we have sort of an event that has more regulatory clarity supporting a Bitcoin strategy for companies. I know we'll talk a little bit about it later in the regulatory panel around some of the accounting rules that have changed. Obviously, the SEC approval of the ETF products is also another support of the ecosystem. And so, as I reflect on how we as a company think about Bitcoin, regulation, compliance, and being aligned in the right way is very important. And there's a lot of thought around it. And I just want to highlight that it seems like everyone here also sort of is aligned in that way, which I think is important. So my next question is, around different considerations that management teams face around either adopting Bitcoin strategy or evolving a Bitcoin strategy. MicroStrategy, for example, started in late summer of 2020, took about $550 million of cash that was on balance sheet, converted that into Bitcoin through a couple of capital markets activities. And ever since late 2020, we've added more Bitcoin on our balance sheet every single quarter. And we've done it in a way that's been diverse and also very successful and focused on shareholder accretion. One of the things MicroStrategy did earlier this year is we announced ourselves as a Bitcoin development company. And so for me, that sort of reflects the evolution of a company that's been in the space and devoted to Bitcoin over the last 4 years and continuing to think about ways to innovate and change and evolve in the ecosystem. And for us, what a Bitcoin development company means is taking sort of the core software business that the company was founded on, integrating that into how we think about Bitcoin, leveraging advocacy efforts, a lot like what we're doing here this week, and also taking other components of corporate strategy, such as access to capital markets, in order to uniquely find ways to gain leverage, raise capital, and accrete more Bitcoin on our balance sheet. So for MicroStrategy, it's certainly an evolution that began with taking $500 million of cash and buying Bitcoin, but over the last 4 years, that's really accelerated and evolved. And so that's a little bit of kind of a description of what we've gone through. I guess, I'll open it up to the panel. Like, how have you guys evolved over the, past few years? And how do you guys, are there any things you're thinking of down the road that may continue, sort of innovating within the space that you operate?
Yeah, so I'll take that. Marathon has gone through its own transformation. The company was formed a couple of years ago, and it was in a different business altogether. And the previous CEO and chairman decided to move in this direction and invested heavily in Bitcoin miners. So think about the machines, invested in that and deployed them in data centers that were not owned by the company. And they were rented space, so thereby saving 30% of the capital and start hashing and producing Bitcoin along the way. Over the years, we have transformed in the sense that we are now taking more portfolio approach. Last quarter, for example, we announced 2 major acquisition of data centers that added significant capacity to our company. We're now more than a 1.1 gigawatt in capacity, and we continue to grow. And that energy is essentially converted into Bitcoin through the miners that we've invested in, which are the most efficient in this industry. And with the passage of time, we continue to invest in that. So the transformation for us has been more from the asset light strategy to now almost being 60% owned and operated, which is asset heavy. That gives us a better flexibility as the Bitcoin price goes up or down, gives us a nice rate of return in different price scenarios. As I had said earlier, this is a commodity price exposed industry from a mining perspective. And we produce a coin that is almost approximately or less than 20,000 per coin, and we hold that on our balance sheet mostly. And the strategy has been that we sell the Bitcoin up to the extent that we need pay for our G&A costs and operations costs and electricity bills and things like that. Other than that, we keep that on our balance sheet. So as a result, we have the largest Bitcoin position in the balance sheet compared to other Bitcoin miners, and we continue to grow from there. Which is very interesting because if you take you mentioned FASB rules and new accounting and regulations and ETFs, the new accounting rules allow us to fair value these coins on our balance sheet, which we early adopted. And if you think about it, just $10,000 change in price of Bitcoin results in $200 million swing in our EBITDA, which is huge. And that gives us that value that the stockholders can see. It's an asset that's sitting on our balance sheet that continues to escalate in value and create value for our stockholders.
I think the questions around the sort of the mindset of people in boardrooms that are getting into digital assets, I think they're different types of clients that have very different mindsets. So I think, MicroStrategy is one example, and you are probably both at the extreme end of your only question is like, how do I acquire it? And then how do I store it? How do I hodl it? And I think that's like one set of people. We have another class of client that says, why should I? Should I invest? I'm a trading house. I'm a macro hedge fund. Should I trade spot Bitcoin? And that's an engagement. That's a conversation, a mindset of why should they? What does the opportunity look like? How might this translate into more of a TradFi explanation for what it is? Because they have a set systems and processes that they understand. They have accountings that they need to do. And how do we fit that into those molds? You touched briefly on regulatory before. A lot of those firms may be RIAs. They're interested in our SOC 2 Type 2 audits. It's very detailed, and sort of to get them over that decision, it's a lot of steps, some TradFi type steps that we in crypto don't like necessarily think on, but we have to do it to help bring them over that bridge. And I think that concept of a bridge is really what we're doing in our industry, is providing that bridge from sort of TradFi to NewFi. And that's what we do. And different clients, again, whether they're VCs or family offices, they need sort of different bits of handholding and different solutions to help get them across their bridge.
I guess we mentioned several times ETFs, and I know the panel before us talked in depth on ETFs. I guess, as I mentioned before, it's certainly another catalyst in the adoption, in the institutional adoption. Do you guys have any perspectives on that, plus the halving and sort of the increase in demand, and what are you seeing from your customers around 2024, in terms of different opportunities, right? Rick, you mentioned like there's probably a use case for a lot of different types of customers. There's a hodl use case, there's a TradFi, like investment use case. What has happened in the past 6 months that may have demonstrated an increase in that demand?
Yeah, I think one of the things that's been really interesting in looking at the Bitcoin ETFs as a category is a little bit the kind of built-in contradiction that comes from the idea of a Bitcoin ETF. Generally speaking, the ETF wrapper is supposed to be a product that encompasses an investment strategy. And so sometimes it's a basket of stocks. You think of SPY as being one of the very popular ones. And so the idea of a single asset ETF almost at the start is a little bit of a contradiction in terms, except for the fact that what that wrapper does is remove so much of the complexity. The issuer has to deal with the acquisition of the Bitcoin, the storage of the Bitcoin through a custodian, and all of the kinds of accounting and other kind of back-end processes that are there. What we've seen, the main response that we've seen at Anchorage with the Bitcoin ETFs has been a renewed interest in other products that are available within Anchorage. I think particularly around our RIA platform, where we're going to be able to service RIAs and allow registered investment advisors to get their clients into Bitcoin, and increasingly seeing that there's just as much demand on that side for directly holding spot Bitcoin as there is for holding within the ETFs. And so in many ways, the way I look at this is that there was, shall we say, latent demand in the market that was satisfied via the Bitcoin ETF wrapper. And then the natural consequence of that is that there are still people who want to take a position in Bitcoin that are unable to. And so there's other mechanisms by which we will see unlocks similar to, if not greater than the unlock that has happened with Bitcoin ETF. So to me, one step on the journey of which there will be many more kind of milestones over the next several years. So super excited and really, really happy to be able to help serve that market, both because it's an exciting market on its own and because I think it's a kind of a harbinger of how much pent-up demand there is to get institutions, investors, and corporates, all kinds of institutional investors into the Bitcoin ecosystem.
Yeah. I'd like to add in as well, it's been interesting, and sort of going back to people at Coinbase who've been here longer than I have been, they've been working on this for 5 years. And this didn't happen slowly. A lot of regulatory engagement, you can call it unsuccessful or successful, but in the end, got everything across the line. I think what that's done is had two really large impacts. One, as I mentioned, the bridge, getting clients across that bridge just got a lot easier, because once it has a stamp on it of approval, not just from the SEC, but just the volume of assets that have gone into it, and the amount of interest, the breadth of interest. And so that is bringing more investors in, is the first thing. And the second thing is that those investors that come in, we sort of built a flywheel, if you build it, they will come sort of style. And we have trading, we have custody, and we have financing. And that financing piece is actually critical, where it's something that people had been using, but they now seem to be activating more across the piece, sort of using all three of those systems in a complementary fashion. And we're seeing a lot more take-up and a lot more breadth sort of across those as well.
Yeah, I recall, Rick, you and I were chatting right around that time period, and it's like steam was coming out your ears and your hair was on fire, just given all the stuff that was going on.
Yeah, I live in New Jersey, but I took an apartment in New York City for that week. It was exciting.
Salman, is there anything related to the ETFs that has impacted Marathon?
Yeah, when you think about ETFs and the thought of BlackRock and Fidelity, the traditional names coming into this space, obviously talks very loudly of what the value proposition is here, right? Again, these are different different investment categories that are available, or products available to investors that they could invest in. ETFs are not a new phenomena. These have existed for ages. But if you think about it, out of the 11 ETFs that were launched, 4 of them were probably one of the best launches of ETFs in the history of ETFs. And that shows the amount of appetite that's out there for Bitcoin. And we haven't seen the institutional investors as yet. This is just retail and probably some hedge funds. So there's significant upside from here. The Bitcoin production keeps declining every 4 years. And although global hash rate keeps going up, which means that there's more people mining Bitcoin worldwide, but this will be a very interesting phenomena because all these ETFs have to buy Bitcoin in support of what investors are investing in those ETFs. And there's a demand and supply play that comes into play, and that's why the price has escalated prematurely before the halving even has occurred. Historically, it was used to be after halving, few months post-halving, you would see price going up. And this time it's unique because of the ETF demand. The price has gone up considerably.
Yeah. It's definitely the first inning. And I think we had an interesting interaction with one of the ETF providers that was having a client event, a conference, talking about sort of their platform and what they offer out. And they had one of their quants go up and describe like various scenarios of simulations they've done with different percentage allocations to Bitcoin. And it basically said you'd be ridiculous not to have at least a 3% allocation. I think that was the number. But he mathematically went through it as to why in the portfolios and all these different scenarios. Now, whether the right number is 1, 3, 5, or 10, or 100 in Michael's case, is up to the individual. But like just as that type of mentality seeps more into the traditional allocators, all the platforms that have activated have all these clients behind it. If we think about it, most of the people in this building can actually now buy Bitcoin indirectly because they can access the ETFs on their phone through their Fidelity platform or whichever. Whereas prior to January, having them buy spot Bitcoin would have been a bit of a hassle. So it's really broadened things out.
So certainly a bigger on-ramp. And you mentioned something just now, prior to January, a lot of folks, if you wanted Bitcoin exposure, you'd have to figure out how to get it and how to hold it, right? And we have, two great custodians and exchanges here. I can tell you from MicroStrategy's perspective, how we acquire Bitcoin and how we hold it is of the utmost importance. How have you guys, in your experience, seen customers or clients? What do they focus on? What do they care about? Whether they're a large public corporate company or a family office or an ETF or whatever the different kind of customer profile would be. Like, what do you see in terms of how people think about exchange and custody?
Yeah, it's a really good question. I think the first thing that I think surprises, say, corporate treasurers or investment teams when they start thinking about allocating into Bitcoin is the very fact that it is a thing you have to think about how to custody digital assets, how to custody Bitcoin particularly. For most of these folks, their entire career has been an assumption that there are extremely qualified, capable custodians that can hold roughly all of the assets they invest in, whether it's stocks, bonds, equities, any kind of alternative assets. So custody as an area has almost felt like just background oxygen you just breathe, and it just exists. So that's the first thing that ends up being interesting is like, oh, this is a real topic with real consideration that needs to come in, due diligence across the security side, the regulatory side, and then the counterparty reliability side. Is this a new partner that is going to support me in my journey? Are they going to hold the assets well? Am I going to be able to move the assets very quickly if I need to do that? And what is their regulatory standing? Not just who is their regulator, but internal controls. They have SOC 1, Type 1, SOC 2, Type 2, and just kind of across the board looking at everything that needs to go into that. We are set up to support our clients in that journey, to not just come to us and know that we are a good counterparty across all those, but really to help understand what that looks like. Here are the questions that you need to be asking, because you may never ever ask these questions of a custodian because of how much this is just kind of assumed in traditional finance that there are capable custodians. So on the custody side, super, super important, and central to it is the security question. And this question cannot be overlooked, cannot be overstated. In most asset classes, there's a set of agreements among all of the counterparties that if something weird or unfortunate happens with how assets are transferred, you have an undo button. You can say, hey, I don't want that to happen anymore. That was incorrect. Move the assets back, and it's okay. Not possible within Bitcoin. If the assets move, they are gone forever. And so the need for security around the safety of the Bitcoin is incredibly important. And a lot of the reason that I thought there was a good opportunity to start an institutional custodian was because of how hard the security problem is and how fundamentally important it is to get that right. And so that part of the diligence process ends up being really interesting. We do, with our clients, sometimes even site visits to our data centers to be able to look at our storage facilities, look at where the assets are held, so that you can get like a real sense of the security apparatus that goes into holding the assets.
You blindfold the clients before you take them to the data center?
It's a whole process. It's really kind of a lot of fun because there's a.
We use hoods. I'm just saying.
Yeah. There's biometric authentication to get in, and there's a lot of fun stuff there. We actually have a low-level system that actually disconnects from the internet storage. So when you actually go in to hear the data center, you actually hear a little clicking that's going on. That is like you can actually hear the security when you kind of do our site visits. So it's kind of fun. Then outside of the custody and storage of the assets, you have the acquisition of them. So where am I going to buy these assets? There's not a natural like New York Stock Exchange kind of a market where you can immediately know that you want to go there and get the best price for the assets. And so you tend to want to work with a whole host of market makers. And so within the Anchorage system, we do liquidity aggregation, we call it, where we look at all of the liquidity globally, find the best price at any point of time, and do big purchases of the Bitcoin that can spread out over, say, days or even sometimes weeks in order to get really good price across time when it comes down to the acquisition of the Bitcoin. And so all of that kind of factors in and ends up being part of the process we take corporations and institutional investors through as they look to come into the space.
Yeah. So Rick, I know you have a lot of expertise in TradFi and now digital assets. Like what are some of the differences you've experienced in that transition?
Some of the differences, TradFi people don't change. So we have to meet them where they are. And so if TradFi, if they use specific order management systems to invest, BlackRock Aladdin being one example. So we integrate with BlackRock Aladdin. So they can treat it like another asset. They have their security master, and they have these great debates like, where does crypto fit? Is it a security? Is it a currency? And it's a big deal because it impacts how things percolate through their systems. They set it up usually as a currency in their systems, and then their systems can't handle decimal points beyond 6, which is a problem. But we work with them, obviously, bridge through this. And so what that lets them do is it lets them close their eyes and pretend they're just trading a currency. So it's a bridge, right? We're trying to get them in, and then we call things custody. We give them things names, and I want to allocate. I want an end of day statement. It's so much fun talking to some of these people across their journey. About, they said, oh, but you'll send us end of day statements. I'm like, what do you mean end of day? There's no end of day. What at 4? Oh, at 5? When do you send? I'm like, it doesn't day end. It's crypto. They're like, well, we don't understand. And it's just a fun thing. So when you send statements, like, when do you want statements? And so it's sort of taking them on that and helping them understand is a lot of what we all have to do. And that starts once they're live. Obviously, we can have some fun with comments like this. But just to get them here, the RFPs that they give to us, they're 100-odd page documents requesting information, obviously going very, very deep into security, but just all sorts of legalities. It's to getting, again, it's a bridge to get them across to understand, to paper. We use prime brokerage. It's a term they understand. There are documents that are common. There are liability and clauses that are common. And so once they have that familiarity, that's how they then cross that bridge and get in. And we make things as like for like as they can with traditional assets.
Just one other quick one to point on that, though. Another one that certainly over the last couple of years has been increasingly important to clients is this notion of bankruptcy remoteness. As we saw some of the issues over the past several years with some of the blockchain players going through bankruptcies, a lot of the institutional investors really have a question of if I hold my Bitcoin at your custodian, does it become part of your bankruptcy estate if something terrible was to happen, or is it remote from you and remote from your asset base? And so this one has been a big issue that a lot of people are thinking about. And the good news there is if your custodian is set up with certainly with a national bank, sufficient regulatory setup, then the assets can be held remote to the custodian's balance sheet, and this ends up being very, very important as we walk people through this process. They don't want to have some sort of exposure of counterparty risk to Anchorage if anything was to happen, and so that bankruptcy remoteness that comes from our bank charter ends up being a big advantage that people appreciate.
Yeah, so agree with that. And then just one last point then on terms of the acquisition, we also do liquidity aggregation and really trying to get our clients best execution. So sort of taking something that TradFi has, I wouldn't say perfected, but they do extraordinarily well, is algorithmic execution. So we brought that in, taken those skills from a large bench of people with TradFi experience, built that out. Crypto is still a very fragmented market. A lot of the exchanges are remote, both in terms of geography, but latency, in terms of how the exchanges work, how they settle, and in terms of how they charge. Again, one of the odd moments you have almost predictably with clients is they'll suddenly start ingesting your market data, and let's say there's a problem. The markets are inverted. The Bitcoin price like a bit above offer. I'm like, yeah, no, that's right, but it can't because arbitrage away. And the answer is no, there's fees, there's latencies, and the market is inverted most of the time. And again, the TradFi people's heads pop, but again, it's a journey.
Salman, you mentioned earlier you guys are holding more Bitcoin on your balance sheet. How do you think about custody and exchange and sort of your transformation?
Custody is important, and both the gentlemen on my right and left are providers. We try to diversify and spread the love, as they say. From a controls perspective, it's a good proposition. But thinking about control and custody and safety and security comes to mind. And being able to access when you need to access for various reasons, whether you want to move around your Bitcoin or you want to do certain creative transactions, whether they be hedging activity or monetization to sell your Bitcoin to pay for your operating costs. All those things are important for us. So all in all, from a customer perspective, it's very important to have it safely secured and going back to the SOC 1, SOC 2 reports, those become very important for us.
Great. Moving on to sort of an associated topic. Yesterday at our Bitcoins for Corporations conference, we talked a little bit about technology innovation associated and related to Bitcoin. I think those types of kind of advancements are opening up not only folks' appetite and demand for Bitcoin itself, but different ways to use Bitcoin. Specifically things like Layer 2 and other advancements like that. How have advancements in Bitcoin technology sort of affected your corporate strategies? What product offerings may have evolved? What are some examples that you guys might have around not just the Bitcoin itself, but the things that are going along in the Bitcoin ecosystem?
Sure, I'll take a first stab at that. We're been working with Bitcoin since 2017. Certainly, as we launched Anchorage as a custodian, Bitcoin was right there as the first asset that we wanted to support. And so then, looking at the kind of second order things that need to come together once a custodian is built and operational, and how can we use some of the aspects of the Bitcoin technology in order to facilitate, say, settlement of Bitcoin among counterparties. A recent launch we've had there is around a product we have called Atlas, which creates this idea of a settlement network between counterparties. And the very interesting part being that we're able to simultaneously settle dollars against Bitcoin or Bitcoin against dollars, and have a real sense of what what traditional markets call something like DVP, delivery versus payment, who pays first, these kinds of things, where you can actually get to kind of instant simultaneous settlement of both the dollar leg and the Bitcoin leg, so that you absolutely reduce any of the counterparty risk that you might see there. Other areas where we've looked at is certainly keeping up to date with the latest in advancements in Bitcoin itself, whether that's the Taproot upgrades or some of the other upgrades that have come through where there's kind of more kind of at a technological level additional features that are available there, whether it's for privacy or other kinds of services, and that we've been keeping ourselves up to date on those. And a lot of that driven by the clients wanting us to add those kinds of features in. And so I think it's been really interesting. And then something that's more kind of in the back end on the I would almost call it compliance innovation has been the fact that there is in fact a chain of transactions that come back from any of the Bitcoin deposits that come into our system. And so we've actually had a very fruitful set of conversations with our regulators about the technology we've built in order to satisfy some of the banking and compliance standards that need to come through. And that ability to track the chain of custody or the chain of transactions that have come through. It's been more kind of in our back office, but has meaningfully helped us get to the point where regulators feel good about where the Bitcoin has come from. Are we meeting our obligations under various federal regulations? And so that's another area that I've found to be a real enabler for the ecosystem.
Yeah. So to jump in as well. So I think it was mentioned yesterday already. On the retail side of the house, there was demand, and so Coinbase is in the process of finishing up its rollout of Lightning. So that's very exciting and well received by our clients, well received by the audience here. So that's one recent. And on my side, on the institutional side, we're again responsive to clients. Post the ETF launch, we had some demand also so we delivered on Taproot, sends, upgraded to SegWit addresses. There have been some increased demands around OFAC screening, just as given the volume of assets and the oversight, and so the regulators being so sensitive to what's going on and all the volumes going in. Just to give some context, the regulators want to look good as well. It's not just if assets go in and things blow up or something bad happens, and they get to come in and beat on us. That's not a good day for them either. As much fun as you might think they're having, it's a bad day. They don't want a black eye. They want things to go smoothly. So a lot of scrutiny there. So some investments there on the OFAC side and screening. There's been a lot of chatter around dust and dust attacks on the ETF provider. So there's a lot of work going on there to help manage those.
When I think about Bitcoin, I think about this as like the internet of the 90s. And I grew up in the 90s. I'm sure there are a lot of younger people here. But when you think about the internet at that time, it was so slow. You had to use the dial-up to connect to the internet. And you were required to have a landline to do that. And that landline was shared by your siblings and everybody. And you had to shut down the phone for somebody else in order to get online. And it was slow, clunky, and there was not much on the internet other than a few things. Fast forward that to 30 years, 30, 35, 40 years, you look at the internet the way it exists today, trillions of dollars worth of transactions, businesses have been established on top of that clunky internet that existed at that time. So when you think about Bitcoin right now, Bitcoin is having that moment of growth. The layer 1 provided the protocol and it provided the base framework. And now you're seeing this layer 2 and other things that are being built on top of it that will provide that accretion and the value that you will be able to see the use of this decentralized and very secure network that cannot be hacked. That level of security, imagine building technologies on top of that level of security. How much value would that create? And that's where the level 2 comes into play. And Marathon has been at the forefront of the technology development. We've announced a few products in the last couple of months Enduro and Slipstream and many others from a technology perspective. And we have a lab, we have our technology team, which is world-class, that is focused on, our eyes are in the future, right? We're looking into the future and seeing how the problems can be solved and how this network can be strengthened further and improved from a use case perspective. And there's a lot in the pipeline.
So I think, if I step back and I think about, again, coming back to the theme of integrating Bitcoin into the boardroom, helping corporations understand, how they can have their own journey in adopting, some sort of Bitcoin strategy. It really starts with sort of going back to our keynote this morning, right? There is no second best. And I'm sure we'll rewatch that hour again and again and again, and there's a lot of important reasons as to why you want to start there. But as we talk here in this forum, it also is very clear to me that once you develop the desire and the understanding of why Bitcoin is the digital asset and the digital property, and you want to go do something with it, you want to buy it, you want to hold it, the infrastructure in which you can do it, the ways in which you can do it have very much advanced in a way that public companies, leading the way and having all of the bells and whistles of regulatory compliance and internal controls and all of the financial reporting needs have really become, in the past 4 years, just thinking about MicroStrategy's journey, easier, right? If I think back to 2020, it was probably a lot harder to think through those. And the playbook has really opened up and allowed people to consider it. That also connected with the demand that we're seeing through more adoption, more regulatory clarity outside of just wanting it, I think really sort of drives the ability of people to consider it and understand why they want it and actually effectively, securely, and compliantly execute on those strategies. So I thank you guys for your time today, and I appreciate all the perspectives that you've provided, and hopefully the audience has a better understanding of the why, but also the how, and some of the thought process behind it. So thank you guys for your time today.
Thank you.
Thank you.
Thank you guys, that was great. All right, thank you everyone. We have had an amazing morning of panels, keynotes. We've got more to come after lunch. Drinks are actually right in the back once you get up from your seat, and then lunch is served directly outside in the hallway. We will see you back at 1 o'clock. Thanks so much.
Please take your seats. Our program is about to begin shortly. Thank you. Please take your seats. Our program is about to begin shortly. Thank you. Please welcome back your host, Natalie Brunel.
Thank you. Thank you. Yeah, we got to get the energy going for the afternoon. I hope everyone had a great lunch. I hope everyone's buying the dip. It won't be long before these Satoshis on sale are not going to be, they're going to be very expensive pretty soon. And the topic that we're going to be exploring in this next panel is when are the big traditional finance banks going to be involved in Bitcoin? The Bank of Americas, the city banks. That's what the panelists are going to be discussing. So I'd like to welcome to the stage the moderator, Phong Lee, President and Chief Executive Officer for MicroStrategy. Hunter Horsley, CEO and co-founder of Bitwise Asset Management, which has over $3.5 billion in AUM. Matt Horne, Head of Business Development at Fidelity Digital Assets, and Puneet Singhvi, Head of Digital Assets at Citibank. Give them a round of applause, please.
So I've been pretty excited about this panel, and Natalie was asking me earlier, so what are you guys talking about? And I was like, well, we're going to talk about when the TradFi banks are going to figure this shit out. But she didn't use it, so I said I would. And so we've got one of the largest traditional finance banks here, Puneet with Citibank, who has been quite progressive with what they've done. And then we have somebody sort of in between Fidelity, and then obviously we've got Bitwise, who's all in on this. And this will be a great discussion. Thanks for everyone who's here in person. For the 80,000 or so of you watching live streaming, awesome. Thank you for attending too. And we'll get right started. Hunter, why don't you just start, give us a little bit of your background, your journey into Bitcoin, into Bitwise, and explain to everybody what Bitwise is as far as a company.
Sure. Thanks, Phong. Awesome to be here. Love the pioneering work that MicroStrategy has done, so it's a pleasure to be with all of you and those of you I've had a chance to chat with. Bitwise is striving to be a best-of-breed specialist in Bitcoin and the digital asset space. We manage over 18 investment solutions to help investment professionals get exposure to the space. We have one of the largest Bitcoin ETFs, that's the Bitwise Bitcoin ETF. We manage the largest crypto index fund that publicly trades. We have separately managed accounts and a whole bunch of solutions. But a large part of what we do is we spend time with investment professionals across the country who want to take advantage of the space, but are ultimately extremely busy with 99 other things going on. And if it's going to be a 1 or 5% part of what they're doing, they need leverage. And they need to feel like they don't have to Google every time they read a headline or every time a client comes back from Thanksgiving and their nephew said, I heard that I should be buying Cardano. Not to work any of you up. So they can rely on us, and we'll get into it more. But today we are partner to over 15 banks and broker-dealers in their wealth management divisions, and we serve a few thousand RIAs, family offices, and wealth management teams.
Awesome, thank you.
Yep.
Matt, so you're with Fidelity, who has really been a pioneer and a groundbreaking in sort of this space. Obviously, your ETF is doing extremely well. Tell us a little bit about yourself and your background.
Sure, so I've been at Fidelity about 12 years. My background is on the traditional ETF side. I personally discovered Bitcoin around 2017 when I was podcasting as I walked to the office in New York City, and I kind of just decided I wanted to make this my career. And I was fortunate enough to be at a company like Fidelity, who, private company, takes a long-term view, always has a penchant for experimenting with disruptive technology, and digital assets were really no different. So Fidelity's been in the digital asset, Bitcoin space as far back as 2014. We have a mantra inside Fidelity. It's, you scan the market, you try some new things, and then if it works, you scale it. So scan, try, scale. And I think the digital asset effort here at Fidelity is a great example of that. So the Fidelity Center for Applied Technology, it's our R&D team within Fidelity. This is where it all started. We were mining Bitcoin. We had the need to then custody the Bitcoin, so we built out slowly over time a institutional custody and execution platform. And now we have really multiple commercial offerings in the Bitcoin and digital asset space. I'm in the Fidelity Digital Asset Management space, so we represent FBTC, the Fidelity Wise Origin Bitcoin Fund, our ETF. We have a custody and trading platform, Fidelity Digital Asset Services. We offer trading to retail clients, as you know, through our retail platform. And we offer financial advisors the ability to do direct Bitcoin and Ethereum trading for themselves. So diversified financial services company. We are long-term view. We have a long-term view on this space that is very constructive. And we have many bets across the board here. So,
thank you. And Puneet, I think people may not understand what Citi's doing in the digital asset space, and I think it's doing a lot under your leadership. Maybe you can give the audience a little background about yourself, how Citi got into digital assets, and what exactly is the scope of things that you do?
Sure. So we set up this team, which is our digital asset team, about 2.5 years ago. It's brought a theme around digital assets there. I've been looking at this space over the last 5 or 6 years, and about 3 years ago or so, I started pitching internally to the senior management team in terms of starting to focus and coalesce around proper strategic way in this area. We have to do it very systematically, thoughtfully, build the right infrastructure supporting it from technology perspective, risk perspective, business perspective. So eventually, kind of in January 2022, we formally kind of set up this team for really focus on driving solutions to meet the client's needs. Obviously in a risk regulatory compliant fashion, and at the same time ensuring that we are building capabilities for the future. So 4 or 5 core domains which I see, which are focus areas, include digital money, payments, the second one, digital securities, third one is around custody and asset servicing, fourth is around trading and risk transfer, and fifth around distribution. So across the bank, across our businesses, we have initiatives which are driven to drive new innovative solutions in this space, as well as find opportunities to capture new business ideas, new clients, as well as internally kind of align and be ready that some of our traditional products need to change as the space evolves. How do we really do that? So that's been a long journey. Be pretty in a very good position. Last year, we must have made multiple initiative announcements in this space, and we continue to do so this year. And I'm very excited to be here. Over the last, today, yesterday, the nature of people I met, the amount of work which is going on is very inspiring, very fascinating. So looking forward to further engagement in this space.
So Puneet, let's dig a little bit deeper, right? When you think about digital assets in Citi, if one extreme is you're the guy that goes around and says the same thing all the time and nobody wants to listen, the other extreme is you're meeting with the board and the CEO on a daily basis. Where does digital assets fit into Citi's strategy overall?
Yeah, I think what we've done ensure that whatever we are doing, it's very clearly, as I said, driven by what clients are actually asking us. So all our initiatives have some client or the other engaged, starting from the building out the solution process all the way to executing and delivering it. So that's been very fundamental to the strategy. Second piece is very important, that we need alignment at the senior management level. So Citi has 5 core business lines after the recent reorg. Leadership across all the 5 business lines need to be aligned with all the work we do. One unique thing we did is this is not a separate standalone unit. Bank does payments. Bank does custody, bank does trading. So we want to ensure that all those respective businesses have this as a component of their overall strategy for the coming years, and future-proof themselves, ensure that they're meeting client demands. And so over the last 2 years, what we've done is really embedded that. Other piece we did, and which is very important for financial institutions, is ensuring there's a right risk infrastructure supporting this. So we appointed somebody for head of risk for this space from our enterprise risk team. We have leads which are domain experts in this across various risk stripes. And then further embedding it, we kind of put up a technology center of excellence, whose idea is to really forward look in terms of technology trends, inform our internal capabilities, and actually help build the tech stack which will enable us to deliver all of these services, which is very critical at the end of the day. So all those things which come together, frankly, from an institutional perspective to engage.
So client-driven, but it does sound like you're trying to do it the right way and be fairly 100%. Strategic about it, which is awesome. Well, you, Matt, like if you think about Fidelity as a huge organization, digital assets, has grown up through there. saw the former head, Tom, now has moved over to sort of do more. Like, he got promoted, which is awesome. Maybe it's a source of talent within your organization. But tell me about, like, I get the sense with Fidelity that digital assets is sort of the leading edge of the organization. But where does it fit? Do you get all the great talent and everybody else works on the TradFi side? Or like, what's
yeah, yes. I agree. It is a massive effort across the firm for us. And Fidelity is known for having this crypto mafia that have left Fidelity over the years. You know, Matt Walsh, Nick Carter, Alex Thorn, where are you? And that it's great. They've gone out to do great things. But I think we're at a point now where we have talent now migrating internally as well. And I think Tom Jessup's a great example of that. He left leading the digital asset custody business to now run our entire brokerage operation for the entire company. So, you know, it's great to have him in that seat. It's a massive effort across the firm, and it is a strategic priority because we view this as a massively disruptive technology and a massive opportunity for firms to get it right and get it done early. This, I would say, the genesis of this has come from both the client demand from, you know, the clients up, but also I think, as I mentioned before, we had a view on this early versus other firms, so it's been a top-down initiative as well. Where I sit within asset management, digital assets is a massive focus. It's, you know, we're focused on building out a suite of alts for our clients, and digital assets is another major initiative that we're focused on as well. And there's client demand here. And there's sort of two forms of this, I would argue. One is just giving clients exposure to the actual, you know, layer one asset, right? Bitcoin, other assets. But then there's also this enabling technology where, you know, you've seen a lot of work in tokenization across the financial services industry the last few months here. We believe that could be transformative as well, right? So we're active in that space as well. So I think you have to have a long-term view, be willing to take measured risks, and make it a strategic priority so that people behave in the manner you want to achieve the goals the company puts out there.
I think it's really cool when digital assets gets to the point in more traditional finance organizations that it's attracting talent, it's breeding talent. If you think about MicroStrategy, you know, we're doing a lot of work in AI. The smartest folks go work in AI. We hire, you know, really great. It's an easy place to attract people, and then they go off and permeate throughout the company. That would be awesome. It sounds like that's starting to happen in your organizations. So Hunter, you know, as you went down this ETP route, but just in general, you know, with Bitwise, you're working with traditional finance banks all the time. And tell me what that experience is like as you go over to these banks to sort of work with you on the ETP. Are they sort of like, is it easy, or you have to like make 18 phone calls until you find somebody who's going to talk to you?
By a show of hands, who owned Bitcoin in 2017? So some people who have a lot of experience with the space. I think, to your question, one of the remarkable things about Bitcoin in 2024 is that you can work with some of the largest financial institutions in the world, and many of the people that you would work with in any other asset class. And the reason I ask the question is because that hasn't always been true. There was a time when if you wanted to run a fund, there was only one administrator out of Colorado that would do any work on a fund that held Bitcoin. There was only one auditor that would do any work on a fund that held Bitcoin. There was a custodian out of Kentucky that was, you know, your main option for custody. And so to fast forward today and how I think about getting to work with traditional financial institutions, it's pretty extraordinary for the space in making it accessible to people where they feel that they're getting the same sort of first-class treatment and counterparties as they would if they were buying any other asset. Today, Bank of New York Mellon is the administrator on our Bitcoin ETF and the cash custodian. And we work with a host of different banks as authorized participants and so on and so forth, which you could go more into. Certainly, these financial institutions have endured for a very long time and have the trust that they have by being very detailed and cautious about the way that they do things. And that applies to this space as well. There's one bank that did 2 months of diligence on us, and I did many thorough interviews before they decided to work with Bitwise. So there's a level of rigor there, but I think it's an amazing development in 2024 that hasn't always been true of, you know, even Bitcoin has been around and has been the same. The ecosystem around it, I think in 2024, is starting to be the same sort of, no longer minor leagues, but the same tier ecosystem that a wealth manager would expect, for instance, if they were buying an ETP in any other category. So I think it's been an amazing development over even just the last 6 months to some extent.
Yeah, so that's great. So let's dig into sort of, going and finding an authorized participant. And I think people are surprised to hear some of the large banks who publicly say one thing and privately are taking part. What does that look like? Did you have to go out? Were you recruiting them? Were they recruiting you? Was it a simple conversation? Did you call Puneet up and say, hey, can you help me out? Like, what does that look like?
This is fascinating. So in general, the team at Bitwise, we talked a little about building teams. We have the luxury of building a team from a clean sheet of paper, and we say if we're going to purpose build for Bitcoin in this space, what is our dream team? And then we try to get those people to join the company. So there are people who have backgrounds in open source software development and cryptography, and there are other people who have decades of experience in ETFs and asset management, and then we try to build that team. So our capital markets team already has relationships with most of the APs. It's a relatively small world. And we go out and we approach the ones that are some of the most accomplished. I think public names are Virtu and Jane Street. Macquarie is a public name on our fund. There's another AP on our fund that is definitely a household name bank, but we have been asked not to mention. So there's still a range of people's comfort in the public forum. But we go out and we try to recruit the best counterparties. And I will tell you that before the Bitcoin ETFs launched, for those of you who don't know, again, I mentioned Bitwise strives to be a best-of-breed specialist in this space. The same way you would think of Apollo in private credit, or Brookfield in infrastructure, or Blackstone in private real estate. We're purpose-building for this space, but we're not Fidelity, and we're not BlackRock. So we had to do a little bit of begging for people to take us seriously. That changed after the launch, and we started to have inbound from some firms that wanted to join as an AP. So I guess I just can't emphasize enough. I think that the Bitcoin ETFs have really brought Bitcoin into the realm of possibility for a lot of traditional financial institutions, to the point where, for the first time in 6.5 years, we have banks reaching out to us looking to be an authorized participant on a Bitcoin fund.
That's a great evolution. I do think it's funny that you went and said, hey, you want to be an AP? And they're like, yeah, but you can't tell anyone we're associated with you.
Yeah, that's remarkable. There's actually a bank with a wealth management division that recently, they spent 2 months evaluating Bitcoin ETFs. They approved the Bitwise Bitcoin ETF for advisors to put in portfolios. And they specifically asked that I not tweet their name.
Because you would have otherwise.
I may have otherwise. But yeah, they didn't put out a press release, so it's not publicly known. I think that's a remarkable part of the first quarter of this year, is that a lot of traditional and reputable firms have started engaging with Bitcoin in a way they never have before, but so few of them are saying anything about it. If you just scroll through your LinkedIn or you read press releases, you would think that nothing has changed versus last year, and I'll just tell you the world has completely changed versus last year, but for now, most or many are preferring not to have it be public.
And just to add one more comment to this, what is also enabled is the entire ecosystem to become even more mature. I mean, if you go through the diligence process of onboarding, it's complex, but it's very thorough. And it asks you questions around every aspect of it. So once you've gone through that process, you actually become more mature in terms of how do you run the company. A sustainable way, not sustainable way? Are you managing risk properly? So just the sheer fact that now these traditional financial institutions, which have connected with many of these providers and so on and so forth, is actually enabled the entire infrastructure to get enabled better. So if it's the flip side of it, where an ETF by established fund manager now goes and procures services from a typical crypto native company, that company now actually has gone up in terms of their understanding and capability because they've gone through that review. So that also I find very fascinating ancillary benefit, frankly, because the ecosystem needs to get matured as this asset class becomes mature. This has been one of the big triggers this year.
Yeah. The story that you're talking about with launching the ETP reminds me of when we, MicroStrategy, went into Bitcoin in 2020. The number of law firms, it wasn't even a number. There was one lawyer, he's here, who knew anything. He'll be up here. The number of accountants or Big Four, no, there was one accountant who sort of knew what they were doing when it came to public companies and Bitcoin. And the number of banks that were willing to work with us on our first convert numbered also in one. And now 4 years or 3.5 years later, that's all multiplied. But we always remember who was first, right? But it has evolved a lot. And a lot of times you have to write your own playbook. Yeah. And then people will start to learn from it. Now, Fidelity is unique in the ETP space in that you're also a custodian. Tell me about that differentiation, distinction, and does that give you any benefits over others?
For sure. I mean, as I said before, we have decades of experience in this space and built our own custody solution and understand that very well in the risks and considerations when building a custody solution and what it takes there. So we were very comfortable relying on our business partners there for the custody of the ETP. It's a good story. It's an integrated story. Fidelity has a lot of trust by our clients, and they expect the highest quality of service, and we hope to deliver that with this product as well. So naturally, using our own custodian made total sense to us. It does give us some economies of scale. Obviously, simplicity of operating in the background since we're all under one roof. But yeah, it's been a good success so far, and looking forward to doing more. So
great. Puneet, so Citibank's huge worldwide footprint, right? And I know you sort of narrowed it down a little bit or focused yourself a little bit more. Tell me, as you work with customers around the world, are you seeing different trends as you're working with technologists around the world? Are you finding some areas to be much more open to working with Bitcoin and with Citi in general with digital assets? So what are the global regional trends you're seeing?
Yeah, obviously the companies in the US are highly competitive and very kind of on the cutting edge in terms of embracing innovation. So that holds true. But this also is very global, where companies, in Middle East, with regulators which are very aligned with kind of building an ecosystem, or Singapore, or in Asia, where there are certain assets, in certain cases they can actually leapfrog from a technology perspective. Many of those cases, we do see a much closer engagement, but kind of in terms of the clients we work with, which are kind of large corporations, large asset managers, large funds and hedge funds globally. What is also equally important is that whatever we build actually meets their risk criteria as well, just like Hunter mentioned, kind of same thing here from us and their perspective. And other piece which is important is that we make it very easy. If it requires signing another legal agreement, if it requires I need to build a new API connectivity, if it requires I need to do something different, I want to abstract away the complexity from a client perspective as much as possible, where we kind of insource the complexity, but from a client perspective, make it very seamless. And that has been, I think, a core trend which I see, where from a client perspective, as long as you can show value, and you can show that effort needed to drive that value is minimal from their point of view, because there are many challenges going on and many things to invest in. To the extent we can do that, we get a very positive reception. We worked with a client called Maersk, which is a global shipping line, in terms of making the logistics easier as they pass through certain canals, which was a highly complex process with money stuck in guarantees for a long time. Kind of, we tried to work through many of those issues. So definitely we see a client level receptivity on this, but at the same time ensuring that from their point of view, they can do it in a sound fashion and in an easier fashion.
Very interesting. And so you had mentioned earlier, as you talked about the portfolio of services you're exploring, that custody was one of them. In one of the earlier panels, I think we talked about the complexity of a bank providing custody services for Bitcoin, meaning you'd have to carry a matching amount of Bitcoin on your balance sheet, et cetera. And so there's challenges. Tell me about how you're thinking about that, how you're facing that, how you're going to compete with Fidelity, who isn't a bank. So sort of how does that work overall?
Yes, I mean, Citi is a big custodian for securities globally. We connected across multiple markets and in leading position in Latin America, leading position in Europe, and so on. We also started by providing custody for tokenized bonds in Singapore, which is like the first foray in terms of how do you look at custody for instruments which are on a blockchain network. But at the same time, there are complexities when it comes to public blockchains, including Bitcoin, for example, both from an accounting rule perspective, which requires that you add the Typically, when you custody any assets, this is not on your balance sheet. You're doing it on behalf of your customer. You're actually segregating it, and you're not using it for your own purpose. And then customers have certain specific rights in terms of kind of information on that, as well as reporting on that, and so on. But in terms of public blockchains, the accounting rule called SAB 121, which I think you will probably talk about in a panel later in more detail, requires you to add it to the balance sheet, which makes it highly complex in terms of how you really deliver that. Because when you have it on your balance sheet, now you need to hold capital aside. So some of those challenges do continue to come through, and we need to figure out kind of right approach there. But that doesn't mean that you don't build technological capabilities, but how you want to engage in this ecosystem gets really driven by the commercial decision behind it and the regulatory construct behind it.
So to the extent you're comfortable, sharing, like how far is Citi away from being an actual Bitcoin custodian?
Yeah, I can't really say
months,
right now.
years?
It's very difficult to say.
Yeah. Okay.
Yeah.
But it's something you're looking at pretty seriously, which is.
I mean, we're looking at kind of custody in this space in general, and then really how do you engage in this? What is the right area for taking the first step and the second step? Is all really driven by the commercial considerations, risk considerations, regulatory considerations.
Do you expect at some point all the major banks will be Bitcoin custodians, like 10 years out, that's just going to be a standard offering?
I think it's part dependent, and each bank strategy dependent, how they want to engage in this. And there are some banks who are very custody focused, and they might decide to pivot and not pivot. Some banks are not. So really, you would actually see the ecosystem evolve based on each institution's strategic priorities and how they want to engage in this space, how they consider risk in this space, and can they actually manage it? Because you can understand risk, but if you build the infrastructure to manage it, that's what enables you to offer any service. So that's another very important thing. I also think the overall ecosystem needs to develop as well to support it. We'll talk about it later in terms of the kind of companies we're working with, which are small fintech companies in many cases. But the entire ecosystem to actually support many of those pieces are important as well. We just met over lunch somebody focused on insurance, for example, and that market developing there. So you do see different components of this now maturing. I think that is a good path. Once that is in place, I think it enables a lot of risk factors to be resolved.
Yeah, it's. I mean, you said it right. Like, if customers are demanding it, right, which I assume they are going to at some point, then the bank should provide it. I mean, Hunter, you spend a lot of time with all these banks. Like, when do you see these traditional finance banks crossing that chasm, if you will, or maybe they have because they're APs, et cetera, on ET?
Yeah, so I think it's a great question, and I would defer to your perspective on anything. But an important nuance that I think is worth appreciating about the Bitcoin ETF, not to, it's a topic everyone is sick of hearing about, but it's very hard, and you just enumerated some of the ways in which it's very hard for a lot of banks and broker-dealers to touch Bitcoin. Mm-hmm. If you take it and you put it in a Tupperware called a security, then there's a lot more you can do. And a remarkable thing about the Bitcoin ETF is it's just Bitcoin in a Tupperware, which is the security, and now you can do a lot with it. So any bank that is allowing clients to trade a Bitcoin ETF is, in effect, allowing the trading of Bitcoin, but it's that the ETF format allows it to slot onto the existing systems, the existing rails, and so it's almost Bitcoin coming to the bank as opposed to the bank going towards Bitcoin. And I think that you're going to see more and more as people realize that things are now possible. I'll give you one brief anecdote. We were out at an outing with one of our APs, who it was a big decision to start being an AP for a Bitcoin ETP, even though it's just a security. The question of do we want to associate with a Bitcoin thing. They decided to do it. It has ended up being so simple and valuable that at the game they were like, we're thinking about doing loans, options, structured products, the whole conventional picture of services that you would expect a bank to be thinking about is now populating in their minds because they realize through the construct of the ETP they can bring Bitcoin into their business and into their format. So I think that those explorations will take place this year. I don't think that sort of the whole of financial institutions will arrive in Bitcoin fully formed this year, but I think that the wrapper of the ETP is going to allow a lot more services to have the lights turned on around Bitcoin.
Yeah, you're right. I mean, kind of if you think of the entire ETF value chain, and we refer to a few things: transfer agency, fund admin, custody of those ETFs, prime brokerage and agency trading, distribution, all those pieces are getting enabled some which way through traditional financial institutions playing different roles. So that's, I think, a good way for that engagement to start to happen.
Yeah, whenever you have trading volume, asset growth, demand, there's going to be opportunities for these players in the ecosystem to make money, and they want to get involved. So they've only been live for, what, 3.5 months, and the category's been so successful, and really, I'd say, probably faster than we thought it would be. It is sort of pulling forward kind of some of these decisions and entrance into the market, right? Even approvals at home offices is happening for these faster than it would for any other type of ETF, right? So I do think the success and interest of this asset class in Bitcoin itself is almost pulling some of this, inward here. So
I like the Tupperware example, but when you were saying that, I was picturing this, person in a radioactive suit, like carrying uranium in like a Tupperware. That's what I was picturing, because we were having some great conversations last night. There are some folks out here who have great businesses and they can't get a corporate bank account with certain banks, and it's not that they're asking the corporate bank to hold Bitcoin. Yep. It's they're asking them just to hold fiat currency. Mm-hmm. And they're not asking for loans, right? And that's even harder. And we've been through this too, trying to get loans and these things. So there's the Tupperware example, but if it's, it's almost as if it's emanating things that then don't allow the traditional banks to even want to do traditional banking with you, right? When do we get over that?
I think that, the space has an irrevocable history, and that history is an aura that looks like risk and looks like tail cases, and I think that unfortunately has caused many firms that care about risk and reputations and so on and so forth to say it's not worth the surface area of risk that we can't even be certain we've sized up. So that what you're describing, the even just cash banking has been difficult in this space over the years. I think that that's changing this year. I just think that the polarization or the taboo-ness of, look, there's no investment in the world that every person in the world is going to, you can find people who don't like Microsoft stock, you can find people who don't like dollars, whatever. So it's fair for people to say, I don't want to own this investment asset. But it's untouchable dynamic, like it's not safe to touch. I think that is going away starting this year. And it won't be 1 month, but I think that the journey of it no longer being something that you can't touch and you sort of have an intuition is not safe, I think that's changing now.
I agree. I think the first quarter of this year has fundamentally changed the way the traditional finance space, and you can't argue with success, right? Mm-hmm. with how quickly these ETPs have grown. The number of conversations, inbounds, all these things we get now with the traditional finance sector has just completely changed this year. And you guys have been a big part of that. Well, let's now talk a little bit about, within banks, sort of the technology side of Bitcoin. And what are you doing? I know you alluded to it a little bit, Puneet, but just in general, for all of you, what are you doing on the Bitcoin technology investment side? Anyone can go first.
Just kind of starting off from an investment perspective. Some of the things which we've done early on and continue to do so is within Citi, there's a culture of actively working with fintechs, building solutions in this, and we don't think innovation can entirely happen internally. We love to partner. And as part of that, we also make investments in the fintech firms. So in the blockchain, Bitcoin, DLT, digital asset space, we made about 20 so far. But some of the relevant ones which are pretty meaningful, and to call out a company called Amber Data, provides data analytics. They launched a thing called Amber Lens, and you can actually see real time what is going on with the ETF market, what's happening with Bitcoin, what's happening with others. So very interesting. Another company called Talos, which are effectively building the entire trade lifecycle management system, where you can execute trade on different trading venues, but then after that kind of figure out the settlement cycles associated with it. Again, kind of one of the investments we made as part of that company, as part of our strategic investment. And then another one called TRM Labs. Again, all of these are very meaningful because TRM Labs' focus is compliance and ensuring that you can do transaction monitoring, which is a very critical requirement for AML. So some of these examples are those where you kind of see these fintechs which are starting to develop solutions which are very meaningful. They solve a problem. And as part of our overall strategy, while we might have our own tech stack, but we will actually lean on many of this to support and fill in certain capability gaps which might be in place. So that has been a very fascinating journey, and we are close partners with them because it's a strategic investment, it's not a venture investment purely, where we will actually consult in terms of providing our insight into the space, what the requirements of a bank might be, and then kind of work collaboratively to see how we can insert their solutions wherever appropriate.
Great. And what are you doing at Fidelity?
Yeah, Fidelity, we're want to be very supportive of the ecosystem, right? So in certain verticals, we will build it ourselves, and others we will partner and invest. We have a private capital team that deploys venture money in a variety of different ways in this ecosystem. Data providers that you talked about, like Coinmetrics, we're an investor in. Even offerings where it might not be a core offering for us right now. So like Casa does multi-sig custody. Very interesting, company there. So we have multiple bets and multiple investments kind of across the board here. And I think that'll continue. And I do think there'll be interesting opportunities in the venture vertical in this space as things continue to evolve here, right? Bitcoin's going to do its thing, but there's going to be picks and shovels and other ecosystem type companies that are going to need to get built to help bring this thing to what we're talking about here. And we'll be right there investing where it makes sense.
And Matt, are these investments sort of venture capital just looking for a return, or are you also investing to bring technology into Fidelity?
Yeah, we've done both. And this isn't just crypto. We've done this across multiple sectors, right? Other fintechs or even other parts of our business. So if it makes sense to bring in, we do it. Otherwise, it would just be a portfolio company. But if it makes sense to integrate in a diversified financial services company, then it's definitely a possibility.
Great. What are you seeing, Hunter?
Yeah. A way to think about Bitwise is that we're sort of an agent on behalf of our clients, of investors. So we spend time understanding, meeting with developers, studying developments in the space, and we help our clients understand them so they can say, I want to have exposure to the space, I want to participate in Bitcoin, but I don't have time to study it myself. So we will go out and we'll meet with Robin from BitVM, or we'll spend time with Michael from Bitcoin Core, and then try to relay that in a package that is understandable and time efficient. But it also works the other way. So we want Bitcoin and we want the ecosystem to be successful. And when we see moments where we can advocate for something that we think is good for the ecosystem and good for investors, we will play that role. So to give you an example, we worked with our Bitcoin custodian to consult with them. They're very competent and talented, but to talk through with them why they should upgrade their Bitcoin wallet addresses from traditional SegWit to Taproot. And over the course of about 2 months this year, they rolled that out. And we advocated for that because we thought that was the best thing, and then we went in and worked to have that happen. We thought that just sort of Bitcoin is so powerful as a distributed public ledger. That's obviously why everyone is interested. It's introduced something new. We thought that you should be able to, while we do want to put it in the conventional Tupperware, so to speak, of the ETP, we can do better because it's a public ledger. So we worked with our counterparties to be able to publish the public wallet addresses of the Bitcoin held in the ETP so that any investor can confirm for themselves that the Bitcoin is there. There's a company here called Hoseki who we've worked with to do an attestation that the Bitcoin is there. So the way that we play a role with these things is we try to spend time with developers, with companies in the ecosystem. We try to both, in one direction, understand what they're doing so we can be a helpful educator to our clients who have a limited amount of time. And from the other dimension, we try to advance or encourage development in the direction that we think will help the space really flourish. We're rooting for investors and we're rooting for the ecosystem. And so we sort of sit in between a lot of different things. And we're ultimately open architecture. So we will work with the best counterparties and service providers, et cetera. But we play that role with them usually.
Great, thanks. So maybe back to you, Puneet, and let's turn to the investment banking side, right? Like, what a lot of these large banks are known for, big margin producers. Citi, partnered with us on our round of last two converts and underwrote it. First bulge bracket bank that actually underwrote a financing specifically for the purpose of put it into Bitcoin. So thank you for that. What are you seeing from the investment banking side? Are the big banks starting to open up and thinking about productizing things specific to Bitcoin?
Yeah, we've been kind of open in terms of working with select clients and kind of from a capital market strategic advisory perspective. Actually, Citi led, including MicroStrategy, the last three of the largest issuances in this space, almost $2.7 billion raised. To support in the support of the ecosystem through the capital market perspective. So that has been a very fascinating journey. We do think that this sector requires kind of capital creation to happen in different formats, and definitely very supportive of working. Through the work we do across the domain, we build a lot of expertise as well, which is very meaningful for the investment banking team to leverage, because then kind of they have the same infrastructure supporting the bank available to them in terms of their engagement in the sector. So definitely pioneering a lot of work in that space.
And what about you, Matt and Hunter? What do you see as far as some of these larger banks starting to offer Bitcoin-specific products, underwriting Bitcoin-specific loans? Do you see this as an important part of the evolution?
I think the first wave here is going to be just on their wealth side, right? Getting the products available for advisory, which was talked about earlier. I think it takes a certain leadership culture and a certain vision for adoption inside these bigger institutions. And it's not always convenient to kind of have a 10-year view at all times on something like this. So we'll see how it goes. Some firms are way more progressive on this than other firms, right? Other firms are kind of just, see it when I see it. But others are very, they want to partner with us. They want to get educated, like firms like Fidelity and Bitwise have been doing with many of these firms. And they're looking for just, guidance in the space and how to do it in a risk-averse manner and give their clients what they need. So I think it just takes time. I think about that chart that Michael Saylor showed earlier, where it was the crazy 4 years we just went through, and the launch of the ETPs kind of ended that era. I'd argue right now is like the age of education, right? It's firms like Fidelity and Bitwise and others, doing that yeoman's work of running around the country, educating home offices, these financial institutions, advisors, and others. Just now is the time, right? Now is the time. Here's why. It's not going away. This isn't just drug dealer type money, right? There's an actual portfolio use case here, right? It's a disruptive technology. It's liquid. I think there's multiple reasons we can hit on now on the education side. And I think that's the burden's on us now, right? We finally have the products we wanted for years here, right? Now the burden is on us to really help grow the market together. And I think that's a huge obligation, but it's a massive opportunity for us.
I agree with everything he said, and I think that wealth looks like will engage first because they ultimately want to serve their clients, and there are over 50 million Americans that own Bitcoin or are engaged with the space. And we've seen a lot of banks and broker-dealers move faster than is even conventional on that front. I think another impression that I have of a lot of financial institutions looking at the space is they have a lot of awareness and good understanding and information. And then there are two challenges. Time constraint. Again, there's a lot of other priorities. They are who they are because of everything else besides Bitcoin. And the second is lining up a clean shot. And I don't know if this would resonate with you, but there's so many possibilities that sometimes there's a question of, okay, but what is the specific thing we should do for what customer and on what time frame? And so, for instance, I think right now you're starting to see that tokenizing assets is starting to look like a clean shot or an application or use case of the broader set of capabilities that might be one that's worth pushing forward and activating around. And so I think as clean shots emerge, I think being an AP is another clean shot that I think many say, okay, you know what, that is actually an action that looks straightforward. We understand the economic implications. We understand how to do that. So I think that there will be these moments because a lot of the financial institutions are so well informed, but they can't try everything. When you start to see clean shots, I think you'll see many people make a lot more progress in a spurt because they can now understand how to underwrite the opportunity, the risks, and so on and so forth, but are paying very close attention to look for those.
There's often Bitcoiners inside these firms too. And it's how do you identify them and help them evangelize within their firm to help advocate for what's going on here too. So that's the good thing is you tend to find the Bitcoiners at these firms and you can work with them. So.
And I agree with, I think, kind of just taking these clean shots where you can actually deliver something and which allows you to get out of the market quickly enough. And frankly, all of these things build on each other. When you build a capability that is kind of broad enough, then it allows you to launch one thing after the other. So we also have this capability portfolio approach to say what we can do now. But that doesn't mean that we don't build capabilities to do what we can do in future. So it is a step-by-step process, but starting to take certain clean shots, AP, the capital market transactions, the ETF work are immediately accessible and gonna get right alignment quickly. So that I think that's a good start. But at the same time, you need to kind of build capabilities which future-proof the evolution, future-proof the institution from an evolution in the space, and be ready for kind of what's to come in the future.
So I respect the methodical approach. And this conference isn't called Bitcoin for private wealth or Bitcoin for wealth managers. It's called Bitcoin for corporations. And maybe I love this clean shot idea, but everyone has a different view of what a clean shot is, right? Like, some of the best hockey players would say that narrow gap, that's a clean shot, right? And so I guess I'll push the conversation a little bit. When do we get banks thinking that underwriting a convert is not just a clean shot? Right now we want, getting folks to do it. I feel like just like you're talking about getting banks to be an AP, sometimes you're having to ask and where really they're the ones selling you services, right? So when do we get to the point where banks are pushing the services versus, going through the risk committee 18 times and saying, yeah, I guess we'll work with you? Like, when does that change occur? And when did they start seeing these simple things as clean shots?
Yeah, but I think when you say clean shot, these are also scalable opportunities. This is not that, this is one and done. Frankly, in my portfolio of initiatives, there are things which need to scale. But there are things we need to build. Then there are things we need to innovate, which are kind of further out. So we're thinking through scaling as well. So it's not just, you do one and gone. You actually need to scale a lot of these things because that's when the true value comes into the ecosystem, otherwise not worth it. And at the same time, you kind of keep building. So I think you think of scaling, you think of building, you think of innovating all together as part of the overall portfolio, which finally kind of goes from one stage to another. As you build, you launch, you scale. You innovate, to you build, to you launch and scale. So ultimately, the idea should be that you scale many of these opportunities, and all of this should be scalable, otherwise not really worth it.
What do you guys think?
I mean, nobody wants to be wrong, right? So I think victory begets victory. I think a firm like you guys doing it first and working with a firm like Citi is showing the way. And it's going to take time, but I think many folks are going to watch this space and see how it plays out over time, and then maybe they'll be more open to the next offering that goes.
I think for people who've been following the space for many years, a decade, it can be hard to recognize, but we're in a different chapter as of 2024. And from my vantage point, everything is now possible. And one of the peculiarities of specifically this moment, as we sit here in May, is that there are many things underway that are not public. We have a corporate that is putting Bitcoin onto their balance sheet. They're a sizable company using our ETF. It's not yet public. There are banks working on certain things. It's not yet public. So I think we're in a new chapter where a lot of this can become possible. And I agree with what was said, which is that you guys have pioneered so many things. And then if you start to see a second and a third and a fourth, then it's a scalable initiative for the bank and the counterparty. And that's when the flywheel starts to spin. And so I think that the next 12 and 18 months may not feel like the last 12 and 18. It may feel like things are suddenly happening that you thought would take a very long time to happen. And you're like, oh my gosh, they're launching that. And then you'll see another one and a third one, because I do think people are pretty well educated, they're attentive, they're looking for those opportunities, and there are things underway now. I also think that in the same way that the Bitcoin ETF took this valuable asset that was hard to move around and hold, and you put it in the Tupperware and suddenly you can do a lot with it. I do think that having some of the very large and valuable Bitcoin and digital asset companies go public will be another one of those moments that establishes. I think if you ask the average investor, they think that this is maybe sort of a very sort of small niche space, but there are probably $10 billion companies in this industry, and it's just that they're private because the IPO markets have been closed for a little while. But I think if Chainalysis goes out, if Circle goes out, if Kraken goes out, if Fireblocks goes out, and you wait a minute, there's a lot of companies, and they all want to do convertible bond issuances. Now that can be an important part of the business in the investment bank, and so I think that's one other moment to look for is when does the IPO window open again? Now, not all of those. I'm not recommending investing in those companies. I'm saying it from a development perspective that I think it will be another sort of step function of maturity and will open up more opportunities for the financial services, the traditional financial services industry.
I think you're spot on, by the way. I think there's activity that's been happening between January and now that isn't yet public.
That's true.
That whether it be done with big banks or done with smaller ones, and public companies, private companies have started to get in. And I think it was mentioned this morning, knowing you're going to do it and then actually doing it takes some time, and then doing it and then disclosing it takes some time. And I do think in the next 12 to 18 months, or maybe even sooner, we'll start to see that wave of adoption 100%. Of Bitcoin for corporations, which is a pretty exciting prospect, and your organizations have certainly led the way. So it's very exciting. Are there questions you want to ask each other? Wow.
I have a lot.
You didn't know I was going to do that.
Yeah. I'd be curious to ask one for you, which is how internally Fidelity is one of the most important companies in America. Has this year changed sort of how the equity team, or the fixed income team, or the commodities team, or the trade, how teams view FDAS and the group that has been chasing down this part of the market?
I think so. I think it's hard to ignore what happened the first quarter this year with these products. And I think people have, are paying attention now and spending more time learning about what this is, right? I think for a while, this topic may have been like a side of the desk type thing. I'll get to it. I'll learn about it at some point. But I do think the success here has awakened a lot of folks inside and outside financial services, right? So yeah, it's helpful, right? And it's a tailwind me and my team want to ride internally and just keep advocating and raising this up where we can, because over time this is going in one direction, right? It's going to continue to get adopted as an asset class over time, inside and outside Fidelity. So it's very encouraging, but it just takes time, unfortunately, right? These things take time. We have a massive brand, a lot to lose. We've massive trust with our clients and our investors. So everything we do is very methodical and thoughtful, and it just takes time. So.
And Hunter, if I can ask you, and you've been pioneer in this space, like even before ETFs, you had your fund, which has kind of done pretty well, available on many platforms. What's next? So after ETFs are done, after fund is done, how do you see? Is it like about scaling that business, embedding it and distributing it, or launching new services, new products? How do you really see the coming months?
For Bitwise?
Yeah, for Bitwise.
So Bitwise has been in the space for 6.5 years. I used to have beautifully colored hair before that, and now it's a bit different. I think that 2024 for Bitwise and for many will be boring to some who have followed Bitcoin for a long time. But I'll tell you, we are having, I've traveled every week since the beginning of January. We'll be at 2 sort of national conferences for wealth management firms in the next 2 weeks. The pace and the amount of time that most of our clients have for Bitcoin is a conversation maybe once every 2 months or once a month or once a quarter, but it's not once a day. And that means progress needs a moment to happen. Even, I remember after the Bitcoin ETF launched, there was a client who emailed us and said, this is incredibly exciting. We're going to make it a top priority to get this in client portfolios. Can we set up a conversation in March? That was January. You emailed me in January. So I think sometimes those who are enthusiastically engaged with the space, we're so used to this sort of rapid pace of development. Something's happening every week. You think it's the Bitcoin halving, and suddenly it's about runes. And there's just always, but with many of our clients, they're trying to fit it into 99 other things that they're doing. And so I think the story of this year will be the year that Bitcoin entered the mainstream. That for those who know the crossing the chasm model, that it moved from the early adopter to the early majority. And we're focused with a lot of our clients. They want to meet, they want to spend time, they want us to do a teach-in for, we've done a ton of academies and webinars for staff. So I think we'll be focused on that this year, and I'm excited for that. One other thing I would just say on this topic is, again, for people who've been in the Bitcoin space for a long time, there's so many things that I think are intuitive to everyone in this room. And one of my hopes working in this industry is that as Bitcoin enters the mainstream, we don't shed all of the detail. Meaning it doesn't just become a ticker with a price return history, and you forget that it's a public distributed ledger. People don't know what the halving is. They don't know that you can examine that ledger yourself, and as any actor can verify a balance or transact. I hope that as adoption goes, so goes understanding. And if that's what you hope for, it will require some time to be absorbed. So we're going to be focused on that. We of course do a lot of other things. We have alpha products, and we have again a large index fund. So we'll support clients however they want to participate. But I foresee this year a lot of time spent making sure people feel situated for Bitcoin to enter the first class citizenry.
Great. So with that, so we'll just sort of see people gradually get involved this year. Last year, sitting here, if someone would say, what am I most excited about with the institutional adoption of Bitcoin, it would have been the potential approval of a Bitcoin ETF. Now you're sitting here this year, what do you look at a year out that you're saying, this is the one thing that I'm most excited about when it comes to institutional adoption of Bitcoin?
I mean, it's going to be these massive wirehouse type firms approving these things. We're talking, 25 to 40 trillion based on how you count the capital that will then be able to potentially touch Bitcoin, right? In a compliant, integrated, seamless manner, right? 'Cause that was always a hiccup for years, right? Hunter and I would run around, this is great, but it doesn't integrate into my workflow or whatever. I can't rebalance easily. I can't bill on it. This Tupperware chassis is beautiful, right? You can integrate it easily alongside other assets. So I think that is what I'm most excited about. Because once you're there, there's other bank shots, right? Home office models that control hundreds of billions in assets of these firms, right? So there's so many ways Bitcoin can get integrated on these platforms once it kind of gets the green light. So that's what I'm focused on.
Yes. Go ahead.
I'll just say I'm excited there are a lot of people across America at RIAs, at banks, at other firms who have been sort of trying to educate their firm and help their firm see the opportunity, and I'm excited for those people to be heroes. I mean, it's felt like for a long time these people have fought a thankless battle. It's not that not the most celebrated thing to do internally, and I think that people are going to look back and say they made sure that we got into the internet and we didn't end up being Sears. Thank God for that person. And man, they were unappreciated for a little while. So I know a ton of these people across the country, and it has been thankless for a long time. So I would just add that dimension, which is there are a lot of people like everyone in this room inside of these organizations trying to figure out how to pull their organizations into a clean shot at the future, and I can't wait for them to be celebrated.
Yeah, I would kind of say maturity of the asset class itself, which brings in a lot of topics. How do you access? You want to direct access, you want through ETFs, you want through futures, you want some kind of derivative product. I think the maturity of that asset class and the access which comes with it, based on each one's individual views of this, I think that is going to be very meaningful. I can see that kind of you just call Bitcoin, but now you can have ETF, but then you can do futures. Maybe you can do NDFs on them. Maybe you can do some kind of structured note. Depending upon how you want to engage with an asset class, actually makes the market very mature. That makes kind of price discovery much more mature. So I do see accessibility, market maturity over the next 12 months to be very meaningful based on the initiatives which I see happening across the traditional financial institutions, crypto native firms, corporations, asset managers. So I think that's going to be exciting.
You want to know what I'm excited about?
Yes, sir.
And I'll tell you, I'm notoriously bad at predicting timing. In 2021, I remember we had this conference online, and I was convinced that a major corporate tech company was going to put Bitcoin on their balance sheet sometime in 2021, and I was wrong. This year, I think we'll call it a Fortune 100 company disclosing a material part of their balance sheet with Bitcoin. And that would be very exciting for us, for me, for the work that you've all done. So, gentlemen, I just want to thank you for the conversation, for the support you've had for Bitcoin, and for all the work that you're doing. Thank you.
Right.
Thank you.
Thank you. Nice block. Nice show.
Thank you. Thank you.
That was great. Super interesting. You know, something that Hunter said really resonated with me because I come from a background of news, which was 24/7. I could have gotten a call at any time. You know, something breaks, I have to run and respond to it. And now Bitcoin's 24/7 too, so keeps me up a lot, but in a good way. All right, the next talk is about regulations. We're going to have a regulatory roundtable about shaping digital assets. The moderator is going to be Ming, Shao, Senior Executive Vice President and General Counsel for MicroStrategy. And the panelists are Dax Hansen, who's a partner at Perkins Coie, Neel Maitra, a partner at Deckert, and Amy Park, a partner at Deloitte. Welcome.
You guys ready? Hello, my name is Ming Shao. I'm the General Counsel at MicroStrategy. Welcome to the Regulatory Roundtable. You know, when we were backstage just now, about ready to come out, I was thinking, when you're a lawyer or an accountant, as we all are, and you're about to conduct a discussion on regulatory topics in the middle of the afternoon, after people have just had a big lunch probably, I don't know who put us in this slot, you sometimes get concerned that regulatory topics are going to cause sleepiness in the audience. But you know what? I don't think that's going to be a problem today. And the reason is that the topics that we're going to talk about are some of the most exciting and consequential to the digital asset industry taking place to date. And many of these topics are topics that all of you have read about in the general press. You certainly heard about some of them here at this conference. Think the SEC's recent approval of spot Bitcoin ETPs, right? Think about a topic that we talked about with Amy last year, which came to fruition at the end of 2023, which is the adoption of new rules that effectively fix, to a large extent, some of the problematic accounting treatment of Bitcoin held on a corporate's balance sheet. We're going to be talking about issues that are very much undecided at this point, but when they do get decided, are going to have a tremendous impact on the digital industry. Think the SEC's lawsuit against Coinbase or Ripple. Sure. Think about the SEC's review, which is currently underway, regarding the application for spot Ether ETPs, right? A lot of really consequential things going on. And I'm hopeful that we're going to have time near the end of this discussion to talk more generally about legal considerations that face businesses which are interested in starting or conducting, say, Bitcoin-related application businesses. Because the environment there, the regulatory environment, is becoming in some ways more challenging for them, not less challenging, even though there's been some progress and clarification in other ways, right? So very exciting agenda. And to help us understand these topics, understand where they're going, we've got up here 3 experts. And they're just not any experts. I've invited them to this panel because they constitute
the core of the external team that has been advising MicroStrategy, in some cases from the beginning of our Bitcoin strategy. You're not going to find, I think, more engaging expert participants in this discussion for these topics than these three. So I want to introduce briefly each one of them because I think it's important that you understand their background so that you can understand better their perspectives that they bring to these topics. The first is Neel Maitra, sitting here to my left. First of all, congratulations to Neel. He just moved to a new law firm, Deckert,
Thank you.
Based in Washington, D.C. Neel has been sort of my go-to advisor on what the SEC is doing and what the implications are for our Bitcoin strategy and for Bitcoin generally. Prior to 2022, when he moved into private practice, Neel was the senior special counsel and crypto specialist at the Division of Trading and Markets at the SEC. Given the number of SEC matters that we're going to be talking about today, I'm pretty sure everybody's going to be very interested in what Neel has to say. So welcome, Neel.
Thank you.
Next up is Dax, partner at Perkins Coie. If there is an OG crypto attorney, Dax is really that person. He started advising on digital assets pretty much from the very beginning, beginning in 2010 or so. He's currently the head of fintech practice at Perkins Coie. Thank you so much, Dax, for all of your support over the years, and thanks for being here.
Thank you.
And then finally, we have Amy Park. She's a audit and assurance partner at Deloitte & Touche, LLP, in their blockchain and digital assets practice. She's also spent time as a practice fellow at the Financial Accounting Standards Board. Like Dax, she's also been alongside MicroStrategy from the very beginning. So thank you, Amy, for being here, and thank you for being in a discussion with a bunch of lawyers. So thank you. I want to start off this discussion with what I think is the biggest regulatory development that's occurred since our panel last year, and that is the big legal domino that fell in January with the SEC's approval of spot Bitcoin ETPs. And I want to start with Neel, because Neel, you were at the SEC for some of those years that led up to the SEC's decision. And I want to ask you, was this a grudging approval? Was it just good news for Bitcoin, or can you see some good signals in there for the digital asset industry generally?
Thank you, Ming. It's wonderful to be here back at MicroStrategy 2024 with you and my fellow panelists. And before we get too happy, let me quickly answer your question and say, yes, it was grudging, and it is just for Bitcoin, and it's not good news for crypto generally, or at least I wouldn't read it that way. And I think, a couple things to bear in mind. Firstly, the SEC spent a whole lot of time rejecting these things, these Bitcoin ETPs, spent about 6 years rejecting these things before they finally got taken to court. And they got taken to court because they'd allowed some Bitcoin futures ETPs to sort of go live. And people started saying, well, if the futures products are okay, why are the spot products not okay? And the DC Circuit kind of agreed with that. It said, these markets seem to be pretty closely correlated. Why are you letting the futures products go ahead and not the spot? And it didn't say you have to let the spot go ahead, but it did say you got to tell us why, or you got to substantiate your decision. And even when the decision went back to the SEC, I thought that they'd still reject the Bitcoin spot ETPs, but they didn't. They went ahead and approved. But when they approved, and bear in mind that this was a 3-2 vote, like the two Democratic commissioners other than Chair Gensler dissenting, and what Chair Gensler said when they approved it, Chair Gensler issued a statement, and he said, fine, we issued it. We had a court decision that kind of forced our hand, but bear in mind that firstly, unlike other commodities, Bitcoin can be used for many illicit purposes. Not quite sure why that was relevant, and then the second thing, don't read this as being approval for crypto assets more generally. So to summarize, very grudging, very limited. Not good news generally.
I'm glad you mentioned Chair Gensler because there's just so much discussion and speculation around him. He was, in a way, the tie-breaking vote, right? Yeah. Because without his vote, it just wouldn't have been approved. What does this say, in your view, you were at the SEC, about Gensler's true colors when it comes to Bitcoin and crypto generally?
That's a really interesting question. I think a couple things. I think firstly, a lot of people say that Chair Gensler sees Bitcoin as being different from other crypto assets. Now, I don't know whether that's true or not, but I think that there was also certainly the force of the court decision. It's a pretty clear decision, and it says 99% correlation between futures and spot. Why are you continuing to hold these back? That, plus I think there would have been several voices in the staff sort of saying, the markets are pretty well developed now. Why are we continuing to hold back the product? So I don't know what the precise lever was, but some combination of these factors probably led to the approvals. And I think the one thing to bear in mind also was how the SEC did the approvals, not just the fact that they did them, but how they did them. And they said, we don't want one fund getting approved and sort of sucking up all the money in the market. So you saw, I think about 11 Bitcoin ETPs approved at the same time. So that's really how this kind of happened, I think.
You mentioned correlation with the Bitcoin futures ETPs. And I keep thinking about the Ether applications that are out there, but we'll get to that in a moment. The grayscale case that you talked about and the SEC's review process of the spot Bitcoin ETP applications really put a spotlight on how these Bitcoin trading markets work. I guess I want to ask Dax for this because he's been around for probably the longest in the digital asset space among us here. What does the approval of the spot ETP say about the maturity of the institutional ecosystem around BTC?
I think that, Ming, for sure what it says is that from a regulatory or regulator and a market perspective, that Bitcoin is finally safe for retail investors, right? That people have been accessing Bitcoin through the unregulated spot markets for many years. But there have been Bitcoin ETP applications going all the way back to the Winklevoss application, I believe in 2013. And so we've been more than 10 years waiting for approval. And for many years, the SEC really rejected those applications. And one of the bases of rejection was that the market surveillance was inadequate. And I do think that personally, the fact that BlackRock has entered the space, Fidelity, WisdomTree, other public investment management firms have come in, but bringing the heft of those entities like BlackRock into the space really just, I think, gave everybody confidence that there is a market that can be safe, that there's tools for addressing the fraud and manipulation. And notwithstanding Chair Gensler's comments that there are issues with Bitcoin, that it can be policed. So this is a big deal, and it really does provide some legitimization for the space and a lot of validation for the pioneers in the Bitcoin space.
Neel, as a former SEC attorney, what is your view? Do you have anything to add to that?
I got to agree. I got to agree. I think there's 2 points that I would mention. Institutionalization, but specific benefits. I think it clarifies certain standards around things like custody. For example, each of these products has a custodian, has sort of publicly stated how it custodies these products and sort of takes steps against loss. More importantly, I think, look what this does. This approval sort of ties the traditional securities markets to the crypto exchanges. It creates a link between them because the products trading on these exchanges, these ETPs, they have to go to Coinbase, they have to go to Kraken, they have to go to Gemini, other platforms to kind of source their Bitcoin. And so to that extent, they're tied, and that sort of creates a way forward for, well, not quite regulation, but certainly for greater surveillance, greater linkaging between the regulated and the crypto markets.
Yeah, it's fascinating you mentioned Coinbase, and we know that the SEC has a lawsuit going on against Coinbase, and we'll get to that in a moment. But in this context, I can't help but think about Ether, right? A lot of people who are Bitcoin supporters are also following what's going on with this Ether ETP application, right? Because if it gets approved, some think that maybe money may flow a little bit out of Bitcoin into Ether, at least temporarily. And I think a couple of weeks ago, or maybe a few weeks ago, people were generally thinking sort of plausibly that maybe Ether is going to follow Bitcoin in that regard, right? But just recently, maybe in the last few days, we've heard about some things in the news that sort of cast doubt on that, right? And there's the consensus lawsuit now against the SEC, and we found out about the Wells notice that they had received, I think, in early April sometime. What is your take on this? What's going on?
Well, I'm a lawyer, so I'll never give you a clear answer, but the Ether ETPs are going to be denied. They're not going to make it. At least, they're going to be rejected this time around. And I think the SEC is lining up to reject the Ether ETPs. We can speculate on what the reasons are, what reasons it's going to put forward. I am pretty sure that any denial will sort of be challenged by the sponsors and others of these products. And I think that the SEC will put forward some decisions of some reasons for its decision. But in reality, it's going to be the thing that's at the back of the SEC's mind is, if we open the door to Ether, what else could come through? And there are distinctions between Bitcoin and Ether. Like, there's not an identifiable founder or a group of founders. There are distinctions about not having a foundation sort of associated with Bitcoin in the same way that there is with Ether. The sort of the information asymmetries that the SEC sometimes talked about. But I think the key is, the SEC's inarticulate premise is, if we open the door to Ether, what else could come through? And so I think Ether is going to be denied.
Well, that's a very strong view and a very strong prediction. I know that in preparing for this panel, I was talking to Dax yesterday. I think, Dax, you have a little bit more of a nuanced view on this, and so it'd probably be a good counterpoint to share if you could.
Sure. I mean, look, I think that the SEC may very well reject the Ether ETP, but when it comes right down to it, it's really hard on a legal basis to distinguish Bitcoin and Ether based on the guidance that the SEC has given us, right? Mm-hmm. And so all I'd say is that, like, it is a big deal to deny Ether on the basis of what it is. We talked earlier about the market and, like, the surveillance of that market, right? And so the Ether market obviously is lagging in time from Bitcoin because it came later, right? But if you're looking at the asset itself, if you just review the SEC's 2019 investment contract framework, without any weighting, by the way, from the SEC, you could reach a conclusion that Bitcoin is a security and Ether is a security, right? And you can also maybe reach a conclusion that neither of them are, but more likely that all of them are. And so then it just comes back to reading the tea leaves. I think, as Neel pointed out, I agree with Neel, that there are some differences in how Ether is structured, right? And just the fact that just in the last couple of years, Ether has moved from a proof of work consensus method to a proof of stake, and that actually influenced the rate of issuance of Ether in terms of its supply, that there is a group of people who are, to some extent, at least leading the development of Ether, right? And this is very much a decentralized protocol, but with Bitcoin, even though there are core developers, there have been fewer changes made to the Bitcoin, so the overall infrastructure. We heard some of the different proposals have been made to Bitcoin. Yes, it's becoming more efficient, but it hasn't been widely changed as much as it has with Ether. So I think it's hard to tell here, but Neel mentioned information asymmetries is one of the questions that I think that always comes up in investment contract context, is whether people are making decisions about their investment based on the managerial efforts of other people. Right. And if there are not any efforts taken by other people, then there are not information asymmetries. Everybody has the same information to operate on. And as we heard end of yesterday, Bitcoin is very neutral. It kind of is what it is. We heard that today as well, right? And I think that could be factoring into the distinction between Bitcoin and Ether.
I want to do a little bit of a thought experiment here, given that it sounds like the Ether ETP is going to be rejected. If they are rejected on the grounds that ETH is actually a security, right, Neel? Can you tell us what that would mean for Ether? I'm not saying that that's going to happen. They could use different grounds.
Yeah.
But if they should come out and just say that Ether is a security, what's that going to do to Ether and other digital assets like Ether?
I'm going to try to choose my words carefully. I think it would be devastating. I think it would be tough. I mean, it would just roil the markets. I mean, so many things would just be up in the air. Firstly, all the entities trading Ether on a regular basis, platforms trading it would have to become exchanges. Everybody trading it on a regular basis might have to become a broker. But then what does Ether do? It would have to then register. Ether would have to be offers of Ether would have to be registered as securities, or you'd have to find some kind of exemption for them. And then even if you could do that, who's going to be doing the registering? Who are the issuers of Ether at this particular point? And then going forward, like, what do we do about all the Ether that's out there trading already? Like, how do we bring that in? Do the people who bought Ether, do they have some kind of claim against the SEC? It's just going to be completely up in the air. I'll put it as pithily as I can. This is precisely what the SEC typically tries to avoid, which is tremendous disruption to the markets and potentially significant harm to retail investors.
Wow, this is going to be fascinating to see how this plays out eventually.
Sure.
Speaking of big legal dominoes, though, there are some out there that haven't fallen yet, right? And in my view, one of the big ones is the Coinbase lawsuit that the SEC has brought. This is a suit that the SEC filed against Coinbase, alleging that Coinbase operates an illegal, unregistered securities exchange, among other things.
Sure.
I guess, going back again to Neel and Dax, and we're going to get to Amy eventually here. Where's that case going? Because there have been some developments. This case has been going on for a while, but there have been some developments.
So I think the Southern District of New York recently rejected Coinbase's motion to dismiss. Essentially, Coinbase tried to dismiss the SEC's case. And I think this is, and the court disagreed. The court said the SEC has pled its case sufficiently. There are, the pleadings are sufficient to sort of make it plausible that you might be an unregistered broker, unregistered exchange, unregistered clearing agency. And this is a significant setback. I don't think there's any denying that. It's hard for me to see what Coinbase can sort of put forward at this, at the merit stage that kind of significantly alters the result. And I think that, anyone who's read the decision, it's sort of well written, it's cogent, it's detailed, and it's hard to see the Second Circuit sort of overturning that. So I think this is a significant setback. But what does that mean? Does that mean I would never bet against Coinbase? There's a lot of litigation left to do, and even if they lose here, even if they lose at the Second Circuit, they will go all the way to the Supreme Court. And I think this particular Supreme Court, which is often very skeptical about administrative agency actions, could be very receptive to a lot of Coinbase claims. Coinbase is making some very sophisticated claims. It's making the claims that many of the assets that it's trading, are not securities, but it's also making the claim that there should be a different framework for these securities. It's kind of a policy claim that it's making as well. And then the final thing I'll say is, let's suppose, as a thought experiment, just carrying this forward, it loses, right? It ultimately loses. Even then, it would have the right to carry on its Bitcoin and Ethereum business, because assuming Ether is not a security, because those are non-securities, and that I think would still be the bulk of its business. So Coinbase is, I would say, despite this very significant setback, still in a formidable position, and I think there is a lot of litigation left to go.
I know, Dax, you've been following that case as well because we talked about it, recently. Do you share that view? I mean, Neel's coming out pretty strong here that Coinbase is just probably going to lose at least at the lower court level, and maybe even at the appellate level.
You may be spotting a little bit of a trend in how I like to riff with Neel here, but I think it's still too early to tell. Right. Too early to call it, right? Really more too early to call it. That this is just a motion to dismiss stage, right? Like, this has not been litigated on the merits. It's just that the judge is just saying, look, the SEC has given sufficient information to convince us that this is a case that should be heard. But now we have to go deal with the merits. We have to deal with the facts. There are lots of open questions around secondary markets. There were only a few assets that were named in the SEC's complaint, right? There's quite a wide variety of the assets that are trading on Coinbase, for instance, right? And so there are legitimate questions that need to be resolved. There's also, I agree with Neel, at the appellate level, there's a lot of disagreement amongst the courts themselves that are ultimately going to need to be harmonized by higher levels of judicial decisions. But one thing that I can say is that to the extent this drags on and we have more litigation against exchanges, secondary platforms on multi-asset offerings, that the innovators, the companies are just going to move away from the United States, right? Like this has been a tough regulatory environment on the securities front for a very, very long time. And there is just a real drain on the innovation and the ability to make money as a going concern in this regulatory environment.
Speaking of secondary exchanges, which you just mentioned, it reminds me of the other big legal domino that has yet to fall, and that's the Ripple case, right? Which focuses specifically on whether XRP is a security, right? It seems like in that case or in some related cases on that topic, the courts can't agree on what the right approach is. I was a little surprised by that in reading, for example, Judge Torres's opinion, one of the first ones that came out. Neel, can you explain what's going on here? Because this is pretty confusing. In fact, it almost represents, to think a lot of other people, that there is not a single way for the SEC to look at this.
Yeah, I think you're absolutely right, Ming, that this has been an area of judicial disagreement. And it's funny because all three of the judges who are relevant here are in the Southern District of New York. So in a single federal district, the judges can't agree on what how these secondary trading. How the secondary trading of crypto should be treated. And it's helpful maybe to just set the stage a little bit here and say, the question here is, Judge Torres says, in the primary offering of XRP, people know they're buying from Ripple and they're relying on Ripple's efforts to make a profit for them. So that makes it a security. But when you're buying on an exchange, you don't know who you're buying it from. These transactions are what she called blind bid-ask transactions by often very unsophisticated investors who aren't parsing the marketing or stuff like that very closely. They don't have any expectations from Ripple in the same way, according to Judge Torres, that primary purchasers do. So she says secondary trading of crypto is different and doesn't involve securities. But then you've got Judge Rakoff in the Terra case, which involves Do Kwon, and then you've got recently Judge Faya in the Coinbase decision, and they both take the view that, no, if you look at the amount of marketing that these crypto companies are doing and the kind of marketing they're doing, they're reaching both primary and secondary investors, and so secondary trading of crypto is also securities trading. And so they disagree with Judge Torres. So I think it's inevitable that this is going to go to the Second Circuit and maybe even further, who knows. But so there's a lot left to go in this particular decision, just like with Coinbase. I think you could see it go all the way. And I think the other thing that I would sort of say here is that the SEC doesn't see I think the SEC doesn't necessarily see the Ripple case as being a failure of its theory that secondary trading of crypto is securities trading. They just see it as maybe we couldn't put forward the evidence sufficiently well to convince the court, and we'll fix that at the Second Circuit level. So, again, just to echo Dax, lots of litigation left on this one.
Well, there's clearly still a lot of legal activity, litigation, controversy in the United States around digital assets. But digital assets like Bitcoin are global, right? And it's pretty clear there are other countries out there, the EU, for example, that are really taking a very different approach, right? Dax, I know you've been following that, and you've talked with MicroStrategy a little bit about that. What's happening there, and could the U.S. actually become a much less attractive place for digital assets?
Yes. So the EU now has broad regulatory clarity that the U.S. lacks. The EU developed some legislation, pretty expansive legislation, I think prompted by the Libre Diem project, actually, where in the EU they categorized these different types of assets. And they sorted out these tokens into crypto assets, things like Bitcoin and Ether and what we would have called utility tokens. There are e-money tokens that are meant to be payment tokens that are tied to one fiat currency. This would be like a stable coin like USDC. And then there are other asset reference tokens, which are tokens that have reference to a basket of currencies, either fiat or digital assets. And there are different rules and regulations around each of those, and separating those from, or distinguishing those three from really financial instruments, which are regulated securities. And there's a much more narrow definition of a security in Europe, and frankly, most places in the world outside of the US and Canada. And so that big drag that we have of the securities issues in the United States is resolved in the EU, right? And so that does make the US less attractive. We have clarity on probably most other issues that relate to digital assets in other areas, like commodities, for instance, money transmission, but we don't have it on the securities front. And so that does lead to, I think, like jurisdictional selection, where innovators and businesses who are hiring people and launching products get to go forum shopping for some place that's friendly for them. And that may not be the United States, but it's just worth noting that in the United States, like, this is the largest market. And so projects may launch outside the United States, where they are going to need to come back in. But even those projects launched overseas should be taking into account US laws because they ultimately want to end up back here.
This was a great discussion on some of these large-scale legal topics. I want to switch for a bit to accounting, where, similarly, a big accounting domino fell in December when FASB issued new rules that changed the accounting treatment of certain crypto assets like Bitcoin, right? I know, Amy, you talked a little bit about that last year at this panel, or the equivalent panel from last year. Can you briefly describe the changes that occurred and tell us your assessment of the significance of it?
Yeah, happy to, Ming. And you say a domino fell. I have little kids, so I'm seeing hearts and rainbows and balloons, because this is a huge win for the digital assets industry. And you can see the smile on my face. Last year, I was like half smiling because we got a little bit of a preview, but this is great news. And usually when I used to talk to companies about the current accounting model, pre this new accounting model, like, I felt like I was booed off the stage. People wanted to throw rotten tomatoes at me, but now I have some good news to share. And so the big headlines here is fair value. And I think what's important to really understand why this is so significant and why it's a huge win is to really understand what today's model or what the old model was like. And so when you're looking at the accounting rules, you have to kind of go by the definitions to say, where does something like holding Bitcoin fall within the definitions in the accounting guidance? And so you look at things like cash equivalents, it doesn't meet the definition of that. Financial instrument, it doesn't meet the definition of that. Inventory actually in accounting rules need to be tangible. This is not tangible. So you almost defaulted to an intangible asset. And you're kind of like, well, when I think about accounting intangible assets, I'm like, IP, customer lists, patents. I don't think about something like Bitcoin. And all of those things that I named before, you don't actually actively trade and like exchange that, right? It's usually held on your books for a while. And so you are stuck in this model where it's an indefinite lived intangible asset. It doesn't have any life to it. And so you have to account for it at the cost that you acquired it at, which hopefully is fair value on day one. And then you have to assess it for impairment. And what does that mean? That basically means what I hold it at. If the fair value is something lower, then I need to like constantly write it down. But I can never write it up. So let's just take some basic numbers, and I wrote these down so I can remember. But January 1, 2024, and I'm going to round here because we can round with Bitcoin. The Bitcoin price was around 44,000. So let's say I bought it on January 1 at 44,000. DAX decides to buy it on March 31st, 2024. The price was 71,000. So he paid 71,000, I paid 44,000. Well, between January and March, the price went down to as low as around 38,000. So on January 1st, I recorded at 44,000. And then when it went down to 38,000, I had to write it down to 38,000. And then it comes time for my Q. I'm a calendar year end. So my first quarter 10Q, 331. I'm reporting it at that 38,000, my one Bitcoin. DAX reports it at 71,000. If we were to both try to sell it on that same day, we would probably get the same fair value. But on my books, it's at 38. On his books, it's at 71. And so for an asset that's actively traded like Bitcoin, companies were having a really hard time with, man, you got to keep monitoring. And let's be real, right? The price doesn't stay flat. It goes up and down. So you have to keep monitoring to see what the price is. Has it gone down? I have to keep writing it down. Will it recovered? Sorry, you don't get to get the recoveries until you actually sell. And so what we had was a model that really didn't reflect the economics of what you were holding or your asset. And so when you think about financial statements from an accounting lens, you always want to know, like, it should tell you the economics of what you have, your assets and your liabilities. And it was really, really difficult for people who were, trying to read financial statements to say, well, Amy and Dax, they both hold one Bitcoin. They don't necessarily know that I bought mine on January 1st and that he bought his on March 31st, but his looks so much more valuable than mine. But in reality, it's not. And so that's why the current model was really, really broken, and why now, if we move to fair value on 331, both of our financial statements will have something roughly around the 71,000. So it's a huge win. It makes the burden on preparers or companies who are putting together their financial statements. A lot of companies who hold Bitcoin had to do one set of books for financial statement and accounting reporting purposes, and then another set of books to talk to their investors of like, well, no, this is what it actually is. And that duplicative nature was just really burdensome, really costly. Like I said, for investors, it was very difficult to really understand. And so this is a huge win. The new ASU came out in December of 2023, so it just came out. It's effective for companies that have a calendar year end in 2025. So it actually has a pretty long effective date. And the FASB does that intentionally because maybe some companies, it takes some time to put together the processes or whatnot. They want to give companies time to actually adopt new accounting standards. But you could early adopt it. So we have seen some companies out there. I think Salman today from Marathon had talked about their company or his company early adopting. And so you'll see some companies that are now starting to report their digital assets at fair value. A couple of things, though, that I want to highlight. So the FASB was really, really quick in getting the standard out. But because they were quick, they couldn't necessarily put everything in. And so there will be some challenges, particularly related to scope, of like, are you in the scope of this new standard or not? For things like Bitcoin and Ether that we're talking a lot about today, those are all in. But when you start getting towards other assets like some of the ones that Dax just mentioned, the wrap tokens, utility tokens, I mean, there's going to be a lot of judgment in terms of figuring out, okay, should those be in or should they not be in? And again, the difference of being in or out of scope of this new standard is going to be pretty significant. I also want to say there's no such thing as a free lunch, ever. Though I think somebody today earlier said that there was something that was a free lunch. But there's no such thing as a free lunch here. Everybody wanted fair value. That's what you got, but it also comes at a cost. There's a lot of extra additional disclosure requirements that are now going to be required. And the reason behind that is a lot of the investors that basically gave feedback to the FASB said, it's really hard for me to understand what a company is doing related to their digital assets with the current intangible asset guidance and the current intangible asset disclosures. And so the FASB put in a lot of additional disclosure requirements. Companies are going to have to disclose a significant holdings table. So basically, if I hold Bitcoin and Ether, I can't just lump that and say, these are my digital assets. I have to actually show I hold Bitcoin, I hold Ether. You have to do a reconciliation. You'll still have to show your cost basis, your ins and outs. So there's a lot of additional extra disclosure requirements. And I think you'll see a lot of companies were really excited about, hey, I get to do fair value. But one of the things that I've been talking at least with many of our clients was think about these disclosure requirements. Do you have the right data and the processes in place to make sure that you have, you will be able to comply with these requirements, et cetera. And for a company that, like MicroStrategy, that holds one digital asset or one digital asset type, it may be easier. But if you think about some of the other companies that maybe hold many, many different types of digital assets, being able to get that information is going to be really, really critical. Some of the other highlights, though, I think that's interesting, Ming, is that by moving towards fair value, the FASB wasn't necessarily changing the nature of the asset. They still believe that it's an intangible asset. So it's not a financial instrument just because we're moving towards fair value. It's an intangible asset that now is being accounted for different than other intangible assets. So in the actual FASB guidance, it still falls within the intangible asset guidance. That actually is one of the criteria to be in scope. It has to be an intangible asset. And you have to present it separately from your other intangible assets, which makes sense. And so those are some of the things on the accounting side that's, I think, super exciting and a great win for the digital asset industry.
That was a very good explanation of the rule change, and I liked the numerical example that you gave. Let's probe a little bit further. Are there other things that can interplay with this new FASB guidance that people just need to keep in mind?
Yeah, so one of the things that the FASB did was they said you have to account for these assets at fair value, but they didn't create a new fair value methodology. They went with existing fair value. And a large reason of that is you don't want to create anything new necessarily. And then two, in order to get this guidance out as quick as they needed to, they basically had to default to the current existing fair value guidance. But digital assets are slightly different. And so when you think about fair value, there's some additional nuances that you're going to have to think through, and it's not necessarily that evident when you're just thinking about traditional securities. So, for example, you have to account for it at fair value based off of your principal market. That's the terminology that the accounting guidance uses. Well, for something like a security or a stock that's traded on one exchange, for example, like the New York Stock Exchange, you're going to go to fair value based off of the New York Stock Exchange price. Well, for Bitcoin and crypto, multiple exchanges. And so you have to actually go, and you can't have a rate, you can't have multiple exchanges as your principal market. It really needs to be one. And so you have to actually think through what is your principal market. So if DAX is a company, his principal market may be different than my principal market. Another thing is crypto never sleeps. I think we just heard 24/7, right? And so traditionally markets close, for securities at a certain time, 12/31, everybody's cutoff is the same time. But if you have crypto markets that go 24/7, is your cutoff at 5 p.m.? Is it a UTC time? So even 3/31, I said 71,000. Well, if DAX's cutoff is 7 p.m. and mine is 4 p.m., that could be a different number. So there's additional nuances that you have to think through, particularly around fair value. And the other thing I always like to say is, I'm certainly not a tax expert, but I also know that taxes related to digital assets and accounting don't all necessarily jive, the tax rules, right? And so there are book-to-tax differences that companies are going to have to think through. So unrealized gains and losses versus realized gains and losses, those usually create book-to-tax differences. That concept of principal market that I just talked about, tax rules have a completely different rule. They actually, I believe, look to aggregators. So look to multiple different price points to come up with what your principal market is. So that could be different depending on what the volatility is of market-to-market pricing. And then also how companies, when they're early adopting, when you adopt the guidance, you have to account for basically any change from what you had it on your books to the 1/1 beginning of the fiscal year price, and that all goes to retained earnings. And so as companies think about the new corporate AMT rules, that could potentially have an impact on how those unrealized gains or losses are potentially maybe triggering a corporate AMT or maybe not triggering corporate AMT. So I always say accounting and tax with crypto, you need to think about those two and make sure that you have those straight, because they may not all all the time be the same.
That's such a great and helpful explanation. I'm hoping we can fit in one more accounting topic here. I know we're a little bit tight on time, and that's SAB 121. It's been getting a lot of press, including in Congress. Can you explain what that is briefly and why it's controversial? Touched on earlier today in some of the presentations.
We talked about it a little bit earlier today. So SAB 121 came out in March of 2022. It basically was a staff accounting bulletin from the SEC that says, if you are a company that is safeguarding, and I'm going to air quote that, crypto assets on behalf of somebody else, you now need to record a liability that's going to be recorded at the fair value of those crypto assets, with a corresponding asset that takes into account whether or not maybe those assets have been lost or loss events. What's really important, Ming, to understand, and I think Alex talked about this earlier today, is that this was issued by the SEC as a staff accounting bulletin. So SAB is staff accounting bulletin. That means that it wasn't an SEC rule. It didn't go through their normal rulemaking process. And I see Neel shaking his head, so what I'm saying is right. All it is a staff interpretation. And so it wasn't issued by the FASB either. And so it's a staff interpretation, but where we struggle is if your regulator tells you that this is how they are interpreting the accounting rules, it probably behooves you to follow what your regulator is telling you. Otherwise, your regulator will probably say, well, your accounting is incorrect. And so there's a little bit of noise out there, or maybe a lot of noise out there about, was this, the legitimacy of this, et cetera. But at the end of the day, it was a staff accounting bulletin that gave a pretty big change, I will say, to the accounting of companies that were potentially safeguarding. And I'd say that because before the SAB came out, most companies had to think through, do I control those assets? If I control those assets, those customer assets, for example, then they're on my books. If I don't control them, then they're off the books. Well, this is saying whether or not you control doesn't matter. You have to think through whether you're safeguarding them. And if you're safeguarding them, it's not that those assets come on your books. You have a safeguarding asset and liability on your books. Happens to be measured at the fair value of what those assets are. But that's a pretty big change. Like, you may say, well, asset equals liability, net zero. Why does it matter? But I think Alex talked about it pretty well this morning of, well, for certain entities, particularly regulated entities, it actually does matter. The gross up is a huge impact, particularly to regulatory capital. And so I think a lot of companies that were potentially thinking about moving into this space and trying to enter into some type of business where they were providing those types of assets or those types of capabilities to their customers were now almost prohibited from being able to do that because they may not be able to make some of their regulatory requirements. And so huge impact to the industry. I think we've seen as a result of that, many companies that were thinking about entering have basically stopped. And I think, well, there's probably more to come there, but the SAB itself doesn't actually define safeguarding, but our understanding is that the SEC has very broadly interpreted that. And the AICPA Digital Assets Working Group, of which I sit on, has issued some Q&As that basically are a result of direct conversations with the SEC staff about how they would think SAB 121 should be applied. So that's a helpful thing to look through if SAB 121 is potentially relevant to you or your company.
This discussion reminds me that there are some significant legal considerations on the operational side, for businesses that want to develop or launch Bitcoin, related applications or business lines. So I'd like to talk about that side, that is companies wishing to either start or conduct Bitcoin-related businesses, because there are considerations there that are important. Dax, you've been in sort of this space for a very long time. And so let's first start off, just very briefly, tell people what sort of use cases you're seeing as a legal practitioner, and then we can get into some of those main legal considerations.
Sure. So here's the use cases that I'm seeing, Ming, that really excite me. One is layer 2 applications that are built on the Bitcoin layer 1 blockchain, things like Lightning. Lightning excites me as a payments and technology lawyer with what it can do. If you were here yesterday, wow, like everyone should be looking at Lightning and what is your Lightning strategy, no matter who you are. Another one is Bitcoin ordinals. We've seen non-fungible tokens, NFTs, really in the Ethereum space and some other Solana and other blockchain smart contract type situations where we need tokens that are not all fungible, that can be a unique asset, a collectible, a title certificate. And there has been innovation around the Bitcoin blockchain that approximates the functionality of NFTs for tracking of non-fungible assets. I've seen a lot of innovation around wallets, especially like non-custodial wallets, and how those wallets might interact with other real-world financial services infrastructure. And then lastly, just leveraging the Bitcoin blockchain as the most trusted source of truth and common ledger for things like identity verifications for individuals or identifying devices or wallets.
So if you're a company that's wanting to start up a Bitcoin, say, related business line, what are some of the main legal considerations that you see? And this is going to segue eventually into what I understand is an increasingly challenging environment for companies that want to do that.
Sure. I mean, there's a punch list for me that first is like, go look at the regulatory requirements and figure out if what you're building touches on securities, commodities, money laundering, money transmission, anti-money laundering, or sanctions laws. Like, you got to just like scrub those for sure. There's other issues that can come up, but that's like the table stakes. And then just to figure out, when you're building applications, are you doing certain activities that are regulated, or are you partnering with service providers that are doing the regulations? In many instances, you might just be building a solution that leverages the services of a regulated entity. And so many times those responsibilities can be outsourced, but I will just tell you that it is harder to sort those responsibilities than you might think when you get into the very powerful and flexible technologies around like wallet maintenance and running nodes, for instance. Those lines get kind of blurry, but you need to make sure that someone's clearly minding the store. There's intellectual property issues. There's things like patent litigation, like MakerDAO, for instance, is dealing with patent litigation. How does a decentralized autonomous organization appear in court to defend itself from allegations of patent infringement? On the money transmission side, right now we have some really fascinating questions that also start to bleed into another core issue of just like developer liability, where we have Tornado Cash and we have Samurai Wallet, where the DOJ, Department of Justice, has gone after and arrested and seized properties related to non-custodial wallets that also have some privacy features that in these cases were promoted as helpful for criminals, right, mixing services, but nonetheless, these are non-custodial wallets in many cases. And so, but yet there's allegations it's money transmission. Well, there's the black letter law in the Bank Secrecy Act. You have to be receiving money and transmitting it to another person or location for it to be regulated. Yeah, but yet we have a pretty overly broad assertion here on the money transmission side. So those are some of the issues to figure out. And then once you have a product, to like draft clear terms of service and privacy policies, how all these things work. Often when there is not a centralized account, you turn up a lot of these kind of norms on their head. Lastly, Ming, I'll just note that when it comes to, though, just Bitcoin, if you're just holding Bitcoin on your treasury, for instance, many of these regulatory issues that I raised just don't apply. That those are your custodians, your brokers are going to be dealing with those issues, and you wouldn't be tripping into money transmission or licensing or need a BIT license for many of those activities.
Right, so you don't have to directly take on a lot of those responsibilities, but you do need to then select your partners and your vendors very carefully, right?
That's right.
I want to follow up here near the end on something that you've mentioned to me recently, which I found a little bit surprising and runs a bit counter to the positive clarification that has occurred on the accounting side and with respect to the approval of the spot Bitcoin ETPs, and that is that the regulatory environment for businesses that are interested in, or companies interested in starting some kind of a Bitcoin, say, application business, is actually getting tougher in some ways. In fact, you told me that just getting crypto businesses banked is an increasing challenge. How can this be? Why is this happening?
Well, I mean, we're in the midst of a crackdown on banks who are supporting crypto businesses and fintechs. In many ways, it's a little deja vu back to 2014 when there was regulatory clarity, but the banks weren't yet comfortable banking digital asset businesses. Many of the digital asset business, even though you may be focused on Bitcoin, you still need to have some TradFi partners. You may have operating accounts and you need to make payroll. So you need bank partners. But the bank regulators, the Office of Comptroller of the Currency, the Federal Reserve, the FDIC, is increasingly finding problems with how many of the banks, and often they're smaller, maybe community banks, are supporting these fintech and crypto businesses that are honestly struggling to deal with the onboarding and the customer verification and monitoring. And so these banks are receiving pretty onerous enforcement actions. And that's going to really cool their ability and their willingness to bank these companies that may be developing in Bitcoin and other digital assets. And then, Ming, since we were here last, we have some major banks that have just failed. Silvergate Bank, that was a major player for crypto businesses, is gone. Silicon Valley Bank, gone. Signature Bank, gone, right? And so there's just fewer banks all around. And this audience, I'd say the people who are developing in Bitcoin, need BlackRock-like banks. I mean, not that BlackRock is going to be banking them, but banks that offer bank accounts, retail accounts, and others, operating accounts, that are willing to get into this space to help support them.
So it's kind of like just as there was a BlackRock moment, so to speak, when it comes to the ETPs, right? Yeah. You're saying something like that is really needed on the banking side.
Neel, what are you seeing in this space?
I think I completely agree. I mean, we're in the traditional securities industry, TradFi, banks and broker-dealers have really been critical towards like good custodial practices, and that's sort of what encourages institutional adoption of an asset. When you know that you've got a safe custodial sort of setup in place, and I think that is just highlighted in its absence in crypto. So, the SEC has made it very, very difficult for broker-dealers to hold crypto. I've seen, although I'm not a banking lawyer, I've seen sort of similar difficulties on the banking side. We've seen Custodia recently with, the Wyoming federal courts failing to get a master account. And so I think, until we get a custodial solution sorted out with banks and broker-dealers, institutional adoption of crypto is going to be hindered or delayed. And now the SEC has proposed a safeguarding rule. It's kind of useful because it talks about what the conditions are under which investment advisors, in particular, can sort of hold crypto for their clients. But I think what the piece that misses is investment advisors may need to hold crypto for their clients in certain ways, but is the infrastructure in place to have that actually happen? And I'm not sure that the SEC actually sort of has fully assessed the landscape and the options that are available. So until that big piece gets sorted out, I think institutional adoption of crypto is going to be challenged.
Very quickly before we end, because what you just said is you've highlighted a bunch of challenges, right, in this environment. Dax, what is your sort of best piece of advice then for digital asset businesses in dealing with banks and custodians? Because we've got to offer somebody some guidance here.
I guess I'd say customer beware, know your partners, know who's holding your money, your assets, ask good questions. There are many fiduciaries or entities that should have had fiduciary obligations. FTX and Sam Bankman-Fried, who's now got 25 years in prison. Prime Trust that went to receivership and then bankruptcy because of, frankly, I think like mismanaging of keys to Bitcoin. Like these entities are supposed to be fiduciaries. Some of the early ones, really didn't have the right sort of controls. I'm not equating necessarily FTX to these entities that are here in the audience. I'm not, for sure. But these are entities that are custodying your assets. I mean, these are the crown jewels. And so ask a lot of questions, find out about audits, understand the security controls that they have in place, have an ongoing dialogue. Just expect to be part of that conversation around regulatory controls, understand where they are with their regulators, if they're receiving subpoenas and enforcement actions. Just treat them like good partners and expect them to be good partners too. And I'll just note that for the practicalities are that many of the custodians in the Bitcoin space are also just dealing with a large insurgence of interest in their services, and they are becoming more like some of the traditional custodians in with securities. And so they're trying to formalize their operations and their contracts. And so there's this necessarily little dance that goes on the allocation of liabilities and responsibilities here. And so these will just take sophisticated conversations to try to find the right place. But at the end of the day, these are custodians that are watching your money. That's what they sign up for. And I think that the customers should expect that the custodians and partners and your bank partners will deliver and safeguard your assets.
This reminds me to remind everybody else that MicroStrategy has done a large amount of learnings on those types of issues, legal issues, diligence issues. And we have open sourced a large deal of the materials that reflect our learnings. And you can find it on our Bitcoin for Corporations website. Just go there, it's at the bottom of the page. It includes, for example, our Bitcoin trading policy, our Treasury Reserve policy. I think there's a checklist for how you deal with vendors and exchange service providers and custodians. It can be very helpful for people who are looking to start or conduct some sort of a business, Bitcoin related business line. So with that, I want to thank our panelists for this discussion. We're unfortunately out of time. But if you have any other questions for us, obviously talk to our experts. Come find me. You can look for us after the conference. And I want to thank our presenters again for being up here and providing such insightful guidance. Thank you.
Thank you.
Thank you so much. And thank you for sticking around. This was arguably one of the most important panels that will impact the entire industry. So we're going to wrap it up this afternoon with our final talk for Bitcoin for Corporations. We're going to introduce the ultimate MicroStrategy trio here. Michael Saylor, Executive Chairman, Phong Lee, President and CEO, and Andrew Kang, Chief Financial Officer. Welcome them to the stage.
Last session, Michael, Andrew, thanks for doing this. So this session is called the Playbook for Bitcoin for Corporations. And with great timing and luck, Jack Dorsey just tweeted out the Playbook for Bitcoin for Corporations. We'll get into that a little bit later because I do think it's excellent timing. And it's great to see the partnership and the leadership from Block and from Jack and Michael Rouhani. If you're still in the audience, thank you, because I'm sure you had a big part of that also. So thank you to all. You are going to make this conversation a lot more fun and a lot easier. But let's go back to 2020, first quarter of 2020. When we started going down this strategy and this path. Andrew wasn't with us before. I remember Mike and I had quite a few lengthy conversations on the topic. But let's start with Mike. Let the audience know, why did we go into a Bitcoin strategy to begin with?
Yeah, I think the first quarter of 2020 was the beginning of the crazy years. And the world locked down, the offices emptied out, interest rates, the markets crashed, and then the interest rates crashed to zero, and the markets surged, and the world kind of got very confusing. Our first thought was, what about the core business? And then our second thought was, now everybody's working from home, they could get headhunted away by Microsoft or Google or Amazon, and they won't even actually have to move. And so we started worrying about existential issues like our employee satisfaction, how are we gonna grow? And then we looked at our assets and we realized our physical capital, we had 500 million in cash, was going to yield 0, and the head of the Fed said it would yield 0 for the next 4 years, and that made us a little bit worried. And then our human capital was not in the office, unstuck, floating in remote space, and we worried, how are we going to serve our human capital? And our conclusion was we needed to do something, and we also got this pressure from shareholders that we had all this cash and it was yielding 0% interest, and the cost of capital is normally 12%. So what do we do to keep the shareholders happy? What do we do to keep the employees happy? What do we do to actually get some benefit from our assets? And that got us looking around open-minded.
Yeah, and I think we looked at a lot of options, right? We talked about potentially buying back our stock, which in retrospect would have been dilutive. We brought in excellent bankers, excellent attorneys. A lot of folks, their thoughts were, why don't you put it in corporate bonds? You know how that would have gone. Keep it in T-bills. You know how that would have gone. Other alternative assets. And then we went down the path of actually executing on the strategy during that time. And some of our partners, Ming and I, probably talked nearly every day. Mike and I talk quite often. The board was very supportive. Folks like Dax Hansen and Amy Park were all part of the execution of the strategy. And it was a lot of work doing it for the first time. We also open sourced our strategy for Bitcoin for corporations at that point in time. But I think even as we launched our first convert in December of 2020, I don't think we knew exactly what was going to happen over the next 4 years. So what changed in our thinking over the next 4 years, Mike?
I think our stages went from defensive, we needed to do something to protect the company, and then it went to opportunistic. And I think by the time we got to December, we were opportunistic. Our stock had doubled or almost tripled, and we thought, well, since it's tripled and we can raise money, we should probably do something. And then by the first half of 2021, it became, I'd say, opportunistic in a high gear, but sort of strategic at that point. When we did the second, you do something once, like a convertible bond issue once, it's opportunistic. You do it twice, and it's programmatic. So I guess we went from defensive to opportunistic to programmatic. And the more we learned about Bitcoin, the more we learned about our place in the market, the more we started to think strategically that maybe there's a strategy and a long-term business strategy here. So after the programmatic, it became strategic, and then ultimately it became transformational. And we ended the journey as now we're a Bitcoin development company. We've transformed the way we think about the business.
And Andrew, you joined us midway through the crazy years, and I think maybe you made things less crazy, but share with us your thoughts on what you saw happen from when you joined in 2022 to now 2024 in the organization.
Yeah, it'll actually be, I think, 2 years next week. And, for me, just being part of the team has been transformational personally.
the officers and directors on Bitcoin. Bitcoin! Okay. C was very carefully think through investor communications and make sure that we built consensus with the investors, then move through a set of investor relations initiatives, including a Dutch auction, or in order to introduce the idea in the most graceful way possible, and then following that, reassess the situation, and every month we would look at the marketplace and reconsider our opportunities, and we would act rationally month by month, quarter by quarter, and that's how we got to where we are. Okay, you're online now?
I believe I am.
Okay.
So back to the question was, what's my experience been? And I joined 2 years ago in about a week or so, and if you recall, that was sort of around the time things started to get a little bit more volatile. And I think, Phong, you might have even joked, like my first quarter as CFO was not the best quarter for MicroStrategy. But I think through that experience, it really sort of helped us solidify culturally within the organization a really foundational support for Bitcoin, in addition to the longstanding legacy of the software business. And when I fast forward from 2 years ago today, we've obviously seen a tremendous amount of rally in Bitcoin and a lot more adoption. We've seen that benefit from a company standpoint as well through people, not only our employees, but also our shareholders that have become more aligned and also feel stronger about our conviction. Because I can tell you, we've got probably the person on stage here who's most convicted around Bitcoin, but I think that has bled through, the entire ecosystem at MicroStrategy in the past couple of years.
Yeah, I think one of the related benefits, and those who are customers, thank you, and who joined our MicroStrategy BI World presentations, I had some folks note that we are innovating faster than we ever have on our core software product. Our employee turnover is lower than it's been in a long time. And so by adopting a Bitcoin strategy, you see benefits throughout the organization, culturally, retention and hiring, and innovation. And that's just been awesome too. So Mike, here we are in 2024. MicroStrategy is the largest corporate holder, publicly traded corporate holder of Bitcoin in the world. And not many have followed yet in the last 4 years. What do you think in the environment today is different that will cause more to follow?
Yeah, I think we've had a lot of positive developments this year. Probably 2024 is the transformational year. The question that we posed in 2020, the existential question was, Bitcoin looks like the solution to our problems. In fact, it looks like the theoretical perfect solution to the problem we have. So is it too good to be true? Will it be banned? Will it be copied? Will it be hacked? Right? Humans have invented the perfect synthetic treasury asset, and so will it be banned, copied, or hacked? And after 4 years, we now know it won't be banned because it's been approved for inclusion in spot Bitcoin ETFs, and in essence has been endorsed as a crypto commodity, so not banned, but embraced. Will it be hacked? We now have 15 years with $65 billion in Satoshi's wallet, and that's the honeypot, and any hacker can get $65 billion or $60 billion if they wanted it, but they can't get it, so we know it hasn't been hacked. And will it be copied? And I think that now in 2024, we start to realize that no, it's not going to be copied. There's only one globally acknowledged crypto commodity in the world, and as a public company, we know, we couldn't do this with a security, even if it was a registered public security, and an unregistered security, a public company definitely couldn't do. So it has to be a commodity. We've now answered those 3 questions. Then we've got The fourth headwind was there were no public companies holding Bitcoin on their balance sheet. When we did a search, we found Overstock had $1 million worth of Bitcoin for a couple of months, and that was it. And so today you have a dozen publicly traded Bitcoin miners, and you have Tesla, and you have Block, and you have MicroStrategy, and you have dozens of SEC 40, investment trust, and so now you've got 100 type public entities, and we couldn't find one then. So that's the second headwind. And then the third headwind is this indefinite intangible accounting. It turns out that, if you're a company like ours and you've already executed the strategy and you've managed to get to the point where you have massive amounts of Bitcoin and people can calculate it, that accounting doesn't hurt you that much. But what it really does is it hurts anybody with a normal business that wants to put 5% of their assets or 10% of their assets, or if 10% of your enterprise value is Bitcoin and the other 90% is something else, what it does is it obscures the P&L and obscures the balance sheet. And so that accounting was a headwind. And now we're in 2024, you've got the option to elect fair value accounting. And I think in Block's announcement, they just announced they're adopting fair value accounting. So you've got the option, and in 2025, it becomes standard. And I think you've got the regulatory clarity that Bitcoin's a crypto commodity, and then you've got the support of the Wall Street machine that's spinning up. Now you've got Bitcoin research from Fidelity or from ARK or from you actually had 3 analysts of Bitcoin on stage today. And when we were doing it, you remember we were looking at Andreas Antonopoulos videos. We had a different set of data sources. And so, the research is stronger, the regulatory support is clearer. The professional community, the accountants, the lawyers, that infrastructure is better. Oh, and then the other thing is institutional custodians. You have Anchorage on stage, you have Coinbase, you have Fidelity, you have a lot more choices there. And if you were a company today and you decided you were going to do this with an institutional custodian, you would be able to choose one that already has a dozen or 2 dozen publicly traded companies as customers that have already disclosed that. Whereas when we were getting into the space, right, we weren't following in the footsteps of anybody else. And that means that our accountants, our lawyers, our finance professionals had to obsess over a lot of risks and ask the question, well, how do you even disclose these risks? What does the SEC expect you to say about these risks, because no one's ever done it before? And so what's the appropriate way to treat it?
Yeah, I remember in 2020, the homework for all of us was to look at 40 hours worth of quality Bitcoin content. And I think we struggled to find 40 hours worth of quality Bitcoin content. And now the bar is 1,000 hours of Bitcoin content. So things have changed a lot. So let's think about the opportunity for corporations going forward. And maybe we can think about it in concentric circles. The first one being companies that already have a Bitcoin strategy. The second one being technology companies. And the third one being just generally publicly traded companies. So what's the case for companies that have a Bitcoin strategy? Bitcoin miners, companies that may be publicly traded, that have Bitcoin ETP products, companies that have Bitcoin custody or exchange solutions. What is the case for those companies to put Bitcoin on their balance sheet as a starting point?
The way I think of it, I start with Bitcoin miners. The public Bitcoin miners, the case for them is they should be issuing convertible debt and equity, and they should be buying Bitcoin because they are public, they are creditworthy counterparties, they can issue securities, and they would be raising money, equity, or cheap debt capital and investing in an asset which is going up historically 40% a year or more. So that's very accretive for their business strategy. Their shareholders are already long Bitcoin. You have to believe Bitcoin is going up and not down to invest in a Bitcoin miner, right? There is no Bitcoin mining business model that works unless Bitcoin goes up in price. And if Bitcoin goes up in price more than 1% or 2% a year, then convertible debt is accretive and equity is accretive. So that's a fairly straightforward case, and fair value accounting makes it even easier, I think. I think the next class is Bitcoin exchanges and custodians. And for public ones, a Coinbase or whatever, well, you're in the business of convincing other people to buy and custody Bitcoin. And so for you to be buying Bitcoin quarterly and custodying Bitcoin, your own Bitcoin, sends a message to your customers that you actually believe it's a treasury asset and that it's safe with you. You can't really, in good faith, recommend someone buy an asset that you think is so risky as you don't want to use money to buy it, if you're going to be a custodian. So I think Block and Jack's putting his money where his mouth is right now, and he's rolled out a product to allow all the small, mid-sized businesses that work with Square to dollar cost average into Bitcoin. And then, Square the product, but Block the company is now doing the same thing. Right, and it illustrates that, you believe in your own product, you support your own ideas, and, you're a trustworthy exchange and custodian to do it, and then you're showing people how to do it. I think that any other exchange, whether they're private or public benefits, a public company, it's kind of an easy thing because public companies can issue equity and convertible debt to do it. For private companies, private custodians, private exchanges in the Bitcoin, community, my advice to them, and many of them have taken this advice. I mean, I think Alex Leishman showed today that he's doing it. You allocate some portion of your treasury to Bitcoin, and B, if you don't have enough, instead of raising $50 million in venture capital to fund operating losses or operations, you raise $200 million in capital and you put $150 million into Bitcoin and $50 million into operations. Because if you believe that Bitcoin is the future, then it's obviously accretive. And if you don't believe Bitcoin is the future, you should quit, sell the company, and get out of the business. Who wants to do business with someone that's selling something that they think is going to zero, right? You've lost your moral standing to be a vendor in the space if you don't support the future of the asset. There's a second order subtlety here, which is for public companies, the convertible debt markets really like a highly volatile asset. So if you're a miner and you issue convertible debt and you buy Bitcoin, then your equity becomes more volatile, then it becomes more liquid, then the options market comes to life, then the convertible debt comes to life, then your enterprise value grows, then your market cap grows, your premium expands, you can do it again. So this is the opposite of dilutive and risky. This actually de-risks the business strategy and is accretive if you're already long Bitcoin, as say a Bitcoin miner, and you're public. It's the way to get yourself out of a rut. If you're a private company, you have a bunch of VC and they want to invest money in private companies, but a venture capitalist would much rather invest $200 million 5 times than invest $50 million 20 times. It's just as much work to invest $500 million as it is to invest $25 million. So the real problem with VC is what's the use of proceeds? They have access to infinite capital. If you can generate a return more than the cost of capital, if you can beat the S&P index, you can raise billions and billions of dollars. There's infinite money. SoftBank illustrated this. So it's not hard to get the capital. The problem is, what do you do if someone gives you $100 billion in capital? And they did WeWork, right? And you can see the problem is you over-invest in bad ideas. right? Investing $20 billion in WeWork, you know, doesn't work out that well, but actually you could invest $20 billion in Bitcoin and it would work out just fine. So if you're a private company and you have a Bitcoin treasury strategy, you actually can solve two problems for your venture capitalists. One problem is you give them a use of proceeds, which is highly accretive, that beats the S&P index. And while they're waiting to get paid, they get 2% management fee and 20% carry. And that's a screaming home run. So that's one problem you solve. But the other problem you solve is that some people don't want to take one-for-one upside and downside risk. So if you're a private company, you can actually issue a participating preferred stock, which looks like a debt instrument that you don't have to mark to market. So an investor can basically invest in Bitcoin, get the upside of Bitcoin, not get the downside of Bitcoin, have a guaranteed PIK or a guaranteed accounting benefit. And so that really appeals to someone with an investment portfolio. It solves the problem for the limited partners. They don't have the volatility. It solves the problem for the general partners of the VC. And then you're the entrepreneur and you've got a Bitcoin exchange business and you want to compete with Fidelity and Goldman Sachs and Coinbase. It might work. But then again, it's kind of hard to compete with companies 100 times as big as you. So if you pursue the strategy I just articulated, if the business succeeds, you make a ton of money. And if your operating business fails, you still make billions and billions of dollars. So you make a ton of money if you fail, and you make a ton of money if you succeed. And the people that invest in you make a ton of money. And the people behind them don't have the volatility of Bitcoin. They just get gains on Bitcoin as everybody's winning. So who's losing? And the answer is, with digital capital, nobody's losing. And so that works with a private company. It works with a big private cash cow, like a $500 million utility company or trucking company or something. You just do it with private equity and not venture capital. It works with a mid-size miner. And then if we go on to non-Bitcoin companies, the world's full of zombie companies. And here's a zombie company, a company with $500 million in revenue that makes $80 million in cash flow, growing 0 to 5% a year, and it has $2 million a day of its stock trading. It's dead money, no options, $2 million of stock, and is valued at 1 times revenue. Now, and it has a little bit of cash. It has hundreds of millions or $500 million in cash. So what kind of company is that? Okay. That's a zombie. What's your future? You don't have a future. Why do people not trade your stock? Because nothing interesting happens for a year. You can check in once a year. Why would I buy something that I can predict the future of it? Will it go bankrupt? No. Are the options valuable? No. There's no volatility. The options are worthless. So you're gonna comp your employees in stock options? Good luck with that. The stock options are worthless because the options are worthless, okay? Who was that? That's us. I'm describing MicroStrategy in March of 2020. That was our company. But, and so how do we get ourselves out of that situation? If you're a zombie company like that, you go to a investment banker like Goldman Sachs or Morgan Stanley, and you say, help me. Their answer is, you need to do a transformational deal, a transformational acquisition. You either need to do a merger or you need to use your cash to buy a high-growth company growing 20% a year, and then you get some growth back into the stock. So you got to go do a deal. But it's hard to find an easy deal to do for $500 million where the thing you're buying is going to go up 20% a year, where you can actually integrate it. And so what is that thing? Well, that's Bitcoin. Bitcoin is the universal merger partner. So you can merge any zombie company with Bitcoin at 200 million scale, at 100 million scale, at 1 billion scale, at 2 billion scale, at 20 million scale. And it's actually reversible. You can merge in 20 million, you can reverse it, you can test it. And what happens is you take a $600 million company with $10 million of stock trading a day, and you buy 100 million of Bitcoin. The stock gets attention, it starts doubling, it gets volatile. Oh my God, the Bitcoin traded down 20 million, it's up 20 million. They had like 1 year worth of bad news. and everybody sells it, but then you have 1 year worth of good news the next day and everybody buys it, and now the stock trading triples. Now the options come to life. Now the employees are getting paid. Now there's a future. Now you can raise, you know, it's this conundrum I laid out. If you're conventional, you make the volatility go away, you give away the capital, and if you need money, you pay 10% interest for junk bonds. Like, that is when you need the capital, you can't afford the capital, right? Isn't that perverse? If I give up my capital and you know, when I need it, I pay 10 to 12% interest, right? On the other hand, if I reverse it, I buy some Bitcoin, I get the volatility. What does it matter? If the volatility comes from Bitcoin, it doesn't matter. Now, the volatility, the stock goes through the roof. The cost of capital goes through the floor. Now, when you need to borrow $500 million, you don't even need the money. So, of course, the market gives it to you for free. Right? So you can either be rich and have money for free and have high volatility and high option value and have 100 years worth of operating losses, and that's one strategy. That's the MicroStrategy, right? That's what we did. That's the Bitcoin strategy. Or you can do the opposite. You can be a zombie company and you're dead money. And so I think that we're more likely to see the mid-sized zombie companies, the $500 million revenue, the $1 billion revenue company with $5–10 million of stock trading a day, we're more likely to see them limp into Bitcoin, you know, post-FASB, than you will see the super marquee best run companies, because they feel like they don't need anybody's help. But these other companies, there's 1,000 companies that are mid-size, mid-cap. The Russell 2000, right? You know, the #1 performer in the Russell 2000 was Supermicro. The #2 performer was MicroStrategy. And the two companies are like 35% of the return on the Russell 2000, right? So what about the bottom 1,000? They're public, right? So I think that's the next interesting development and opportunity here.
Yeah, I think the irony is let's talk about 1,998 companies in the Russell 2000, and let's say they carry, you know, 20% of their revenues in cash on their balance sheet. Andrew, you've been a corporate treasurer before. The job of the corporate treasurer typically is to do no harm, right? That's what you're told as a corporate treasurer, do no harm. But if you're carrying $100 million on your balance sheet, earning what can they get now, 5%, versus the inflation
right,
is 8%.
If you look back in March, it was 0 to nothing, right? So.
Inflation 7%, right? The S&P is gaining more than that. Like, it seems like you're doing harm if you're keeping $100 million on your balance sheet, gaining 5%. But Andrew, so we have a bunch of investment banks and banks that have partnered with us here now. What's also difference between 2024 and now is we have folks like Citibank, like TD Cowen, Canaccord, BTIG, Moelis. Thank you for all your support. They have the formula now. So tell us about what that opportunity creates, Andrew.
Yeah, so still fresh in my mind and many of our minds was our activity in the first quarter around the convertible debt markets. Michael explained that sort of option or lever to generate capital to buy Bitcoin. I think what's transformed, you know, probably in the past 4 years as well is one, the support in that capital markets, as you just mentioned. There's a lot more banks that are out there willing to think about this with you and be alongside you. I think you alluded to in a previous panel that, you know, in 2021 there was one person that would talk to us. Right now, we have access to all of the best banks. There's still a couple that are out there that are probably lagging a little bit, but there's definitely more support in the investment banking community. There's also a significant amount of support in the investor community. So what I mean by what still resonates with me is what we did in Q1 is we launched a convertible debt offering. And I think, from what I've been told, there's been no one else that has been able to go back the very next week and issue another convertible debt with similar execution, you know, sub 1% coupon, 6 to 7 year money at 40+% premium, which we then converted directly to Bitcoin. So not only are there people supporting the execution of that, there are people and investors who want that exposure as much as we're willing to give it. And so that's how that ecosystem really comes together. And so as I hear, what should other companies think about? Can they go raise convertible debt? Look at what MicroStrategy's done. Part of what we're talking about is the playbook. You can go do that too, and you can find a way, find that intelligent leverage to be able to create shareholder value like we've done in the past 4 years.
So let's go to the next concentric circle. So with the Russell 2000, you have the corporate treasurers who ironically are told do no harm. And that's exactly what they're doing by just keeping cash on their balance sheet. In a money market, at best, they're doing harm. Now let's go to the Fortune 500, where usually the corporate bromide or trope there for the corporate treasurer is if you don't know what to do with the money, give it back to your shareholders, because they'll do a better job and they can make a decision of what to do. So what you see are these high cash flow, high cash balance companies either paying large dividends, and you're seeing that now more and more tech companies paying dividends, or doing large stock buybacks. But I think there's an alternative, Mike. Let's hear about that.
Yeah, the conventional wisdom is I buy back the stock or I issue a dividend. The dividend is sort of double taxed, and so that seems very tax inefficient. The buying back of a stock is the decapitalization. The real problem as I see it, I've said before, the road to serfdom is working exponentially harder for a currency growing exponentially weaker. So let's say you're a big company like Meta, and you have a good quarter. You basically cut a bunch of cost. You put a lot of money to the bottom line. The stock doubles. So now there's pressure to keep the stock price up. So the way you're going to keep the stock price up is you announce a $50 billion buyback and a dividend. Okay, so now I'm decapitalizing the company. I'm basically surrendering the capital. The assumption is that I can't get a yield on the capital if I invest it in a liquid treasury asset. And that is true if the only option is T-bills. If your option is T-bills, then your 3% after tax against a 12% cost of capital is 9% negative yielding money. And the view is, yeah, that's value destroying, give it back. But here's the problem. You need to be convincing the world that your stock is a store of value over the long term. So for the stock to be a store of value, then you're going to have to increase the value of your assets in the treasury at a rate equal to the cost of capital, or you're going to have to grow your cash flows at a rate equal to or faster than the cost of capital. So when you decapitalize, what you're doing is you're doubling the market cap of the company, but now the market cap doesn't trade based upon the book value of the company. It trades based upon the forward earnings estimates or forward cash flows of the estimates of the company. And the higher the stock goes, or the higher the stock price goes, the higher the discounted cash flows have to go. And the higher the inflation rate is, the higher the discounted cash flows have to go. So the stock is becoming more fragile or more brittle. And if you have one bad quarter where you underperform, the likelihood that the stock crashes, dramatically goes way up. So that idea of surrendering the capital is a road to serfdom. In the extreme, the first step is I surrender my capital. I have some bad quarters, so I have to borrow a bunch of money. And then the extreme step is I surrender the capital, then I borrow a bunch of money to surrender more capital. I have negative capital, like say Apple Computer is almost negative capital, but you can get the point where you're actually in debt 5x your annual earnings or 10x your annual earnings. And at that point, then just a weak quarter is a death sentence for the company. And that's why most mid-sized companies and all the LBOs, they eventually fail. That's why there's like a 99% corporate death rate amongst those kind of companies. And that's why the average corporate life expectancy is 2 years. So the opposite of that is to reverse the polarity if the treasury asset yields 24% and the cost of capital is 12%, the question is how much capital do I want? And by the way, really the opportunity cost of capital is 12%, whereas the actual cost of capital, that varies by corporate entity. Apple Computer could borrow money at half of that number, I suppose. And if you use convertible debt, if you have a volatile equity, you could borrow money at a tenth of that number. So the amount you pay for the capital may be and probably is less than 12%, but the use of proceeds is the critical question. And so if the use of proceeds is T-bills, then any amount of capital is dilutive, and you want the bare minimum working capital. And if the use of proceeds is Bitcoin, well, Bitcoin has been yielding 3 to 4 times the return of the S&P index. And if you extrapolate out a decade, the volatility will come in, the performance will come in, but I think it's very reasonable based on first principles to assume that it will be returning some, 2x the multiple of the S&P, or 50%, or 75% more than the S&P index. And the volatility will always be higher because it's a 24/7, 365 global traded digital asset in unregulated markets. It'll always be higher than the S&P, and the performance will be higher because of lack of dilution. So in essence, it's a very simple polarity question. If you get 24% yield on a tax-deferred yield on the Treasury, then you want as much capital as you can gather. And if you get less than 12% yield, you want as little capital as you can carry. The only company I can think of that the famous one that uses its balance sheet is Berkshire Hathaway. And Berkshire Hathaway's investments in like Apple and Coca-Cola and the like allowed it to beat the S&P performance, and that's why they could have a $1 trillion balance sheet, and they have $1 trillion of liquid capital, or something like that, $1 trillion balance sheet. But the problem is they pursued their strategy using securities as a treasury asset, not using commodities or property. And because of SEC 40 rules, you can't have more than, what is the number, 40% of your liquid capital as securities. And so they hit some wall, and then they have to go off and do big acquisitions of operating companies in order to grow, and those are always much more difficult. Or they have to carry $160 billion worth of T-bills, because those are carved out. They're treated not as securities for the purposes of that. So in essence, they hit a wall, and Berkshire stopped being able to grow in the same way because of some constraints and because they have not embraced Bitcoin. If they embraced Bitcoin, then they could actually grow faster and they would be performing better. And I think that that Bitcoin really is the game changer because it flips the polarity from negative to positive. And imagine what happens when 10,000 operating companies start recapitalizing. Imagine a world where 10,000 companies keep their cash flows and don't dividend them out. Imagine 10,000 companies buying Bitcoin instead of buying their own stock. Imagine 10,000 companies issuing debt securities to buy Bitcoin instead of issuing debt to buy their own stock, right? And you can see how at some point, as you go from 1 company to 10 companies to 100 companies to 1,000 companies, at some point these become a massive capital gateway, and that's how you see the trillions and tens of trillions of dollars of capital flow out of the analog economy into the digital economy, and the world turns upside down for those firms.
Yeah, it's as if corporate treasurers and banks have forgotten, what they learned in business school or they learned in microeconomics or corporate finance. If you can find an investment that exceeds your cost of capital, whether it be 5%, 7%, or 8%, you should invest in it. And if you can't, then it means you should return it to their shareholders. In this particular case, there is an investment that can exceed the cost of capital, and they have I would say, a fiduciary responsibility to make the investment. And then you can say, well, do you think it's going to return 10% or 15 or 20 or 24? I think Mike's conservative with 24. You can have that debate and argument, but like returning it to the shareholders is basically giving up, right? You have nothing better to spend your money on at this point in time, so you're going to give it back to the shareholders because in theory they know better what to spend it on. And I just think whenever I hear corporate treasurers or CFOs or CEOs or boards talk like that, it just feels like they've given up at that point in time, as opposed to they have a responsibility to their shareholders.
You're just waiting to die. Like the money is just you're just waiting to die.
I'll go with giving up. So what's next? What do you see next, Andrew? What do you see next, Mike? I mean, we have a formula. I can understand why in 2020 and 2021 folks haven't adopted it. It's that the timing is amazing, right? We now have the Bitcoin ETPs and the institutionalization of the asset class, right? We have the new accounting standards in place. And we're starting to see what Square is doing. They're putting their money where their mouth is, but the timing is actually quite nice that they did it this quarter because there are two fundamental shifts. 10% is a good start, Michael. You know, it's Rahani, not you. When do we start seeing more? When do we start seeing the companies start to adopt?
I think you get a parade of endorsements. You're going to start getting 13F filings here in May, and you're going to see, a parade of famous investors and famous funds that started biting off a bit of Bitcoin, and that's going to change things. I think you're going to see more and more securities issuances, more ETFs. Then you're going to see more derivatives. You're going to see more public companies. I think you're going to see more Bitcoin miners. They're going to be announcing that they're not just mining Bitcoin, they're buying Bitcoin. I think you're going to see more good news coming from the clients of Square, right? And small, mid-sized businesses. You're going to see more of them. I think you're going to see more of the exchanges announcing that they're taking some systemic view. I think it'll be just bit by bit, every quarter, one more normalizing, program that builds Bitcoin into the capital structure of a private, a public company, a fund. You're going to see. I think over the next 4 quarters, you'll see announcements from the big banks that they've approved Bitcoin ETFs for unsolicited sale, and it'll be one a quarter, and then the next one, then the next one, then the next one, and then you'll see announcements that it's marginable, and then you'll see, like you saw last week, a dozen funds at Morgan Stanley approved Bitcoin to be incorporated in the fund, and then a bunch at 2 at BlackRock, and I think you'll just start to see more and more of these things. And that will drive the news cycle. And then I think you'll see some of these small, mid-size, these zombie companies. We've had CEOs of some of these companies reach out to us. I've had them reach out to me. And it's like when you're stuck and mired and your options are worthless and you're worried about losing your employees and you want to put some life back into the company, you need to do a deal. I mean, at that point, it's very simple. You're either going to sell yourself, and the deal you're going to do is sell out to a bigger entity that can get value out of your product, or you got to buy something or buy somebody, or it's either a merger of equals, or you're going to buy a small, high-growth thing, or you're going to sell out. And up until 2024, I don't think Bitcoin was an institutional option. The banks were afraid of it. Public companies were afraid of it. They didn't know which side the SEC would come down on it. I think by the end of 2024, I think the institutional world, the public company world will say, well, Bitcoin's not going away. Bitcoin's the only crypto asset. It's the best. There is no second best. We're not going to get shot to have it on our balance sheet. And at that point, people switch from fear, or fear of doing something to fear of not doing something, or maybe from fear to greed index, and they click it up a bit by bit. 2025 to 2028, those are kind of the years of early adoption. But good for us. It doesn't take much at this stage. It takes 2, 3, 5, 10 companies to act, and you kick off a roaring bull run. You know, it doesn't take much to move Bitcoin from 60,000 to 150 or 200,000. When we get to 200,000, we're going to need, you know, 10x more capital to move it to the next level. But they'll be on stage with us then.
Well, Michael, Andrew, it's been a tremendous journey, and we're just getting started. It's still early. I do want to thank all of our shareholders and all of our customers and our analysts and our partners and everybody else who's joined us in person and online. I'm going to hand it over to Natalie to close things out. Thank you all.
Thank you so much. And a testament, once again, to the leadership. I mean, MicroStrategy has been a pioneer when it comes to Bitcoin corporate adoption. And I mentioned this yesterday, but I've been so impressed by all the people I've met who work at this company, and so many of them have been here for decades. So that says a lot about the leadership that's coming from the top. Thank you so much for joining us for MicroStrategy World Bitcoin for Corporations. I think they've painted a very bright orange future. I hope a lot of you have learned something new. If you haven't gotten your fill of Michael Saylor interviews, I just did another one. You can check it out on my podcast. I'm Natalie Brunell. Thank you so much, everyone, and thank you so much to the sponsors.